Hello students. So in this particular session, we are going to learn about the concepts regarding your advanced capital budgeting decisions. Okay. So this particular chapter, as you all are aware that it is an extended version of your Inter CA chapter, which was dealing with your investment decisions. But definitely there are some very important concepts and very advanced concepts when we are going to study about this particular chapter. So I'm going to cover all the concepts of your study module here. So please keep your books handy and keep on solving this along with me whenever I am solving it so that everything gets completed with one go. Okay. And this chapter, if it comes in your examination, where the expected weightage can be anywhere between 5 marks to 10 marks, so then it can be very easy to score for you as well. Okay. So basically, whenever we are dealing with your investment decisions, what you have learned till now is uh, whenever we make investment in a particular project, we have to first see that what is going to be your cash outflows. Then we are going to estimate what is going to be the cash inflows. And whatever are the future value of cash inflows, usually there were various techniques to evaluate the particular project, and the most common being your net present value method, right? Also known as your NPV. So what we used to do in that particular case under your NPV method, we used to discount all the future value of cash inflows into present value terms by taking into consideration your discounting factor, which was nothing but the cost of capital. So we used to get PV of CI, we used to subtract PV of CO. Ultimately, we used to get your NPV. And if the NPV would have been positive, we would have accepted the particular project. And then there were various other techniques as well, where we used to take into consideration payback period method, discounted payback period, internal rate of return method, and all those methods. But here in advanced capital budgeting decisions, the most common method which we are going to use here is discounted cash inflows for the purpose of evaluation of a project. But not only the economic benefits from the project will be taken into consideration, but how do we consider the risk and the uncertainty in the project, and how should we incorporate that as well for the purpose of decision making? Even that needs to be taken into consideration. So isn't it very much obvious that whenever we are making investment in projects and we have like 5 projects for the purpose of evaluation, all the 5 projects definitely will not have the same types of risks, right? So all the 5 projects will not have the same types of uncertainties. So it is the duty of a CFO or the fund manager or the investor that how do we evaluate such kind of uncertainties and risk in these different types of projects, and how do we evaluate the same, and then select a particular project for the purpose of decision making. Okay. Now, basically what happens is that in capital budgeting, there are 3 things which are going to have maximum impact. And that is nothing but something which is called as the impact of inflation in the capital budgeting decisions. Then there is whatever is a change in technological trends and how is that going to impact your capital budgeting decisions. And also at the same time, how government policies also impact your capital budgeting decisions, right? So if you are making investment in a particular project, so we have to consider these 3 aspects at a very macroeconomic level for the purpose of making decisions, right? The first one being what? Whatever is going to be your inflation trends. So definitely when we are estimating all the future value of cash inflows, I hope you understand that the value of 1 rupee at the end of 1 year is not going to be the same. So what is going to be the impact of inflation to discount it and to bring it to the present value terms? That is something which we are going to understand here. Also, how technological changes will have an impact in your capital budgeting decisions. See, there are certain types of investments or certain types of projects where technology keeps on changing. So we have to check what are the different kinds of scenarios. What if the products which we are manufacturing and we have estimated the cash inflows for 5 years, but let's say after 3 or 4 years, there is some change in technology or the old technology become obsolete or something like that. So because of that, in the worst case scenario, how do we evaluate the capital budgeting decision? How much a particular variable is sensitive to different types of changes in other variables. So sensitivity analysis needs to be taken into consideration, right? Also at the same time, there are different types of probabilities when we will be estimating your cash inflows. So all these things, you have to incorporate while making your investment decisions. Also, at the same time, how does government policies have an impact on your capital budgeting decisions, right? So basically, just to give you a gist, like in a very summarized way, government keeps on changing their monetary policies, and based on monetary policies, what happens is that the cost of capital of the particular company can also change, right? So prima facie, what happens is that whenever investment is being made in a particular project, we always make investment from the long term perspective. All right. So when we are making investment from the long term perspective, what do? Is we also raise the funds from the long term sources, and generally on the base of fixed sources. So that is why when there is a fixed capital which is attached, changes in the government policies might not impact the capital budgeting decisions that much, right? Because we generally take your cost of capital as a discounting factor. So usually what happens is that, let's say for example, there are certain changes in the monetary policy because of which the cost of capital of the company is going to change. Let's say I've taken a loan at a floating rate of interest, okay? So which is a benchmark rate, let us say repo plus 1% spread. So when the government changes its policies at macroeconomic levels, okay, and when the monetary policy changes, if the repo rate keeps on increasing, then can I say that at the same time my cost of capital must be also having an impact? Yes or no? Yes. So this only is possible when I'm investing funds in a project where I have raised those particular funds, from long term sources, but which are actually floating in nature. But in usual circumstances, as a fund manager and as a CFO of a company, you should always try and raise the capital, from your long-term sources at fixed rate, so that changes in the government policy should not have an impact on your investment decision projects. Okay, so uh, I hope you're understanding that at a very nascent stage earlier at Interc, you just understood that whenever we are evaluating a particular project, we simply just estimate the cash inflows, okay? And then we discount it at cost of capital, bring it to the present value terms. But as I just now discussed, that along with the normal estimation of cash inflows, what is important that we should also focus on the uncertainty and the risk aspect, okay? And these are the three main macroeconomic factors, on the base of which there can be some changes, in your investment decisions. Fine. So as we just discussed that current trends in capital budgeting, the changes are pertaining to inflation, then changes in technology and changes in government policies. Okay. But amongst this, the most important aspect is whatever is the impact on your capital budget, inflation and its impact on the capital budgeting decisions. Now, this is the most important aspect, okay? How this inflation is going to have an impact in the capital budgeting decision, okay? Now, see, ideally, what happens is, if I just give you a basic summary of what the income statement is, as you all are aware about it, wherever you feel you want to write down something, then please make a note of it. We usually take sales minus variable cost. What do we get? Contribution from this. If we subtract fixed cost, we get net profit before depreciation and tax. Okay, from which we subtract your depreciation, we get your net profit before tax. We subtract your tax, then we get your net profits after tax. On which, if we add the amount of the depreciation, what do we get is your cash inflow. So this is the normal format of the income statement. Okay. Now, if I just put some figures, this is nothing but sales of 1 lakh, and your variable cost is, let's say, for example, 70%. So I'll put here 70,000 as a variable cost. Suppose your contribution is 30,000, your fixed cost is, let's say, 5,000, and your NPBDT is 25, from which if I subtract 5,000, then my net profit before tax will be 20. And suppose my tax rate is, let's say, 30%. So 6,000 will be my tax, and this is your NPAT, and your depreciation is again 5,000. So ultimately, you are getting the cash inflow of 19,000, correct? So we focus mainly on the cash profits, rather than what is just being accounted in the books. Okay. because when we are talking about book profits, then in that particular case, the companies which have a huge quantum of investment in capital asset, they tend to charge more depreciation, and because of that, their profits might be relatively lower. Okay. So we might devalue some projects or some companies for making investments. Suppose the quantum of depreciation is higher in that particular case, so the profits will be reduced, and we might, if we are just evaluating a project based on the book profits, then we might not make the investments on the same. But actually, what is important is how much cash which is generated. So that is why we add the quantum of depreciation to get the amount of your cash inflows. And this particular same concept, can I say we can also present it by taking whatever is my sales, from which I will subtract my total cost. Okay, that is nothing but your variable cost and fixed cost. So ultimately, I'll be getting your net profit before depreciation and tax. And let me just subtract the tax rate. Okay. And then what I will do is I will add the tax savings on depreciation. And the moment I add the tax savings on depreciation, what will I ultimately get is nothing but the cash inflow. Okay. So this is the shorter version of this income statement. So let's say, for example, my sales here is 1 lakh. And you can see my total cost, that is variable cost plus fixed cost, that is nothing but 75. So now my NPBDT will be 25,000 and my tax rate is 30%. So 25,000 ka 30% is 7,500. Okay. And this figure will give me 17,500. And now let me add back, the tax savings on the depreciation. So my depreciation was how much amount? 55,000 and the tax rate was 30%. So if I simply take my 5,000 and multiply that by the tax rate, which is 30%, so 5,000 into 30%, that is 1,500. And if I add it, then ultimately what will I get is nothing but 19,000. Okay, so I hope you're trying to understand that under both the situations, I'll be getting, the same cash inflows. So either you prepare the entire income statement, or from the sales, you subtract the total cost. Okay. And whatever is your net profit before depreciation and tax, you convert that post tax and add your tax savings on depreciation. Then ultimately what you're going to get is nothing but your cash inflows. Okay. So this is ultimately the same concept, okay, which is written here, impact of inflation on your capital budgeting decisions, where, this is the format of the normal income statement. Okay. Where we have revenue minus cost minus depreciation, then we'll multiply that by 1 minus tax. Okay. And add the amount of the depreciation, which is very equivalent to, we take revenue minus cost. Okay. And then convert that post tax and add the tax savings on the depreciation part. Okay. Now, of course, it goes without saying that the tax savings on depreciation, okay, that does not depend on inflation, as depreciation charges are based on the historical cost. Okay. So obviously what happens is that, when we are talking about the inflationary trends in the macroeconomic factor, then which all elements will be affected by the same? Then it's definitely your sales and the cost, excluding your depreciation. Okay. So that should not be taken into consideration, because your tax savings on depreciation does not depend upon the inflation. How do we calculate the depreciation? What do we take it into consideration? We simply take whatever is your depreciation and, that is original cost minus scrap, divide that by life. So that particular depreciation per year is always going to be constant. Okay. So basically what they're trying to tell us is that that does not have an impact on the inflation. Okay. But yes, can I say that this particular element, will that be having an impact due to the inflation? Come on, yes or no? Yes, sir. So if I'm changing some sales, then definitely, let's say, for example, there is inflation of 10%, then my sales will definitely be having an impact. But my depreciation does not move, okay, along with the changes in whatever the inflationary trends are. So why I'm saying all these things is, let's say, for example, for an MCQ, they might ask you something like this, that out of the following costs, which of the cost does not have any impact on the inflation, and it's going to be constant throughout. So in that particular case, of course, depreciation, right? So that is not going to have an impact on the same. So this is one of the examples on the basis of which your depreciation is being calculated, and what is going to be the impact of the inflation in the particular economy and in this particular project, and how are we going to calculate the cash flows. Now see, in this particular case, you all can just check that we are having the initial outlay of a project. So that's nothing but your cash outflow, which is 80,000 rupees. And we make the investments today itself. So that's why its present value is also going to be 80,000. Your annual revenue is 60,000. Okay. So 60,000 per annum is constant. And annual cost other than depreciation is 20,000. Your tax rate is 50% and depreciation on straight line basis, presuming as if there is no inflation. So what your income statement will look like. So from your revenue, you subtract your cost, then you subtract your depreciation. What do we get is your net profit before depreciation and tax, from which we subtract your tax, net profit after tax. And to this net profits after tax, the moment I add back the depreciation, what do I get is my cash inflows. Okay, so this is what is happening. So my cash inflows are 30, 30, 30, 30. Now, if there is inflation of 10% applicable to the revenues and cost of the project, then can I say that if there is an inflation, what does it happen is that my cash inflows, my sales, etc., is definitely going to grow. Okay. It means that while estimating the sales, I have to take the impact of the cash inflows of this particular inflation rate as well. What do I mean by this? See, now just pay attention here. See, what happens is, as a CFO of a company, when I want to invest in a particular project, and if I tell my sales department that please estimate what is going to be the sales for the next 4 years, okay? So if we are investing in this particular project, so they will estimate that sir, sales for the next 4 years will be, let's say, we are able to sell 10,000 units at rupees 6. So 60,000 is example my sales, okay? Then I ask him that what is your prediction of the output? And if suppose the CFO tells that the sales manager tells that we are estimating that 10,000 is going to remain constant. Okay. So in this particular case, can I say the sales department has estimated that there is a sales of 60,000 every year for the period of next 4 years. Now, what is the problem in this estimate is that inflation is not taken into consideration. So the sales department has kept this 6 rupees per unit constant for the period of 4 years. Now just imagine something like this, that when at the macroeconomic level, if the retail price index goes up, then definitely the selling price of your particular unit which you are selling in the market, that is also going to go up. So it's not going to be constant at rupees 6 per unit. Similarly, when I tell you that uh, regarding the cost, your variable cost, your labor cost, your fixed cost, what do you think that the cost is going to remain constant every year? You have taken some premises on rental basis. Do you think that it's going to be remain constant throughout the period of 4 years? Then the answer is absolutely no. So that needs to be increased year after year due to the impact of inflation. So the sales department or the production department or the marketing department, when they are going to give you estimates, do you think as a CFO of a company, you are going to get those estimates after incorporating inflation? Then the answer is absolutely no. They are just going to give you the data which is there without inflation, and that is something which we actually call as real cash flows. So they just give it to us without the impact of the inflation. Okay. Now, what happens is, let's say for example, this is 60, 60, 60, 60. Okay. Now we are considering the inflation at the rate of 10%. Now in this particular case, what happens is that if suppose today value of 1 rupee is 1 rupee, what do you think that at the end of 1 year, it's not going to be 1 rupee at all. So there is going to be inflation of 10%. So if something which I'm selling it for 1 rupee today, because of 10% inflation in the economy, can I say at the end of year one, I'll be selling the same product for 1 rupee 10 paise? Okay, so 1.1. So I'll be selling that for 1.1. So if there is an inflation of 10%, then can I say 1.1? That is going to be my selling price at the end of year one. Then at the end of year two, it's going to be 1.1 plus 10%. So that's going to be 1.21. So while calculating the inflation, do we have to give the compounding effect for the same commodity? Yes or no? Yes, sir. So at the end of year one, the price of the commodity will be sold for 1.1. Then at the end of 2 years, it will be sold for 1.21. At the end of 3 years, it will be sold for 1.331. At the end of fourth year, it will be sold for 1.4641, right? So because of 10% inflation in the economy, this same product at the end of fourth year will be sold for 1.1461, right? If I'm incorporating 10% inflation to it. Now, what was my selling price? It was 6 rupees. So right now the selling price is 6 rupees. But because of 10% inflation, can I say it will be nothing but 6.6, right? Then if I take 1.21 and multiply that by 6, so this will be nothing but what? 7.26, right? Then if I multiply this by 6, then this particular product will be sold for 7.986, okay? And then if I multiply this by 6, then 1.4641 multiplied by 6, this will give you 8.7846. So many students, they get confused here that how do we incorporate inflation when we are calculating the selling price per unit. So one very simple way is what? You can simply take, instead of 6 rupees, you can add 10% inflation. So that will become 6.6. Then to this 6.6, you directly add 10%. That's nothing but 7.26, right? Then you add 10%, that is 7.986. Okay. And then you add 10%. So that will be nothing but 8.7846. Okay. And then you have to multiply that whatever is going to be the number of units to actually get the amount of sales. Okay. So as you can see here, the revenues are calculated just like the way what we have discussed. Okay. So we just have to multiply that by whatever is going to be the selling price per unit at the end of first year, second year, third year, fourth year. Keep on multiplying that, we'll be getting the amount of the revenue. And then what about the cost? So cost here also at the same time, that also needs to be increased by your 10% rate. So then we are going to increase the amount of the cost as well. Then depreciation, as you can see that it always remains constant because it is based on historical cost, and the impact of inflation does not have, it does not have any impact on the inflation. So it's going to remain constant at 20. Then we'll be getting taxable profits. You subtract tax, then add cash flows. Then we'll be getting the net cash inflows. Now these net cash inflows are actually called as your nominal cash flows. So nominal cash flows, you always have to understand that it is after taking into consideration the impact of inflation in the economy. Okay. And if suppose these are your nominal cash inflows, and if I want to know that what are my real cash inflows, so to calculate the real cash inflows, what I need to do is I have to remove the proportion of inflation from this particular cash inflows. Okay. So real cash flows are what? This is excluding the impact of inflation. Okay. Now 32,000 which we have calculated, that is including the impact of inflation. If I want to exclude that, then in this particular case, what will be the real cash inflows? Okay. So now this is 32,000. Okay. And I want to remove the impact of inflation. So I want to deflate this particular case and I want to bring it to the real cash flows. So then this 32,000, I need to bring it down to the real cash inflows by discounting it with the inflation rate of 10%. Now, because this was just at the end of year one, so this will be the same. You can take 1 divided by 1.1 and multiply the same by 32,000. Then you will be getting 29,091. Okay. But when we are actually deflating this particular amount, okay, so from 34,200, which is the future value of cash inflows, if I want to bring it now to, this 28,000, that is excluding just your inflationary aspect, then the change here will be from 34,200, I need to bring it down by taking 10% inflation rate raised to the power 2. Okay, because that is at the end of the second year. So 1 divided by 1.1 raised to the power 2 and you multiply that by 34,200, ultimately what you're going to get is 28,264 and so on. So till now, it was always observed like this, that whenever we talk about evaluating a particular project and the cash flows which we have, we always talk about the cash flows which are real in nature. Till now, this is what I'm trying to explain you at inter CA level or at the any earlier level. You have just understood that we can evaluate a project just by taking into consideration your real cash flows. Okay. So we just estimate it by whatever is the real cash flows at the end of year 1, year 2, year 3, year 4. Whatever are your real cash flows, we just discount it, at your cost of capital to bring it to the present value terms. Okay. Now, but in real life, practically, what plays an important role? Do you think that the real cash flows are actually used for the purpose of evaluating a particular project? Then the answer is no. So we tend to usually take into consideration nominal cash flows. Okay. So a CFO of a particular company, when it wants to make investments in a particular project, he will always receive the data which are real cash flows. Okay. So when you all are going to become chartered accountants and you all are, evaluating a project, then your sales manager will always tell you, okay, sir, these are the cash flows. But the first thing you have to ask him is, have you incorporated inflation in it? So he's like, sir, what? Well, okay, no problem. Chalo. Now I've understood that first I have to convert this real cash flows to nominal cash flows. And the moment I convert that into nominal cash flows, then I have to discount it at a nominal discounting factor rate. Okay. So prima facie, okay, this evaluation of projects, okay, can be done on two bases. Okay. So one is your nominal cash flows and the other one is your real cash flows. Okay. So nominal cash inflows always means including inflation, and your real cash flows always means excluding inflation. And whenever we are talking about nominal cash inflows, okay, we will always discount at nominal discounting factor, and that is including your inflation. Okay. And your excluding inflation, matlab the real cash flows, will always discount it at a real discounting factor, and that is a discounting factor which excludes the inflation in it. Okay. So first of all, as I told you that these real cash flows, okay, let's say for example it is rupees 1 lakh, and if I want to convert this into nominal cash flows, okay, so then what do I have to do? I have to simply add the inflation part to it, right? So then this will now become 1,10,000. These are my nominal cash flows. Okay. 1,10,000. Now, if you ask me, sir, how do we present this in the easier way? So then your nominal cash flows can be whatever is your real cash flows into 1 plus inflation rate. Okay. And similarly, what is your, how do we calculate your nominal discounting factor? If they give you a discounting factor without the impact of inflation, and if there is an inflation percentage which is given to you, so how do you calculate your nominal discounting factor? So that you calculate by taking 1 plus nominal discounting factor is equal to 1 plus whatever is the real discounting factor. To that, I have to add 1 plus whatever is my inflation rate. So based on this, can we calculate whatever is going to be your nominal discounting factor? Come on, yes or no? Yes, sir. So this is something you have to understand, why? Because if sometimes they have told you to evaluate a project just on basis of real cash flow basis, okay, and they have given you nominal discounting factor and the nominal cash flows. So what do we need to do is, then we will take nominal cash flows, divide that by 1 plus inflation rate to get the real cash flows, and then how will we calculate the real discounting factor? So we'll take the inflation rate here. So 1 plus nominal discounting factor, if I divide that by 1 plus inflation rate, I'm going to get my 1 plus real discounting factor. Okay. So this is the pure content which speaks about how do we incorporate your inflationary trends for the purpose of decision making. Okay. And why is it so much important? Because that is the most practical approach. So in real life, the data which you're going to get from your various departments will always be real. Convert that into nominal and then evaluate it. Okay. So I will just give you one small example, okay, which will help you to understand this in much better way. Okay. So now see, in this particular example, what is given to you that the cash outflow is rupees 1 lakh, and we have for the next 3 years the cash inflow that is 50,000, 50,000, 50,000. Now let's say for example the inflation is at the rate of 10%. Then what will happen is that these are the cash inflows which are actually your real cash inflows. That is, it does not take into consideration the impact of inflation. Okay. So if we consider the inflation aspect to it, and inflation rate is 10%. So as we have just now discussed that we have to give compounding effect while calculating the impact of inflation in your nominal cash flows. Okay. So that is why this 50,000, your nominal cash inflows will be 55,000. Then this 50,000 will be nothing but 60,500. This 50,000 will be 66,550. Now all these are your nominal cash inflows. So this, can I say, is including the amount of inflation? Come on, yes or no? Yes, sir. So we have to discount it by the nominal cash, nominal discounting factor. And suppose your nominal discounting factor is 15.5%. Then in this particular case, what will be my present value? My present value will be 1,36,161. Okay. So nominal cash inflows should always be discounted at the nominal discounting factor. That is nothing but the inflation aspect is to be taken into consideration in that discounting factor itself. So in the question only they have given to you, let's say the real cash inflows are 50,000 and the nominal discounting factor is 15.5%. Okay. And there is 10% inflation rate. So the first thing is we have to convert the real cash flows to your nominal cash inflows, just we right now did. And then we'll discount it at the nominal discounting factor. We'll be getting the present value, which is 1,36,161. And then 1 lakh is your cash outflow. You subtract it, then finally 36,161. This is your NPV. Now, the same concept, if I want, I can also solve it in an alternative way. Okay. So this is nominal cash inflows discounted at nominal discounting factor to get the present value. Now, I will evaluate the same project, but I will take into consideration the real cash inflows and I will discount it at a real discounting factor. So real discounting factor is something which does not have any impact of inflation in it. So in this particular case, as you can see here, 1, 2, 3, we have cash inflows and then we have real discounting factor, which is at the rate of 5%. Now, how did I get the real discounting factor at the rate of 5%? So see here, I'm not incorporating any inflation. So I'm not incorporating any inflation in my cash inflows. I'm discounting 50,000 rupees only, but I'm discounting it at a real discounting factor that should not have inflation in it. So my nominal discounting factor was 15.5% and it had inflation in it. Your real discounting factor will be how much? That is excluding the inflation element. So it has to be lower than 15.5%. So as we just now discussed, we can calculate the same by taking 1 plus real discounting factor into 1 plus inflation. Then if the inflation rate comes here, then ultimately your real discounting factor is nothing but 5%. So now can I discount all these cash inflows at 5%? Yes. Can I get the present value? Yes. So this is nothing but 1,36,162. Okay. Are you realizing that your PV of CI is 1,36,161 in both the cases? But the only thing is, in the first approach, I used nominal cash inflows including inflation and hence nominal discounting factor including inflation. In the second scenario, I have taken real cash inflows excluding inflation, and so I've taken real discounting factor excluding inflation. So till now, basically what you were doing is you all were taking into consideration just real cash flows. You all were not incorporating inflation element. But in advanced capital budgeting, what are we going to do? We will definitely incorporate your inflation aspect in it. Okay. And obviously estimate the nominal cash flows. So basically, there is a very big controversy, sir, what to do with the cost of capital if it is given to you in the question. So if suppose the cost of capital rate which is given to you or the minimum required rate of return which is actually given to you in the question, that is let's say 15.5%. So should we treat that as including the inflation or excluding the inflation? Now my personal view here is that whenever cost of capital is something which is calculated by the CFO of a company, that cost of capital always takes into consideration the current trends of inflation in it. Okay. So if I tell you that, let's say for example, let's calculate your KD, cost of debt. So if you can just recollect your bond valuation aspect, how do you calculate your cost of debt? Your cost of debt is actually calculated by taking into consideration whatever is your yield, which is going on in the market, right? We take that into consideration and then we bring that post tax. Also at the same time, whenever we are calculating your cost of equity as well. So we are using your premium approach, CAPM model. So whatever is the beta, whatever is the risk-free rate, all this, your risk-free rate also takes into consideration the current interest rates which are prevailing in the economy, which is based on the current trends of the inflation. So in my personal view, whenever they give you cost of capital, we can assume that cost of capital always as including the inflation element in it. And then, just consider that as a nominal discounting factor. Then you can further see that what is the data which is given to you in the question. If the cash inflows are given to you in real terms, then we will convert that into nominal cash inflows. And then we have the nominal discounting factor. We can discount it and bring it to the present value terms. So your minimum required rate of return or cost of capital, the conclusion is we can assume that as your nominal discounting factor, that is including the inflation element in it. Okay. And the same thing is also written here. See, your cost of capital considered for investment appraisals contain a premium for anticipated inflation. So does your cost of capital contain a premium for inflation? Then the answer is absolutely yes. So due to inflation, the investors require the normal rate of return to be equal to your required rate of return in real terms plus the rate of inflation. Okay, so that's just now what we discussed. Okay. So your nominal discounting factor is real discounting factor plus the inflation element in it. Okay. Now see, this is a very basic illustration that we are required to determine what should be the NPV of the project with the help of the following information. So this is nothing but your cash outflows, and the present value of 40,000 is always 40,000 itself because we make the investments today. Then we have the revenues without inflation. Okay. So can I say these are your real cash inflows? Okay. So real cash flows is your real sales is nothing but your 30,000. Similarly, annual cost without inflation. So this is also your real data which is given to you, that is without the inflation. So which will make you realize that we have to incorporate now inflation element in it. Then we have the useful life of 4 years, we have salvage 0, and then we have the tax rate. Also at the same time, they have told you that the cost of capital, including the inflation premium of 10% is 12, is nothing but 12%. So now see, do we have the nominal discounting factor? Yes, sir. Now, if it's a nominal discounting factor which is given to you, the first thing you all should do is that we have to convert these cash flows from real to nominal. That is including the inflation aspect. So your sales manager has just told you, okay, sir, we are going to earn 30,000 per year for 4 years. Your production manager has told you that, sir, there is going to be a cost of 10,000 every year for the period of 4 years. Now see, the best part is that the inflation for both the aspects is given to you is nothing but the same, that is 10%. You can see the inflation premium is 10%. But, there can be some questions in which there can be different inflation rates for different parameters, that is revenue and cost. And also at the same time, there can be different discounting factors, or there can be different inflation rates for different years as well. Okay. So both these aspects are possible, but here it is constant. Okay. Now, what do we have to do? We have to convert this real cash flows to your nominal cash flows. Okay. So very interesting. What we will do is, this is 30,000 real. We will convert that into nominal cash flows by considering the inflation element of 10% in it. Okay. So ideally, your revenues will look like this. Uh, Year 1, 2, 3, and 4, we have the revenues. Okay. And your inflation rate. So which will help you to calculate your nominal revenues. Okay. Similarly, we have the cost. We also have the inflation rate, and this will help you to calculate what is going to be the nominal cost. Okay. And then, we can give the impact of the depreciation element to it. So what are your revenues? So your revenue is, as you can see, 30,000 every year. Okay. So this is 30,000. Okay. Every year. And your inflation rate is 10%. So that's why this will now become 1.1. Then this will now become 1.1 square, so 1.21. Then this will become 1.331. This will now become 1.4641. This will help you to calculate your nominal cash inflows. Okay. So that will be 33,000. Okay. Then 30,000 into 1.21. So that will give you 36,300. 30,000 into 1.3331. So that will give you 39,930. And then 30,000 into 1.4641. So that will give you 43,923. Okay. So these are my nominal cash inflows, that is including the impact of inflation in the economy. Okay. So what is now going to be my cost? So your cost is nothing but 10,000. Okay. And the same inflation rate. So this will now give me 11,000. This will give me 12,100. So this will now give me 13,310. And this will now give me 10,000 into 1.4641. That is nothing but 14,641. And then to calculate your NPBDT, okay, so I can now simply take this nominal revenue, from which I can subtract the nominal cost. So 33 minus 11,000. Of course, you can do it in the other way as well. That is, we can simply take 30,000 minus 10,000. That is directly your net cost, and then give the impact of the inflation as well. Or else, after considering depreciation, tax savings, even after that, you can take it into consideration. But this is how I have taught you in the previous, in the basics, that we can take the inflationary aspect. And this method will be helpful where there are two inflation rates available for revenues as well as for your cost. Okay. So now this will be 22,000 and 36,300 minus 12,100. So that will give you 24,200. 39,930, from which I will subtract 13,310. So that will now give me 26,620. Okay. And then from 43,923, if I subtract 14,641, so this will ultimately give you 29,282. Now this is going to be your net profit before depreciation and tax. So as you can see that whatever is your NPBDT, okay, from this, if I subtract my depreciation, what do I get is my NPBT, right? So how did I get my net profit before depreciation and tax? So I took whatever was my nominal revenue, that is after considering whatever was my inflation impact. From this, I subtracted whatever is my nominal cost. So then I got my net profit before depreciation and tax, from which I subtract the depreciation. I got the net profit before tax. Okay. And my depreciation, as you all know, should always be calculated by taking, as in this particular illustration, it is original cost minus your scrap, which is 0, divide that by life. So it's going to be consistent 10,000, and NPBT minus tax, NPAT, add depreciation and cash inflows. So ideally, for the period of year 1, 2, 3, and 4, your nominal cash flows, which is after adjusting inflation, should be as 16,000, 17,100, 18,310, and 19,641, which I need to discount it at the nominal discounting factor. And your nominal discounting factor means something which includes the inflation, and that is nothing but your 12% rate. So if I discount it at 12% rate, I'll be getting my present value of cash inflows. Okay. So this is fine. We can do it in this particular way. But also at the same time, if we check the ICI solution here, there is slight little bit of discrepancy in the solution. As you can see that they have considered your real cash flows as 15,000 every year same. Okay. So how did they calculate this real cash flows 15,000? They have considered whatever is your revenue, which is 30,000. From this, you subtract the cost, that is 15,000, 10,000, sorry. So then you got your NPBDT, which was nothing but 20,000. Okay. From this, if I subtract the depreciation, which is 10,000, I got the NPAT of 10,000. Your net profit before tax of 10,000. Then on this, the tax rate is 50%, so that is 5,000. So my NPAT is 5. To which if I add the depreciation, which is 10,000, so I'll get my cash inflows of 15,000. So ultimately, this is the same format which we follow, that is sales minus cost, your NPBDT, from which if I subtract the depreciation, NPBT, minus my tax, what I get is my NPAT, add the amount of the depreciation to get the cash inflows. So the cash inflows here are 15,000, which is nothing but my real cash inflows, which is 15,000 rupees. But the problem here is that if I consider this 15,000 as the base, and if I add the inflation to it, I'll be getting 16,500. But my year one cash inflows, including the inflation, is coming as 16,000. So are you seeing that there is some difference in the nominal cash inflows, which I have calculated right now, as compared to what is given by the ICI? Now, this particular discrepancy is because in ICI solution for this illustration 1, they have considered inflation even on depreciation. Okay. So when I'm considering this 15,000 as the cash inflow and then adding inflation to it, so I'll be getting 16,500. And in this 15,000, you all can see that 5,000 is my NPAT. And this 5,000 NPAT has come after subtracting this 10,000 depreciation. So here the depreciation is actually considered as the part of the cost on the basis of which the inflation is incorporated, which is slightly erroneous. Why? Because we never consider inflation on the concept of depreciation, which ICI specifies here itself, and it specifies that the tax benefit accruing from depreciation does not keep parity with the inflation. Okay. And your revenue minus cost, okay, into 1 minus tax tends to move in line with the inflation, as inflation influences revenue as well as cost. But the tax savings on depreciation does not depend on inflation, as depreciation charges are based on historical cost. So basically, depreciation is not going to have any impact due to the inflation element on it. Okay. So this is what they have done even in the example. The example is something what we have done exactly in that particular format. But in this illustration one, they have considered the cash inflow as 15,000, which is after considering the impact of the inflation even on depreciation. Okay. So this is just something that they have done for illustration one. Again, in the second illustration, they have done it exactly the way we have actually done it right now. That is, depreciation should not be having any impact, on the inflationary trends. So just going by the explanation of what I say have done. So in my opinion as well, we should calculate it, the depreciation separately. We should not give the impact of the inflation on the same. Okay. And impact at depreciation cap, because what will happen is that in some questions, if you consider depreciation uh, as the part of the cost and add the inflation to it, and in some questions if you don't consider the depreciation element as the part of the cost, which is actually the way it should be. Okay. Because it's a historical cost, and inflation should not be having any impact on the depreciation. So then you'll be having two separate solutions. So let us maintain consistency by solving it the way ICI has mentioned in the theory and the example, and also the other questions, except for this particular illustration, where inflation will not be having any impact on the depreciation element. Okay, clear? So ultimately, what will happen is we have just given the inflation impact to the revenue and to the cost, and then we got the NPBT. We subtracted depreciation as the historical cost, NPBT minus tax and PAT depreciation, we got the cash flows. Okay. So now let us discount this cash flows at the nominal discounting factor, which should be including the inflation premium. And yes, 12% is including the inflation premium. So this is now going to be 0.8929. Okay. This will be 13,632. And this will now be 12,905. This is coming as 12,482. So this is coming as 53,305. So this is your PV of CI, from which if I subtract my PV of CO, what do I ultimately get is my NPV. So this is 53,305 minus 40,000. So this will now give you 13,300 13,305. Okay. So this is now my PV of CO was 40,000, right? Yes, it was 40,000. So this will slightly differ from the solution what is given to you. Okay. Why? Because they have considered the inflationary trends even on the depreciation element, which we should not take that into consideration. So we'll maintain consistency in our solutions, and that's how we will get this NPV. Also, this particular concept can be solved in the alternative method as well. And what is your alternative 2? So in your alternative 2, we have to take into consideration real cash flows and discounted at your real discounting factor. So that is one of the way to calculate your NPV. So that is the other alternative. Okay, so to take real cash flows and discount it at real discounting factor. But in my opinion, that whenever the cost of capital is given to you, that is including the inflation part, then we should always, that's a nominal discounting factor. So we should always convert your real cash flows to your nominal discounting factor, your nominal cash flows, and then take that nominal cash flows, discount it at nominal discounting factor to get the final present value. Okay. So rather than converting the nominal discounting factor to your real discounting factor and then using that to discount it for the real cash flows, I would prefer that you maintain the consistency of converting the nominal cash flows, by considering whatever is going to be your, nominal revenue and after including the inflation element in it. And then you can calculate the present value the way what we have done it here in this particular illustration. Okay. Now, the point which I was trying to make here is actually in this illustration too. See, XYZ requires 8 lakh for a particular unit. So this is nothing but your PV of CO, correct? And then useful life of the project is 4 years, your salvage is 0, depreciation charge is 2 lakhs. And the expected revenue and cost, which is excluding the depreciation, ignoring inflation. So can I say these are your real cash flows? Okay, matlab real revenues and real cost. Exactly the data what you get from your sales department. The tax rate is 60% and the cost of capital is 10%, including the inflation premium. Wow. So can I say this is your nominal discounting factor, which is based on your practical parallels. You know that whenever we will be calculating the cost of capital, that will always be after taking into consideration the inflation part. So you are required to calculate the NPV, and as you can see that there are two different inflations which is given to you for revenue as well as for your cost. So now this will actually help you to understand that why I was doing two separate calculations, because there are two different rates which are available. Okay. So see, the first step is always what? That whatever is the revenue, okay, we will add the inflation to it and then we'll be getting the nominal revenue, right? But here you have to be very careful that the inflation rates every year are not the same. So to give the compounding effect, we have to take, if I'm taking year two inflation rate, then if I'm calculating year two nominal cash inflows, then I have to take into consideration whatever is the inflation rate for year two as well as whatever is going to be my inflation rate for year one. Okay, something like this. See, uh, you have your revenues available, right? See, this is your illustration two. Year 1 to 4. Guys, try to practice this along with me because, you know, only when you write and when you practice, you'll understand that how we have to, incorporate these various changes, what should be the flow of the question, okay? And the consistency will also be maintained. So we have the revenues and we have the inflation rate for revenue as well, which will help you to calculate your nominal revenues, okay? So it's 6, 7, 8, 8, 6, 7, 8, and 8. Okay. And what's your inflation rate? So your inflation rate is going to be different. It's 10% for first year. So this will be 1.1. Now see, for the second year, as you can see that the inflation rate is 9%. So basically, this is just the inflation rate for the second year. Okay. So if I am standing at year 0 and if I know that my year 1, you know, rate is 10% and my year 2 rate is 9%. So I actually know that my revenue at the end of the year 2 will be year 1 rate multiplied by year 2 rate. Okay. So this is going to be 1.1 into 1.09. So ideally we used to take 10% square. Okay. But that was only possible when the rates were constant. Then this is now going to be 1.1 into 1.09 into 1.08, and the last one will be 1.1 into 1.09 into 1.08, and I'll multiply this by 1.07. Okay. So this will now help me to calculate what is going to be my revenue. Okay. So my revenues are now going to be, of course, this will be 6 lakh 60. So that will be 8 lakh 39,300. This will be 10 lakh 35,936. And this will be 11 lakh 8,451 or 52. Okay. Now, these are my nominal revenues, that is after giving impact of the inflation. Now, similarly, you all can calculate on your own for year 1, year 2, year 3, year 4, what is going to be the cost and its inflation rate, which is actually different. So that will give you your nominal cost, right? So you all can now just try to calculate this on your own. So basically, your nominal cost will be 3,36,492,800, 537, 172, and 580, 124. So now what will happen is that you can calculate what is going to be your net profit before depreciation and tax, right? So NPVDT. So that will now be whatever is your nominal revenue. From this, you will subtract your nominal cost. Okay. And see, nowhere we are taking into consideration the impact of inflation in it. So 6 lakh 16 minus 3 lakh 36,000. So that is now going to be 3 lakh 24,000. Then 8 lakh 39 300, from which I will subtract 4 lakh 92 800. So that is now going to be 3 lakh 46 500. Also 10 lakh 35,936, from which I will subtract 5 lakh 37 172. So that will be 4 lakh 98 764. And then 11 lakh 8,452, from which I will subtract 5 lakh 80 124. So that will give me 5 lakh 28,328. Okay. So these are going to be my net profits before depreciation and tax. Okay. And then what can I do is, okay, so 3 lakh 46, 498, and 5 lakh 28. Okay. Now from this, I can subtract my depreciation, get my NPBT. So this is the point I wanted to make, that we will take into consideration the depreciation on historical cost without giving any impact on the inflation to it. To this impact, if I add the amount of the depreciation, I ultimately get my cash inflows. I will then discount it at whatever is my NDF, normal discounting factor, to get the PV of CI. Okay. Now, as you all can see that the depreciation rate is here it is 8 lakh rupees without any salvage value, and the life is 4 years. So depreciation is going to be 2 lakhs. So this depreciation will be 2 lakh every year. So we'll be now having your NPBT. So see, this is a very orthodox and a very traditional method to solve this. Okay, or else you can take NPBT and then subtract tax and then just add the tax savings on depreciation to it as well to get the final answer of cash inflows. But students are generally familiar with this particular part, that from NPBT we subtract depreciation, get NPBT. That's why I'm just solving it, in a very basic way. So this will now be 1 lakh 46 500. This will now be 2 lakh 98 764. This will now be 3 lakh 28 328. And then what's the tax rate which is given to you? It's 60%. Okay. So I'll simply calculate what is going to be my NPAT. 1 lakh 24 minus 60%. So that will be 49,600. 146,500 minus 60%. So that's going to be 58,600. 2,98,000. 2,98,764 minus 60%. So that will give you 119,506. 3,28,328 minus 60%. So that will be 1,31,331, to which I'll add the depreciation of again 2 lakhs every year to get my cash inflows. So this will now be 2,49,600, 2,58,600. Okay. Then this will now be 3,19,506, 3,31,331, which now I have to discount it at my nominal discounting factor. So what's my nominal discounting factor? Cost of capital is nothing but 10%. So that includes your premium part as well. So we will now simply get, there is no DF EV factors which are given to you. So 1 divided by 1.1 into 2,49,600. So this gives me 2,26,909. This, if I multiply it by 258,600, this will now give me 2,13,719. Okay. And this, if I multiply it by third year PV factor, this will give me 2,40,050. And this will give me 2,26,304. So ultimately, this is coming as 9,06,981. Let me check here. So this will be same 9,06,738. This is 9,06,981. So PV of CI minus PV of CO will ultimately give me my NPV. So what I've done here is I've just used the same methodology which I've done in the illustration 1. The first thing and the second thing, nothing has changed. But then we have to do it accurately, precisely, where depreciation is a part of the historical cost and the impact of inflation should not be taken into consideration on the same. Okay. So this will now be 906,981. And if I subtract 8 lakhs from it, so ultimately this will now be 1,06,981. And your NPV is positive, and that's why we are going to accept it. Okay. So these are the two illustrations which were pertaining to what is going to be the impact of your inflation in your capital budgeting decisions. And for technology and also for the government, scenarios changes. So we have other methods like scenario sensitivity and what is going to be the impact of then cost of capital on the NPV of the project and stuff like that. Okay. But let us now solve some questions from the practical problems dealing with your this particular real and your nominal cash flows. Okay, so let's do that first. Okay, now see, this is your illustration 17. See what is given to you, that a firm has projected the following cash flows from a project under evaluation. So they have already given to you your cash inflows, where year 0 it is 70 lakhs. So that's nothing but whatever we are making the investments today. Year 1, 2, 3, we have the cash inflows available as 30, 40 and 30. And the above cash flows have been made at the expected prices after recognizing the inflation. Okay. So these are my cash inflows. But in these cash inflows, already inflation is a part of it. Okay. So already can I say that these are your nominal cash flows? Yes, sir. Okay. After recognizing inflation. And the firm's cost of capital is 10%. The expected annual rate of inflation is 5%. Show the viability of the project which is to be evaluated. Now, again, the firm's cost of capital is 10%, but they have not mentioned that it is including the inflation premium or not. Okay. Now, ideally, what happens is that the cost of capital should be including the inflation element. Okay. So everywhere we always assume that the cost of capital is including the inflation. because that's how the cost of capital is calculated. Okay. But in this particular question, it is not specified that this is including your inflation premium. Okay. So institute has solved this particular question by assuming that this particular 10% rate is your real rate. So it's a real discounting factor. So it does not have any impact on the inflation premium is not taken into consideration at all. So for advanced capital budgeting decisions, then, you can always assume like this, that if they have given to you cost of capital, but if they have not specified that this is including the inflation premium, then we can assume that as the real discounting factor and do that accordingly. Okay. But whatever assumption you make, please write down a note for the same, because these are the different types of the errors what ICI makes while making the question or by preparing solution. So just like as you just saw that in illustration 1 and 2, the concept was the same, and just the format we had maintained the same, and we got the same answer as well, in the second illustration. So sometimes, there are these kind of discrepancies which you will observe. So coming back, what should be done to the examination? Okay. So as I told you, what we have done in illustration 1 and 2, we have to be very consistent on depreciation. Inflation should not be having any impact, and it should be solved the way what we have done it. And here in this question number 17, you can assume it like this, that this is the cost of capital, including inflation, and assume that as your NDF, okay, and solve it accordingly. Or else you can assume that since no information is available to you, there is no inflation rate, there is no cost of capital including inflation mentioned specified. So we'll assume that as real discounting factor. Okay. So in examination, if they don't specify that this is including your inflation, we will assume it, okay, that this is your real discounting factor, and we can do that accordingly. So I'll start this particular solution with this note only. So the note will be note, since it is not specified that cost of capital is including inflation, rate, we assume the same as a real discounting factor. Okay. So in my view, unfortunately, we have to remember it like this, that it's a real discounting factor, and solve it so that your solution matches with your ICI solution as well. Okay. So uh, in practical life, obviously, you will not face this problem. And the cost of capital, as I told you, that these are always including the inflation premiums. Okay. So there is nothing you have to worry about it. But here, if since it is not specified, okay, that cost of capital is including the inflation rate, we assume the same as your real discounting factor. Okay. So of course, all your calculations will be based on this. So since the cash inflows are readily given to you, so there is nothing we have to worry. These are nominal cash flows. So uh, the easiest way to do is that we will convert the real discounting factor to your nominal discounting factor. And then we have the nominal cash flows, we have the nominal discounting factor, we can convert it, and then we can bring it to the present value terms. Right? So this is the most basic and the easiest way to solve this particular question. So you all can, write down like this, convert a real discounting factor to nominal discounting factor. Okay, so this is your approach 1. Okay, so we'll do this by both the ways. Okay, so how do you do that? So 1 plus nominal discounting factor is 1 plus whatever is a real discounting factor into 1 plus whatever is your inflation rate. So in this particular case, uh, 1 plus real discounting factor, so that's nothing but 10%. So we have assumed that this is 10% without considering the inflation element. Okay. The same is real discounting factor. So that is without inflation. And then to this, I'll add the inflation rate, which is 5%. So this will now give me 1.155 is 1 plus your nominal discounting factor, and your nominal discounting factor will now be 0.155 or 15.5%. Okay, so this is nothing but your nominal discounting factor. Now, once I have the nominal cash flows and if I have the nominal discounting factor, can I calculate the present value? Of course, yes. So what can I do here is here 1, 2, 3, 4. I have my nominal cash flows. Okay. And okay, there are only 3 years, sorry. So this is 3 years. See, they have specified here that these are the cash flows after recognizing inflation. They should have also specified here that the cost of capital is including the inflation. Okay. But unfortunately, they have missed on this part. So we are assuming that as to be real. And that's how even ICS solved it. Okay. So this is 30, 40, and 30. 30, 40, and 30. Okay. And we will discount it at 15.5% to actually get my present value. Okay. Of your CI. So this will now be 75.43. Okay. Yeah. And from this PV of CI, I will need to subtract my PV of CO to ultimately get the NPV. So that's 75.43. And what was my PV of CO? It was 70. So this will eventually give me 5.43. That's your NPV. Okay. And now you all can also check this out. Also at the same time, the alternative two approach. What's the second approach? Okay. So your alternative two will be, what are we now going to do? We have now whatever is going to be your cash flows. Okay. Now let us convert these nominal cash flows to the real cash flows. Okay. So what we'll do is nominal cash flows will convert it to real cash flows. And then we'll discount it at the real rate. Okay. So year 1, 2, 3, we have the nominal cash flows as 30, 40, and 30, 30, 40, and 30. And then whatever is your inflation rate. So inflation rate is nothing but uh, cost of capital is 10%. So 1 divided by 1.1. Oh, sorry, it's 5%. So this will now be 1 divided by 1.05. Okay. So here it will be 1 divided by 1.05. So that's 0.9524. And as we have discussed that it's a compounding effect. So then this, while doing discounting also for the second year, this will be 0.9070 and this will now be 0.8638. Okay. So this will now give me the real cash flows. Okay. Then this will be 36.28 and then This is 25.91. So these are all your real cash flows, and now I need to discount it at the real rate, which is nothing but uh, how much percent? This will be 5%. Okay, so 10%. So this will now help me to calculate my present value. Okay, and this will now be 1 divided by 1.1 multiplied by 36.28, 1 divided by 1.1 multiplied by 25.91. So this is also coming as 75.42. Okay. So in both the cases, can I say my NPV will be the same? That will be my PV of CI minus my PV of CO. So that is 75.42 or 43 minus 70. So that is 5.43. Okay. So your NPV is going to be the same under both the methods, whether you take into consideration nominal or whether you take into consideration your real cash flows. So the only thing here is the interpretation part. And I hope that ICI becomes very clear in the way they are asking you a question, because they can't make a question complex by not specifying the information, right? Because it's then the matter of assumptions. So that is something which they should not do it. But if they give you the clarity about, that whether this particular discounting factor is including inflation or not, then it will really help you to solve it. Okay. So with this, now your question number 17 is completed. Now let's talk about question number 18. Okay, so this 17, 18, 19, these three questions are regarding your, these are regarding your real and your discounting factors. So real and nominal cash flows. So you all can just write down NCF and RCF. Okay, nominal cash flows and real cash flows. Even 18th is your nominal cash flows and your real cash flows. And 19th is also your nominal cash flows and your real cash flows. Okay. देखते हैं अभी question number 18, see what is given to you. Shashi and company has projected the following cash flows from a project under evaluation. Year 0, 1, 2, 3, we have year 0 cash outflow, which is available as 72 lakhs. Year 1, 2, 3, these are your cash inflows. And the above cash flows have been made at the expected prices after recognizing inflation. Okay, very nice. So we have these uh, cash inflows, which is after considering whatever is the inflation. The firm's cost of capital is 10% and the expected annual rate of inflation is 5%. So show how the viability of the project is going to be, and the PV factors are also given to you. Okay. Now, in this particular question as well, okay, uh, we can convert these particular cash flows, to the real cash flows. And then what we can do is we can discount it at the real rate. Okay. So that is one of the way where we can do this. So what is given to you in this particular question? Okay, so what we will do is first let us understand that these are your nominal cash flows and the rate which is given to you is 10%. Now see, they have still not mentioned that this 10% is actually your real discounting rate, yeah, nominal discounting factor. So again, they have not specified that this is including the inflation premium or something like that. So we will assume that to be as your real rate, and based on that, we will add the inflation aspect to it. So for nominal cash flows, we want nominal discounting factor. So I'll just solve this, in a very summarized way, very fast, and only under one alternative. So your alternative one will be what? From nominal cash flows, we will keep it nominal only. Okay, but here the real discounting factor, we will convert it into the nominal discounting factor. Okay, so what's your real discounting factor? 1 plus 0.10. Okay, and your nominal discounting factor is something which we have to find out. So your nominal discounting factor 1 plus will be nothing but 1 plus whatever is your real discounting factor, to which you will add the inflation element to it. Okay, so I'm just repeating the same note here as well. Since no data is given to you, then this cost of capital is to be treated as your real discounting factor. So what will be your 1 plus nominal discounting factor? We will take 1 plus 0.1, and the inflation is, I think, the same, which is 5%. Okay, so this will eventually give me 15.5%. The same thing. Okay, now do I have the nominal discounting factor available? Come on, yes or no? Yes, that is 15.5%. So what I need to do here is that I have uh, all my cash flows available. So these are anyway or nominal cash flows. So here 1, 2, 3. Okay. And these are already adjusted with the inflation. So your nominal cash flows are 30, 40, and 30. Okay. And then I will discount it at the nominal discounting factor, that is 15.5%, to get my present value. So this will now be 75.43. Okay. Which is the same thing. Okay. And your cash outflow here is, I think, 72. Okay. So that's the only variation in this question. So that will be 3.43. So is your NPV positive? Yes, sir. So we should accept this particular project. Okay. And then we have this question number 19, which says that, okay. So now see, in this question number 19, what have they specified? That KLM requires rupees 15 lakhs for a new project, and the useful life of the project is 3 years. The depreciation is 5 lakhs, and given below are the projected revenue and cost excluding the depreciation, ignoring inflation. So we have the revenues, we have the cost also available with us. Okay, and applicable tax rate is 35%, and assume the cost of capital as 14%, which is after tax, and the inflation rates are given to you as 9%, 10%, etc. And we are required to show the amount to the nearest rupee, and we are required to calculate the NPV. So, sir, now in this particular case, now this cost of capital we will treat it as a nominal discounting factor. Why? Because see, there are two inflationary rates which are given to you. Okay, so in this particular case, obviously the cost of capital which they will provide to you will be including the inflation only, because they might have calculated the average inflation and done it accordingly. Because in this particular question, it will not be possible for you to actually convert this particular nominal discounting factor to a real discounting factor, because then the question will arise, then what should be the inflation rate for the same. Okay, so that is why here we have to calculate such kind of a question by only one alternative, which even IC has done. Okay, they have just converted this only by only one alternative, and that is they have converted this nominal cash flows. Okay, they have converted this real cash flows into nominal cash flows, and then these nominal cash inflows are now discounted at what percentage rate? 14% rate. Okay, and that's how you'll be getting whatever is going to be the present value, and it is to be done accordingly. Okay, so for this particular question, okay, you have to understand it that the revenues which are available, the cost which are available, both of them are your real cash flows. Then we have the inflation rates for revenue as well as cost. So basically, we have to calculate the nominal cash flows for which we require a nominal discounting factor. So that's 14%. Okay. So if you are thinking, okay, sir, let this be real, let us convert this nominal to real. So that's not possible. Why? Because of different inflation rates which are given to you. So this is your nominal discounting factor. That is after considering the impact of your inflation in this part. Okay. So for question number 19, it makes sense that when ICA does not provide to you that this particular rate is including the inflation, so it's okay, no problem. Why? Because there are multiple inflation rates for different years and for different parameters. So the rate which will be available, that is your nominal discounting factor. So no problem regarding the same. So now, how will we approach this particular question? So very similar to what we have done, you all can practice this. Uh, the cash outflow is 15 lakhs. Life is 3 years, depreciation is 5 lakhs. And then for year 1, 2, and 3. So we will keep our methodology same. Year 1, 2, and 3, we have revenue, which we will adjust with the inflation rate. So ultimately, we'll be getting the nominal revenues. Then we will be having the cost, which will adjust with the inflation rate. So we'll be having the nominal cost, right? Then I can write down here NPBDT, right? And from this, then we will subtract the tax. So we'll be getting the, if you want to do it, subtract tax NPAT and then add the tax savings on depreciation. That is also what something we can do it. And if you want, then you can do it like this as well. You'll be subtracting the depreciation. Then you'll be getting net profit before tax. Then to this, you will subtract the tax rate. You will be getting the net profits after tax. Add the amount of the depreciation to ultimately get my cash inflows. Okay. Now, what are your revenues? It is 10, 13, and 14. So it's 10 lakh, 13 lakh, and 14 lakhs. Okay. And your inflation rate is 9%, 8%, and 6%. So 1.09, then 1.09 into 1.08, if I'm not wrong. Yes. And this is 6%. So 1.09 into 1.08 into 1.06. Correct? And for cost, I have 10, 9, and 7. So 1.1, 1.1 into 1.09. And the last one is 7. 1.1 into 1.09 into 1.07. Okay, so this will now give me my nominal cost, which will help me to calculate your NPVDT, subtract your depreciation, get your NPVT, subtract your tax, NPAT and depreciation. That will give you the cash inflows. Okay. So now this is going to be 10 lakh into 1.09. So this is now going to be 10 lakh and 90,000. Also 13 lakhs into 1.09 into 1.08. So this will give you 15 lakh 30,360. 14 lakh into 1.09 into 1.08 into 1.06. So this will now be 17 lakh 46,965. Okay. Same is now applicable to the cost. We have the cost as 5, 6, and 6 lakh 50. 5 lakh, 6 lakh, and 6 lakh 50. Okay. So this will let me to calculate what is going to be my nominal cost, where the rate is okay available to us. So 5 lakh into 1.1. So this will be 5 lakh 50. 6 lakh into 1.1 into 1.09. So this will be 7 lakh 19,400. 6 lakh 50 into 1.1 into 1.09 into 1.07. So that will be 8 lakh 33,905. So guys, this will help us to now calculate what is going to be your NPVDT, net profit before depreciation and tax. So that's going to be 10 lakh 90 minus 5 lakh 50. That will give you 540. then 15 lakh 3360 minus 719,400. So that will actually give you 8 lakh 10,960. 1746,965, from which I will subtract uh 6 8 lakh 33,905. So that is coming as 9 lakh 13,060. Okay, fine. 548,10 and 913,060. Great. Now let us subtract the element of your depreciation. So what is now going to be your depreciation? So for your depreciation, this is given to you as 5 lakh rupees per annum. So that's nice. 5 every year. So this will now give me my NPBT, which is 40. Then 3 lakh 10,960. And this will now be 4 lakh 13,060. Right? Now, what is going to be the tax rate? So the tax is 35%. So we can directly calculate your NPAT. Okay, so that's 40,000 minus 35%. That's 26,000 for you. Then 310,960. If I subtract 35%, so that is 2 lakh to 124. 413,060 minus 35%. That gives you 268,489. To this, I will now add the amount of depreciation, which is 5 lakhs, 5 lakhs, and 5 lakhs. So this will now be 5 lakh 26,000, 7 lakh to 124, and 7 lakh 68,489. Okay, so these are your cash inflows. So what do I have to do with the same? I have to anyway discount it at my rate, which is nothing but 14%. So I need to discount this at 14% to get my PV of CI. Correct? So this will now give me my PV of CI. 768, 489. So my PV of CI total will be coming as 1519,965. 1519,965. This is my PV of CI. So of course, what's going to be my NPV? So from this, if I subtract my cash outflow, that is 15 lakh 19,965, from if I subtract the cash outflow, which was nothing but 15 lakhs. So can I say ultimately I'll be getting the NPV of 5,19,965. Okay. So this is your final answer. Sorry, uh, this is 19,965. So this is my final answer. NPV is positive, then definitely what are we going to do? We are going to accept it. Okay. So I hope that the concept of your real and your nominal cash flows are now absolutely clear. Okay. Everything regarding real and nominal cash flows, the impact of the depreciation on it, and everything, we have done it very thoroughly. So I hope you all have understood this much. Okay. Now, after this, we'll be starting with something, uh, regarding how are we going to adjust the risk element. Okay. So as we have discussed that there are certain types of risk and there are certain types of uncertainties which are there. So we have to adjust those risk elements and incorporate that risk while evaluating your capital budgeting decisions. Okay. So basically, whenever we are going to adjust the risk aspect, then these are the three important aspects which you have to understand. Okay, so there is something which is called as statistical techniques, conventional techniques, and other techniques. Okay, so regarding statistical techniques, we can take probability, variations, or standard deviations for the purpose of calculation, coefficient of variation. So these are all statistical techniques to incorporate risk in a particular project. Conventional orthodox methods are your risk adjusted discounting factor, certainty equivalent factor, and then, so these are the two types of your conventional techniques. So these are the three types of statistical techniques. And then these are other methods which deals with your sensitivity, scenarios, simulation, and decision tree. So in all total, 3 plus 2, 5 plus 4, we have 9 techniques. We have total 9 techniques to incorporate risk in the capital budgeting decisions. Okay. So first we will start with some very basic methods, and that's nothing but your risk adjusted discounting rate. Okay. So we're going to start with that. Okay. So risk adjusted discounting factor. So apparently what happens is that whenever you see that there is some risk in a particular project, what do we do? That we have to discount it at a much higher rate. Okay. So this risk can be, taken into consideration with the help of coefficient of variation or standard deviation. So whenever you think that a particular project has a higher element of risk, what should we do? We should adjust your discounting factor. And that is, we should add the risk premium to your normal discounting factor in such a way that it becomes your risk adjusted discounting factor. Because the whole point is what? The project in which the risk element is higher, if we discount it at a higher rate as compared to the project which has lower level of risk, and still if the net present value is coming positive, then we can make investment in such kind of the projects. Why? Because it has a higher NPV, though we have incorporated risk in the particular project. Okay. So a risk adjusted discounting factor is the sum of the risk free rate as well as your risk premium. Okay. The risk premium depends on the perception of risk by the investor of a particular investment. Okay. And the risk aversion of the particular investor. So we just have to focus on what is the risk premium. We have to add it. And then apparently we'll be getting the risk adjusted discounting factor, which we have to discount it and bring it to the present value terms. Okay. So in this illustration 7, you all can see that there is an enterprise who is investing how much? 100 lakh in a particular project. So this is your cash outflow. The risk-free rate is 7%. So that's your RF, and the risk premium expected by the management is 7%. So obviously the discounting factor here is going to be 7% plus 7%. That's going to be 14%. The project has a life of 5 years, and these are the cash flows. So we have to discount and bring it to the present value terms. So if we are discounting on the basis of the risk-free rate, then the discounting factor is 7%, and on the basis of the risk-adjusted discounting factor, we'll be discounting the same at 14%. Okay. So this is how we'll be getting the NPVs. Now let us do a couple of questions regarding the same. Okay. Okay. Now see, you all can just check in this particular question. Determine the risk adjusted net present value of the following projects. So we have the net cash outflow, which is 2 lakh 10, 1 lakh 10, 20, and 1 lakh 10. We have project life, we have annual cash inflows, and then we have coefficient of variation. Now see, coefficient of variation is one of the way to measure the risk, because we always say that if the risk element is higher, then can I say that when the coefficient is higher, the risk element is higher? Because it is variation means what? That it is moving from its average, and the more it moves from its average, we can always say that the project has a higher element of risk involved. Okay. So coefficient of variation should, if it is higher, then it indicates that the risk element is also higher. So then accordingly, we have to adjust the discounting factor. Okay. So we have the net cash outflows, we have the project life, we have the annual cash inflows, and then we have the coefficient of variation. The company selects the risk adjusted discount rate on the basis of coefficient of variation. So we have the coefficient of variations available, which is 0, 0.4, 0.8, 1.2, 1.62, and more than 2. Then we also have the risk adjusted discounting factor, and then we have the annuity factors available. Why is it helpful? Is because the cash inflows are constant. Okay. So now what we have to do is we have to evaluate that which project is the best. So very basic and an easy question. So when we are discussing that calculation of NPV, okay, based on risk adjusted NPV. Okay, so what are we going to do? Okay, so see, we have three projects X, Y, and Z. Okay, so we have three projects X, Y, and Z, and we have their coefficient of variation. So what is the coefficient of variation for X? It is 1.2. Now, of course, for 1.2, what should be the risk adjusted discounting factor which we should take? So as you can see that 1.2, for that we can take the risk adjusted discounting factor of 16%. Okay, all right. And then for Y, we have this as 0.8. So for 0.8, we need to take into consideration 14%. Okay. And for your Z, we have this as 0.4. So for that, we need to take the risk adjusted discounting factor as 12%. Okay. And obviously, we also have the PVAF as well available. So whatever is the cash inflow per annum, we will multiply that by the present value annuity factor. We will be getting PV of CI, from which I will subtract my PV of CO to ultimately get what's my NPV. So what's your cash inflow per annum? So that's 70, 40, and 32, 70,000. Then we have 42,000, and then we have 30,000. And also, what's your annuity factor? So we have the annuity factor of 16% as 3.274. Then we have it as 3.433. And then we have it as 3.605. Okay. So we'll be having our PV of CIs. So that is 2,29,180. And what's your PV of CO? It is 2,10,000. So this will now give me 19,180. Okay. Similarly, 42,000, if I multiply that by 3.433, so that is 1,44,186, from which I will subtract my PV of CO, that is 1,20,000. So if I subtract 1,20,000, this will be 24,186, and then this will now be 30,000, which I will multiply by 3.605. So that is 1,08,150, from which my PV of CO is now 1 lakh. So this will now be 8,150. And you all can see that we can select your project Y because its NPV is maximum. So this is how, on the basis of coefficient of variation, we will understand that what is going to be the discounting factor. And once we have got the discounting factor, then what we have to do is we will have the PVAF, we'll multiply that, we'll be getting PV of CI and stuff like that. Okay. So continuing further now, let us come to your question number 16. See, here also the same concept is applicable. New projects is evaluating three project P1, P2, P3, and the information is given to you. We have the cost, which is your cash outflow. We have here 1, 2, 3, 4, whatever is the cash inflow. We have the risk index, and risk index for the particular project can also be called as your project beta. And we have the minimum required rate of return for the firm, which is 15%, and the applicable income tax rate is 40%. The risk-free interest rate is 10%. So first thing is we are required to calculate what should be the risk-adjusted discounting factor. And then we have to see that which project is the best. Okay. So in this particular question, okay, question number 16, we are required to calculate what should be the risk-adjusted discounting factor. Okay. Now to calculate your risk-adjusted discounting factor, the first thing you have to understand is that which model is given to you. So here there is a risk index we have the risk-free rate, and then we have the minimum required rate of return of the firm. See, it is very similar to if you want to invest in a stock and the risk-free rate is 10%, okay, and Nifty is providing you on an average a return of 15%. So your minimum required rate of return from the stock has to be 15%. And the stock has some sensitivity with the market. Okay, so that is nothing but beta. So that can be, twice or 0.5 or 1, and based on that or any other thing, and based on that, you calculate your expectations from that particular project, right? So same thing is applicable here as well. Uh, as we were talking about stocks, here we are talking about the projects. Do we have the risk index available? Yes, sir. Okay. Do we have the risk free rate? Yes, sir. And we also have the RM available. So what are we going to do here is your RADF will now be risk free rate plus RM minus RF into beta. Okay. So now what's your RF? What's your risk free rate? So your risk free rate is 10%. Okay. Your minimum required rate of return is 15%. And now can I say that for different projects, okay, we are having different betas available. So for your project A, B, and C, okay, we are having the betas of 1.8, 1, and 0.6. So definitely this will now help me to calculate what is going to be my discounting factor. Okay. So this is now going to be 19%. Of course, this will be 15%, and this will now be 13%. Okay. Now what I need to do is I have to now consider this 3 as the discounting factor. Then I have to discount it and bring it to the present value terms. So do I have the cash flows available? Yes, sir. So now you can very well solve this very easily. Okay. And practice this in such a way that NPV can be calculated. Why? Because we already have the 3 discounting factors readily available. Okay. So I'll be putting the answers now. Okay. So just presenting the solution, you have your risk adjusted discounting factor as 19, 15, and 13, and based on that your project A is coming as 83,151, your project B is coming as 167,800, and your project C should be coming as 2,13,800. So these are the 3 important NPVs, and we will select project C. Why? Because its NPV is maximum. Okay. So with this, now we complete these 2 questions about your risk adjusted discounting factor, and same. Now, let us discuss something about your certainty equivalent factor. Okay. Now, see, apparently, uh, in your certainty equivalent factor, we have to understand that there are certain cash inflows which you are going to earn for sure. Those are your risk-free cash flows. So basically, there are 2 main types of cash inflows, like one which are having some element of risk and one which is risk free. These are called as your certain cash inflows. Okay, so understand something like this. Let's say, for example, I want to start with a particular project, and I'm just estimating the cash inflows at the end of year 1, year 2, year 3. And I know that at the end of year 1, when once I'm estimating the cash inflow, which is 10 lakhs, in that I know that 70% I am going to earn for sure. So it's called as my certain cash inflow. Okay. So from 10 lakh, if I multiply that by 0.7 or 70%, so 7 lakh will actually be called as your certain cash inflows. Okay. Now these certain cash inflows you are going to earn for sure, and these are your risk-free cash inflows. So what do we do in certainty equivalent factor is, to just cut a long story into short, we just estimate whatever are the cash inflows and just see that what is the certainty equivalent factor in it. So we will be getting the certain cash inflows, and because they do not bear any kind of risk, then we will discount it at the risk-free rate. Okay. So the basic difference between risk adjusted discounting factor and the CE factor is, in your risk adjusted discounting factor, if the risk in a particular project is higher, we will discount it at a higher rate. All right. But we are not adjust the cash flows. Here, what are we doing is we will discount it at risk free rate. But what we are adjusting is your cash inflows. So we will convert your total cash flows to your certain cash flows. The moment we get the certain cash flows, we will discount it at the risk free rate to get your certain cash inflows. Okay. So just coming to this particular question, the textile manufacturing company is considering one of the two mutually exclusive proposals, Project M and Project N, which require a cash outflow of 8 lakh 50 and 8 lakh 25 respectively. So these two are your cash outflows. The certainty equivalent approach is used in incorporating risk in capital budgeting decisions, and the current yield on government bonds is 6%. So this is a risk-free rate, and this is used as the risk-free rate, which they have also specified. The expected net cash flows and their certainty equivalents are as follows. So we have year 1, year 2, year 3, we have the forecast of the cash, we have the CE factors. So the first step is we have to convert these cash flows from total to your certain cash inflows. And once we get the certain cash flows, we have to discount it at the risk-free rate to eventually get what are your present value of the certain cash flows. Okay. So for Project M and Project N, and usually you'll always have this observation that as and when the years keeps on increasing, year 1, year 2, year 3, your CE factors will be kept on reducing, because you will be very certain about the cash inflows at the end of year 1, but you can't be the same percentage certain, at the end of year 3 as well. So usually this is the observation that the CE factors will be kept on depleting. We have the present value factors at the rate of 6% given to you, and we are required to calculate which project should be accepted. And if the risk adjusted discount method is used, then which project should be appraised with a higher rate and why? So which project should be appraised with higher rate? Of course, the project in which the risk element is higher. Higher the risk element, higher is going to be the discounting factor, right? So which project will be appraised with a higher discounting factor? The project in which the risk element is higher. Now, when can I say that the project has a higher risk element? When the C factor is lower, right? The total of the C, if that is lower, because when the total of the certainty equivalent factor is lower, it means that the risk element is higher. See, the relationship is like this. If the CE is lower, it means the risk is higher. And if the risk is higher, can I say the discounting factor will also be higher? Right? So we will see that which project has the total certainty equivalent factors. We'll sum it up. And then we will check that if suppose the total C factors here is, example, for project M, you all can check, it is here 0.8, 0.7 and 0.5. So that is 2. Okay. So project A has the total C, which is 2. Let's talk about project B, that is 0.9 plus 0.8 plus 0.7. So that's 2.4. All right. So now you can see that project B actually has a higher CE. Okay. Here it is lower CE. Okay. So I think it's project MNN, right? So I'll write down your project M and project N. So can I say that project M total CE factors is lower, project N total CE factor is higher. So here the risk is lower, here the risk is higher. Okay. Where the certainty is more, there the risk will be lower. So which project will be attached with higher discounting factor? Project M, and here the discounting factor will be lower. Got it? So I've just solved the second part here, that is, if the risk adjusted discounting factor is used, then which project will be discounted at a higher rate? Then the answer to this is project M. Okay, this project will be having a higher discounting factor. Okay, now let's start with the first part. So in the first part, we are required to calculate what should be your which project should be accepted. So very easy part. What we will do is project M. We will write down here how many years are there? 3 years, and we have their cash flows, which is 4 lakh 50, 5 and 5. Okay, 4 lakh 50, 5 lakh and 5 lakh. Correct? Now I need to multiply this by the CE factor to get certain cash flows. All right. And once I've got the certain cash flows, I will discount it at the risk-free rate because these are certain. It does not involve any risk, which is 6%. So I'll be getting the present value. Okay. So what are my CE factors? 0. 0.8, 0. 0.7, 0. 0.5. 0.8, 0.8, 0.7 and 0.5. 3 lakh 60, 3 lakh 50, 2 lakh 50. And what is the discounting factor? 0.943, 0.890, 0.840. All right. So this will then give you the PV of CI, which should be coming as uh, 8 lakh 60, 980. Okay. From this, then you will subtract the PV of CO, which is coming as 8 lakh 50. So ultimately, you will be having the NPV of 10,980. That is for your project M. Similarly, the same concept. Now, this is a no-brainer exercise. We just have to calculate the cash flows, multiply that by the CE factor. We'll be getting the certain cash flows. We'll discount it, and eventually we'll be getting this as 1,71,315. So obviously, project N will be selected. Why? Because it has a higher NPV. Okay. And this is how we're going to solve your question number 14 as well. Okay. Great. Fine. So now with this, your conventional methods is now completed. Okay. So we have completed your risk adjusted discounting factor as well as we have completed your certainty equivalent factor. And the most important element, we completed your inflation trends in the economy. Okay. Okay. So students, now let us continue with our next session. Now, see, in this particular case, we have already completed that. While considering the risk analysis part, we have considered your risk adjusted discounting factor and your certainty equivalent factor, right? So in these two methods, we understood that if a project is going to have a higher element of risk, then we will discount that particular project with a higher discounting factor, correct? And a project with your lower element of risk, we are going to discount the same with a lower discounting factor. So that is something which we had understood. Okay. Now we will be starting with our statistical techniques. And there are three types of statistical techniques which we have to understand. One is the probability, second is the variance or standard deviation, and third is coefficient of variation. Okay. Now see, it's a very simple concept that in your capital budgeting decisions, actually what are you doing? That you are estimating the future value of the cash inflows, right? And we are discounting that and we are bringing it to the present value terms. That is something which we are doing, right? So when we are estimating the future value of cash inflows, so no one is certain about it. Okay. And whenever there is uncertainty which is involved, there is definitely some risk. And to avoid that risk, we always attach probabilities to it, right? So whenever we are not sure about something, what do? We attach probabilities to it. So let's say, for example, you come from your AFM examination, and if I ask you how much marks you are going to get, so you can't be 100% sure that I'm going to get exactly this much marks. So you will tell me, okay, sir, I'm going to get, example, 60 marks. Okay. And then you will attach some probability to it. Sir, if suppose the event is, if the paper checking is tough, then I might get 60 marks. And if suppose the paper checking is easy, then I might get 70 marks. Okay. So you will make an estimate based on some events and you will attach the probabilities to it, right? So if suppose you tell me, okay, sir, I might get 60 marks. Okay. If the paper checking is tough, I might get 70 marks. If the paper checking is easy, Then you'll ask me, sir, this attempt, what do you think is the probability that the paper checking will be tough? So I tell you that there is, example, 50% probability that the paper checking will be tough, 50% probability that the paper checking will be easy. Then can I say you are actually expecting on an average how many number of marks? Then can I say you are expecting 65 marks, right? So this is your average expectation from your paper. So probability, acha, it goes without saying that in the actual results, the marks are going to be something else only. Okay. It's not going to be 60, it's not going to be 70. But, many of us have a habit of after coming from the examination hall, we keep on checking, that how much marks we are going to get, etc. So 2 minutes ago, you are the examiner. Now 2 minutes ago, you are the student, appearing the exam, and suddenly you become the examiner, and then you keep giving marks to yourself, right? So basically, we give estimates and we multiply the probabilities to it to calculate some average. Okay. So average, you're expecting how much? 65, correct? So don't you think that the same thing is also possible when it comes to, when we are going to calculate that what is going to be our estimated cash inflows at the end of year one, year two, year three. So to that, we have to attach probabilities because no one can be 100% sure about it. Okay. So let's say, for example, you tell your dad that's, Papa, I want to start with my own business. Okay. So he will be like, okay, so for how many years you want to do the business? So you're like, let's say, for example, that you can estimate it for the period of 3 years. Okay. So these are your, you have estimated okay, for 3 years, so I'm definitely going to do the business and I can make the estimates for the period of 3 years. Then your dad will ask you, okay, chalo, at the end of year one, what is the estimated cash inflows which you are planning to generate? So you will tell, okay, sir, chalo, okay, the estimated cash inflows, let's say, for example, are 2 lakhs. Okay. But are you 100% sure that you are going to generate 2 lakhs? Then the answer is no, beta. Okay. So it depends upon so many situations involved. Okay. So you'll tell, okay, suppose the probability to earn this 2 lakhs is, let's say, for example, 30%. Then there is a possibility that you can earn 1,50,000. The probability of that is, let's say, for example, again 30%. Okay. And then you might earn 1,70,000 also. And the probability of that is, let's say, for example, 40%. Okay. Now, in this particular case, can I say that you have estimated cash inflows for the period of first year based on the three probabilities? Come on, yes or no? Yes, sir. Same goes at the end of the second year. Okay, so you'll be having three probabilities, okay, that on the basis of which you're going to estimate the cash inflows. So for this, I will always use the word estimated cash inflows, okay. And again, estimated cash inflows at the end of the second year might be 3 lakhs, might be 4 lakhs, it might be 1 lakh as well, okay. And the probability might be 0.5, 0.3, and zero point 0.2, okay. At the end of third year also, you might be estimating some cash inflows. Now, if I ask you that, what is your average? Then can I say your average will be estimated cash inflows into the probabilities and then we will sum it up. Can I say this will be called as your expected or your average cash flows? Come on, yes or no? Yes, sir. Okay. So that is going to be, this will be 60,000. Then this will be 45,000. And this will be 1,70,000 into zero point 0.4, that is nothing but 68,000. Okay. So if I add all these three things, can I say I'll be getting this as 1,73,000? Now, what is this 1,73,000? Can I say this is your average cash inflow at the end of the first year? Again, if I take the probability multiplied by all these things, then I'll be getting again the average cash flows at the end of the second year. And again, there will be some average cash flows at the end of the third year. Okay. Now, these are the expected average cash inflows at the end of first year, at the end of the second year, and at the end of the third year. Now, these are all your future value of the cash inflows. Can I say I want to convert that into present value? So I need to discount it and then I will bring it to the present value terms. And once I get the present value of cash inflows, you all know what we have to do. We will subtract that by the PV of CO to ultimately get the NPV. So the process is going to remain the same. That is, we are going to estimate the cash inflows and After estimation, the probabilities will be given to you. So we'll be calculating the average cash flows. Then we'll be discounting it and we'll be bringing it to the present value terms. Now, there are two possibilities, main possibilities here, where the estimation of the cash inflows will depend. Now, sometimes what happens is that, let's say, for example, I have estimated at the end of year one, the cash inflows of, let's say, 1 lakh and 2 lakhs. Okay. Now, today I have estimated that the cash inflow at the end of year one can be 1 lakh also, or it can be 2 lakh rupees also. Okay. Now, let's say, for example, the probability it can be 1 lakh is 0.6, the probability it can be 2 lakh, that is 0.4. While estimating the cash inflow at the end of the second year, if suppose I tell you that it is based on the cash inflows at the end of the first year. So at the end of the second year, when I'm estimating the cash inflows, I have to take the base of the previous year cash flows. Now, in this particular case, can I say the cash inflows are dependent on each other? Come on, yes or no? Yes, sir. They are dependent on each other. And when the cash inflows are dependent on each other, it means that second year cash inflow is dependent on the first year. So, while estimating the cash inflows, suppose I now want to estimate what is the cash inflow at the end of the second year, then I will take a base. Okay, so I want 1 lakh rupees at the end of the first year, then at the end of the second year, I might earn 1,30,000 also, or I might earn 1,40,000 also. But if suppose I am going to earn 2 lakh rupees here, then can I put it like this, that at the end of the second year, I might earn 2,40,000 also, or 2,70,000 also. Okay. And definitely there will be some probabilities attached to this as well. So can I say the probability that I might earn 1,30,000 is, let's say, 40%. The probability I might earn 1,40,000 is, let's say, 60%. Okay, because both these cash inflows are based on the cash inflows at the end of year one. Similarly, 2,40,000 and 2,70,000. Suppose the probability here is 70%, the probability here is 30%. Okay. Now, in this particular case, I hope you guys are trying to understand that the second year cash inflows are dependent on the first year cash inflows. Okay. So, if I want to calculate that what is going to be the average cash inflows at the end of the second year, then in this particular case, I will use the concept of joint probability. So, joint probability should only and only be used under what situations, beta? That when the cash inflows are dependent on each other. When year two cash inflows are dependent on year one. Because you can check that 1,30,000, to earn this 1,30,000, can I say it is dependent that I should earn 1 lakh at the end of the first year? Correct? So to earn 1,30,000 at the end of the second year, it is a prerequisite that I should earn 1 lakh at the end of the first year. Now, what is the probability I'm going to earn 1 lakh at the end of the first year? The probability is 0.6. So there is 0.6 probability I'm going to earn at the end of the first year 1 lakh. And what is the probability I'm going to earn 1,30,000 at the end of the second year? So that is 0.4. So the moment I multiply this by 0.4, can I say this is 0.6 into 0.4? It means 0.24. That is the joint probability for the second year to earn this 1,30,000. Come on, yes or no? Yes, sir. Similarly, if I want to earn 1,40,000 at the end of the second year, that is only possible if I earn 1 lakh at the end of the first year. And what is the probability of that? It is 0.6. And what is the probability that I might earn 1,40,000 at the end of the second year? So that is also 0.6. So the moment I multiply 0.6 into 0.6, I'll be getting this as 0.36. Similarly, to earn this 2,40,000, I have to earn compulsory this 2 lakhs. So 0.4, can I say that is the probability to earn 2 lakhs at the end of the first year? And I need to multiply this by 0.7. So 0.4 into 0.7, can you see it is 0.28? Okay. And similarly, 0.4 into 0.3, so that will give me 0.12. And now if you sum it up, 0.12 plus 0.28 plus 0.36 plus 0.24, then of course the total will be 1. Okay. So what does this mean? That if I want to calculate what should be the average or the expected cash flows at the end of year 2, then can I say I have to use the concept of joint probability to do it? Come on, yes or no? Yes, sir. So whenever a question on probability comes, until unless specifically mentioned, it is always the first case. And what was the first case? That the cash inflows are independent of each other. Okay, independent of each other means what? They are mutually exclusive. Okay, so year 2 cash inflows are not dependent on year 1 cash inflows. Okay, and when we talk about joint probability, then can I say if they're specified, then the cash inflows are dependent on each other. Now, when the cash inflows are independent of each other and when the cash inflows are dependent on each other, they both play a very important aspect while we calculate what is going to be the risk of the project as well. Okay. So something which you have to understand that whenever the cash inflows are independent of each other, then with the help of the Hiller's model, we'll be understanding that how can we calculate the risk of a particular project as well. Okay. So that is something which I'll discuss while doing the question. But I hope you have understood what is the significance of the first statistical measure in evaluating the risk in a project. And what's the first statistical measure which we are going to do is probability. And what do we mean by probability? So probability is nothing but how do we attach the probability or the possibility of a particular cash inflow materializing over a particular period of time. So whenever there is uncertainty, what do? We attach probabilities to it. Okay. What is the chance that you are going to earn this much? Okay. So, if you can just recollect, we have understood this at very earlier levels that whenever you toss a coin, what is the probability that it will be heads or it will be tails, right? So we attach probabilities to it. So even when we are dealing with stocks and whenever we are dealing with options, so what is the probability that it might become ITM, OTM or ATM? Okay. So all these things, is very much required when there are estimates which are involved. Okay. So in this particular case also, while we are going to, calculate what should be the average cash flows, it is important that we calculate what is the estimated part and whatever are the estimates, we attach the probabilities to it. And the moment we attach probabilities to it, what happens is that we'll be getting the average cash flows. And then from future value, we have to convert that into present value by using the discounting factor. Okay. So as I told you, nothing is mentioned. We'll always understand that the cash inflows are independent of each other. And if they give you specifically that the cash inflows are dependent on each other, then to calculate its average, we use the concept of joint probability. Okay. Now, we have discussed what is the probability. Now, what is the variance or standard deviation? What is the meaning of variance or standard deviation? Okay. Now, variance or standard deviation means what? Whenever something which moves from its average, we call that as a standard deviation, right? So let's say, for example, you want to invest in a particular company, okay? And you check their last 3 years data. And when you check the last 3 years data, you find that in the last 3 years, the returns which a particular security has provided is 10%, 10%, 10%. Okay. So can I say on an average, your expectation from this particular company is also going to be what? It's going to be 10%. Okay. So this is your X bar. That's your average is going to be 10%. Okay. So this is the average expectation. Now, if I ask you that what is the risk that you are going to for sure earn 10%, then you will tell me, sir, the risk is zero. Why? Because there is no deviation from the average. You can see in the past 3 years, the company has provided the returns based on 10%. That is nothing but its average only. So why should I consider risk when I'm investing in this particular company? So in the fourth year, at the end of the fourth year also, my expectation is that I'm going to earn 10% average. And the risk attached to earn this 10% is actually going to be zero. So there is no deviation only from the average. But on the contrary, if I give you year 1, year 2, year 3, and if suppose I give you 5%, 10%, and 15%, Now, can I say the total of this will be 30% and the average of this is going to be 10%? Okay. Now, if you are going to invest in this particular company, then what is your expectation? Then definitely your expectation is going to be 10% only, right? Your average is going to be 10% only. But now, do you have any risk attached to it? Then the answer is absolute yes. There is going to be some risk attached to it. Now you will be like, sir, what is the risk attached in this particular case? So the risk attached is, can I say at the end of the first year, from 5 we have deviated to 10. So there is -5. Here there is no deviation and there is +5. But of course, if we sum it up, then it becomes 0 only. So that's why what do? We square it. Okay. And the total of this will be 50. So if I ask you what is the average, so you have to take 50 and divide that by 3. Correct? Because we want to calculate average on per year basis. So this is the returns on per annum, right? That's what you're expecting in the next year. So the average is going to be 50 divided by 3. But because we squared it, now we take the root of it. So this is how your standard deviation formula is derived. So what is standard deviation? You take root of summation of x minus x bar square upon n. So this was your x. This is your x minus x bar. We take x minus x bar square. So that's what we do it, right? So this is now going to be root of what? 50 divided by 3. So 50 divided by 3 will be root of 16.67 and the root of this will be 4.08. So the basic significance of deviation is, you know what? That you are expecting 10%, but it can go plus minus 4.08%. So you can expect 14.08% also, or else 6 point something percent as well, 5.92 as well. So this is something your range of estimate is going to be. Okay. So deviation helps you to understand, and I hope you are very capable of understanding this, that higher the standard deviation, higher is the risk attached. Why? Because then if suppose there is another project which provides 10% return, and if its standard deviation is let's say 6%, then you can get higher returns as well, and the risk can also be tremendously high. Okay. So apparently the whole point is that whenever the standard deviation is higher, the risk attached to that particular project is also going to be higher. Okay. So we can calculate standard deviation of different types of cash inflows, which is getting generated at the end of first year, second year, third year. And then once the standard deviations are calculated, what do? Is we check that where the risk is relatively higher, okay, by comparing those standard deviations with the mean. So we are going to learn how to calculate standard deviation of the cash inflows as well. How do you calculate the standard deviation of the NPV as well? Okay. Then what is variance? Variance is standard deviation square. Okay. So if I ask you what is the variance of this particular project, then your answer will be 16.67%. So what is standard deviation square? That is nothing but your variance part. Okay. Now, after probability and standard deviation of variation, there is something which is called as coefficient of variation as well. Now, this coefficient of variation usually comes into the picture when you cannot make decisions through theory of dominance. Okay. So something like this, suppose you have project A and project B. Okay. And let's say, for example, your project A and project B, your project A has, let's say, for example, an average return of 10%. Project B also has an average return of 10%. And if suppose the risk involved here is, let's say, 4% and the risk involved here is 6%. So it's a no-brainer exercise. Will you select your project A, come on, yes or no? Of course, yes. Why? Because at the same level of returns, the risk is relatively lower. So A is definitely dominating B. Okay. If I give you another example, that if this is 15% and if this is 10%, okay, and this is your average return, and your risk here is 3% and the risk here is 7%. Of course, in this particular case also, we will be selecting project A as well. Come on, yes or no? Yes, sir, because it provides higher return at lower level of risk as well. Okay. If I give you another example in which there is project A and project B, and both the projects, let's say, for example, this gives you 15%, this gives you 12%, and the standard deviation is, let's say, same 4%, 4%. Then also you will select project A because it provides higher return at the same level of risk. So these are the situations where theory of dominance can be applied. Okay. But if I tell you that there are two projects A and B, and the return here is, let's say, 15% and 18%, and the risk here is 5% and 6%. Now, just by looking at these two averages and standard deviation, you cannot apply your theory of dominance. So what will you do in this particular case? Then definitely you need one technique, okay, where you can bring both these particular projects at a standard level of comparison. So for that particular case, we use coefficient of variation, which is nothing but whatever is your um, whatever is your standard deviation, we divide that by the average. So let's say, for example, the standard deviation here is 5 and the mean is 15. Okay. So this will be 0.33. And if this is 6 and if this is 18, okay, so this is again coming the same thing only. So it is 0.33 is to 1. But if suppose I take this as, let's say, 20%. Okay. So if this is 20%, then 6 divided by 20 will give me 0.3. Now, can you just check to earn 1 unit of your return, you are having 0.3 of risk. So here the risk is relatively lower. Here the coefficient of variation is relatively lower. So when you take standard deviation and compare that by mean, what you get is coefficient of variation. And lower the coefficient of variation, the better it is. Okay. Because for your 1 unit of return, can I say that there is 0.3 level of risk? Okay. Here for your 1 unit of return, there is 0.33 risk. Now, definitely you want to take lower risk for your 1 unit of return, yes or no? Yes, sir. So that's why coefficient of variation should always be lower the better, and so is the standard deviation. But coefficient of variation usually applies under what situation? That when you cannot apply your theory of dominance normally. Got it? So these are your three types of statistical techniques, and now we'll be doing the questions on the same. So we are done with the conventional techniques. Now we'll be starting with the statistical techniques where there is probabilities, variance or standard deviation, as well as the coefficient of variation. Okay. Sure. So let's start now with the questions on that. Okay. Now your practical question one. Okay. Now let's start with that. Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of rupees 50 lakhs. The expected cash flows after tax for the next 3 years is as follows. So for year 1, year 2, year 3, we have the cash flows after tax, which is 14 lakhs, 18 lakhs, 25 lakhs, and 40 lakhs, and we also have the probabilities attached to it. Similarly, for year 2 also we have the cash flows after tax, we have the probabilities. For year 3 also we have cash flows, and then we have probabilities. The company wishes to take into consideration all the possible risk factors relating to airline operations, and the company wants to know the expected NPV of this venture, assuming independent probability distribution with 6% risk of rate of interest. So independent probability distribution means what? The cash flows are not dependent on each other, so they are independent in nature, right? So they are mutually exclusive. So second year does not depend upon the first year. Then what is the possible deviation in the expected value? So possible deviation means we are required to calculate the standard deviation of the project, and how would the standard deviation of the present value distribution help in capital budgeting decisions. So we need to check that standard deviation, what is the impact on your present value distribution. So how, this is a theory part, that how is the standard deviation extremely helpful for the purpose of decision making. Okay. So that is something which we'll discuss, but the first part is we are required to calculate the expected NPV. Okay. So let's do that. We will now start with your first question. Write down calculation of expected NPV. So please solve this with me. Expected net present value. Okay. So as you all are aware that if you want to calculate the NPV, what we will do? We will take the present value of cash inflows. From this, we will subtract the present value of cash outflows to ultimately get what is your net present value. And we already have your present value of cash outflows. And how much is that? 50 lakh rupees. So this will now be 50 lakhs and we are going to make the investment today itself. So this is going to be 50 lakhs. Okay. Now, when it comes to your PV of CI, it is important that we have to estimate for PV of CI what is going to be the cash inflows at the end of year 1, year 2, year 3. So we will see what are the cash inflows. Then we will discount it definitely at what percentage rate. The rate is 6% and we are ultimately going to get the present value of cash inflows. Okay. So these cash inflows should always be your average cash inflows. This should be your expected cash inflows. But here you can see that we have the cash inflows available and the list of probabilities are also given to you. So these are different situations of the cash inflows which are possible. So on an average, what we have to do? We have to take the cash inflows, multiply that by the probability and calculate the average. So I'll do it here for the first part. What is going to be the average or expected cash flows at end of year 1? So this is going to be year 1, year 2, year 3 and year 1. How many situations are there? First, let us check. There are 4 situations. Okay, 4 possibilities. So there are 4 possibilities. And what is the probabilities? 0.1, 0.2, 0.4 and zero point 0.3. Right? So these are the 4 probabilities. And what are the cash inflows which are possible? So these are the situations. These are not years. Okay. There are 4 situations, or else you can just write down this as A, B, C, D. So there are 4 situations. Okay. And what are the estimated cash flows? 14, 18, 25, 40. 14, 18, 25 and 40. Okay. So will this help me to calculate what is going to be my average cash flows? Come on, yes or no? Yes, sir. So what's going to be my average cash flows? So my average cash flows are now going to be 14 lakh into 0.1, then 18 lakhs into 0.2, then 25 lakhs into 0.4, then 40 lakhs into 0.3. Okay. And the total of this is coming as 27 lakhs. Correct? So on an average, can I say I'm expecting 27 lakhs at the end of the first year? Yes, sir. So I'll write down here 27 lakhs. Okay. So this is the average what I'm expecting, 27 lakhs. Now, similarly, I have to do the same calculations at the end of the year 2 as well as year 3. Okay. So for year 2, similarly, for year 2. Okay. Now that is again going to be the average. So X bar will now be, now I'm doing it directly, 15 lakhs into zero point 0.1, then 20 lakhs into zero point 0.3, then 32 lakhs into zero point 0.4, and then 45 lakhs into zero point 0.2. Okay. The total of this is coming like 29 lakh 30,000. Okay. And for year 3, now let us check this out. So this is 29 lakh 30,000. And for year 3, this is now going to be 18 lakhs into zero point 0.2, 25 lakhs into 0.5, 35 lakhs into 0.2, 48 lakhs into 0.1. The total of this is 27 lakh 90,000. So this will now be 27 lakh 90,000. Now, if I want to calculate the present value, what do I have to do? I have to discount it at 6% rate, 1 divided by 1.06. So this is going to be 0.9434. This is going to be 0.8899. And this is going to be 0.8396. Okay. So in this particular case, My cash inflows will now be 74,97,071. Okay. So yes, so this is my cash inflows. PV of CI 74,97,071. From this, I will now subtract 50 lakh rupees. So I'll be now getting 24,97,071. Now, do I have the NPV available? Come on, yes or no? Yes, sir. The moment I have the NPV available, and if the NPV is positive, then what is going to be my conclusion? That I should accept the project, right? So my conclusion is now going to be conclusion, since NPV is positive, we should accept the project. Okay. So this is something which we can conclude it very easily as a solution to the first part. Okay. The second part is the possible deviation. Okay. In the expected value. So now we are required to calculate the standard deviation. Okay. Of the entire project. So we will write down here second part, calculation of standard deviation of the project. Now to calculate the standard deviation of the project, what we need to do is that we have to see what is the average and how much are we deviating from the average. Okay. So our average is something which we know, that is nothing but how much is it? You have got the PV of CI of 74 lakh 97 minus 50 lakhs, so 24 lakh 97,071. So now this 24 lakh 97,071, this is your expected NPV, correct? And your expected PV of CI is 74 lakh 97,071. Now, on an average basis, what is going to be the deviation that you will be earning this PV of CI and you will be earning this NPV? So, what is the risk attached to it? So, for that, what we need to do is first we have to see whether the cash inflows of the projects are dependent or they are independent. So, if they are independent in nature, okay, just as the case is, okay. Now, in this particular case, what we need to do is to calculate the standard deviation of the project. So, first we have this Hiller's model, okay, which says that the standard deviation is nothing but whatever is the variance of cash flows at end of year one. We have to divide that by 1 plus discounting factor raised to square plus whatever is the variance of cash flows at the end of year 2, we have to take 1 plus discounting factor raised to the power 4 plus whatever is the variance of cash flow for year 3. Okay. And we will take 1 plus discounting factor raised to the power 6. So this is what is actually called as your Hiller's model for the purpose of calculation what is the risk of the project. Okay. But let us just simplify this particular thing, that how do we calculate the risk of the project. So see, whenever we were discussing in portfolio management also, that how do we calculate the standard deviation of the project. Now see, because here there are 3 years, let's say for example there are 3 securities, okay, in a particular portfolio. So how is to calculate the risk of the particular portfolio? Okay, so if you are done with portfolio management, we have derived how do we calculate the standard deviation of the portfolio, the risk of the portfolio, when there are 3 securities in a portfolio with the help of a matrix. Okay, so here if you are capable of understanding that there was a derivation where there were 9 possibilities and based on that we calculated. So here also we are going to calculate what is going to be the standard deviation of the portfolio. I'll just write down the formula for the same. So what will be the formula? We will take weights of A square into variance of A, right, plus weights of B square into variance of B, plus weights of C square into variance of C, right? So this is what we used to do while calculating what is the risk of the portfolio. Plus we used to take 2 times weights of A into weights of B into standard deviation A into standard deviation B into correlation coefficient AB. Okay. Plus 2 times weights of B into weights of C into standard deviation B into standard deviation C into correlation coefficient BC, plus 2 times weights of A into weights of C into standard deviation A into standard deviation C into correlation coefficient AC. Correct? So this is something which we had discussed, okay, in portfolio management chapter. Now, if I tell you that instead of your portfolio, let us calculate what is the risk of the entire NPV. Okay, we have to calculate the risk of the NPV, risk of the entire project. Okay, so in this particular case, what I need to do is first, instead of the variance of the security, I will take what is the variance of the cash inflow at the end of year one, right? And the weights here will be what? The weights here will be nothing but the discounting factor, the PV factor, because I want to calculate in the present value. So to calculate in the present value, the most important aspect is what? That we need what is the PV factor at the end of the first year, right? So weights of A square will be, because to calculate the present value, I will need two things. What will I need? Whatever is the cash inflow, and second, what will I need is whatever is the discounting factor, and multiplying that I'll be getting the present value, right? So basically, let me interpret this weights as whatever is my PV factor and the variance of this particular security which was there in the formula. We can understand that this can also be called as your variance of the cash flows. Okay, so again, this is your PV factor, this is your variance. Again, this is your PV factor, this is your variance. Okay. But of course, here it will be PV factor for year 2, here there will be PV factor for year 3. Okay. Now, of course, if the cash inflows are independent of each other, then can I say that between year 1 and year 2, the relationship of cash inflow is actually 0. Okay, the correlation coefficient is 0. Between year 2 and year 3, it's also 0. And year 3 and year 1 and year 3 is also 0. So can I put it like this? Then we are left with the risk of the project to be as whatever is your PV factor at year 1 square into what is the variance of cash flow at end of year 1, right? Plus whatever is the PV factor at year 2 square, multiplied that by variance of cash flow at year 2, correct? And plus what is the PV factor at year 3 square, multiplied by what is the variance of cash flow at year 3, correct? So this is something which we had discussed. Okay, so if it is 0, then obviously all these elements are going to be 0, so we'll be left with only this much part. Okay, now how do you calculate this? So can I put it like this? Your PV factor at the end of year 1 can be written as 1 divided by 1 plus discounting factor square. Correct? Because see, if it is at the end of year 1, then can I say it will be 1 divided by 1 plus discounting factor at the end of year 1. So I'll raise to 1. But because it is square, I have to multiply that by 2. And then of course, I'll be taking here whatever is the variance of the cash flow at the end of year 1. Now, if I denote the cash flows by term X, can I say this will be variance of X for the first year? Okay. Plus, can I say this will be 1 divided by 1 plus discounting factor? Now, because I want to calculate the present value for the year 2, I have to take 1 divided by 1 plus discounting factor square. But then again, I need to multiply this by 2, right? Because this is square. Okay, it's weights B square. So that's why whatever is the PV factor at the end of the second year, I have to square that as well. Okay. And then I need to multiply this by variance for year 2 cash flows. And same 1 divided by 1 plus discounting factor for the year 3. Okay. But this is at the PV factor at the end of year 3. But again, I have to square it up because it's weight C square. So that's why I'll take 3 into 2. And then I will take variance of X for the year 3. Okay. So ultimately, can I say now we are left with the exact formula what we have discussed, that is 1 plus discounting factor square, 4 and 6, because I hope you all have understood that this will ultimately become what? The risk will now ultimately become whatever is the variance of the cash flow at the end of year 1, okay, and because it's variance, that's why I've taken standard deviation square, okay, divide by 1 plus discounting factor square plus whatever is your variance, okay, for year 2, you can divide that by 1 plus discounting factor. Here you can take 2 into 2, sorry, so this will be 4, okay, and then you can take variance for year 3, okay, and divide that by 1 plus discounting factor raised to the power 6, correct? So ultimately what I have to do is I have to now calculate. So this is what the Hiller's model is. So now I have to calculate what should be the variance of the cash flows at the end of year 1, year 2 and year 3. The moment I calculate the variance at the end of year 1, year 2 and year 3, can I substitute that and calculate the risk? Then the answer is absolutely yes. So it's possible. Okay. So now what will I do is my steps will now be to calculate what should be the variance. Okay. So I'll write down here variance of cash flows at end of year 1, year 2, year 3. Now, why there is a risk in this cash flows? Because see, y'all can just check that these are the cash flows and these are the probabilities of occurrence. Okay. So definitely there is going to be some variance. There is going to be some risk attached for these cash flows, right? So at the end of year 1, there is 14 lakhs, the probability is 0.1. If this is 18 lakhs, the probability is 0.2. I hope you are trying to understand that to own these cash flows as well, there is certain risk which is attached to it. Okay. Now, variance of cash flows at the end of year 1, year 2, year 3. So what are you going to do? Now, for year 1, we have how many situations? 4. A, B, C and D. Do we have the probabilities attached to every situation of occurrence? Yes, zero point 0.1, zero point 0.2, zero point 0.4 and zero point 0.3. Okay. Now, do we have the estimated cash flows? Yes, sir. We have the estimated cash flows as well. 14, 18, 25 and 40. 14 lakh, 18 lakh, 25 lakh and 40 lakhs. Okay. So these are estimated cash flows where we can say this is X. Then we need to calculate your X bar. Okay. So this will be your average. Okay. The summation of this will be called as your X bar. Then you can write down X minus X bar. Then we will take X minus X bar square. But because here there are probabilities, we'll multiply the same by probabilities to get the average. Okay. So instead of dividing by 2, what do? Is we multiply that by probability. Okay. So I think your X bar is already calculated. So your average cash flows we have already calculated for the first year. And that was nothing but 27 lakhs. Okay. So here I will write down 27 lakhs. So my X bar is actually 27 lakhs. Okay. So what will now be X minus X bar? So this will now be minus 13 lakhs. This will be minus 9 lakhs. This will be minus 2 lakhs. And this will be 13 lakhs. Now I need to square it up. Okay. And multiply that by probability. So that will be 13 into 13. Multiply that by probability of 0.1. So that will be 16.9. Okay. So this will now be, because it's 13 square multiplied by 0.1, right? So 16.9. So right down here this has 16 lakh 90,000. Similarly, one second, x minus x bar, around 13 squared multiplied by probability is the 16 lakh 90,000. This is correct. Okay. Similarly, 9 squared 81 into 0.2. So this will now be 16 lakh 20,000. Then this will be 2 square 4, which I need to multiply by 0.4. So this will be 1 lakh 60,000. And this will be 16 lakh 90,000. Here the probability is different. So this will now be 13 lakhs into square. Okay. So 13 into 13 square into 0.3. So this will give you 50.7. Okay, so that will be 50 lakh 70,000. So this is 85 lakh 40,000. Okay. Now we have already got the variance as 85 lakh 40,000. But let us calculate this in lakhs only. Okay, so that will be much more easier. So 85.4 lakhs. So here the variance will be, okay. So I want to calculate the risk of the project, right? So I can substitute it here. So variance of the project will now be 85.4. Okay. And plus square. Okay. Now similar to this, you can now calculate on your own what can be year 2 and year 3 variance as well. So I'm giving you some time. If you want, you can pause your video and now you can just calculate your year 2, year 3 as well, so that then we can proceed this further. So for year 2, you should be getting this as 98.61 and this should be 74.29 lakhs. Okay. So this will be 98.61. Divide that by 1 plus 0.06 raised to the power 4 plus this is now going to be 74.29, right? So that will be 74.29 and raised to the power 1.006 raised to the power 6. Okay. So let us calculate now the present value. So this should be coming as 76 plus 78.11 plus 52.38, and this will be root of 206.49. So your risk should be coming as 14.37 lakhs. Okay. 14.37 lakhs. Right. So this is the risk which should be coming as. Okay. The risk of making investment in this particular project is nothing but 14.37 lakhs. Now, in my opinion, this risk of the particular project is, related to what is the risk which is involved to earn the average cash inflows. Okay. So here, as you can see that the average cash inflows in present value terms was coming as 74 lakh 97,071. So that is why the risk that your particular project will earn can be 74 point something plus or minus 14.37. But because your PV of CO is always constant, that is 50 lakh, 50 lakh. So of course we can attach this plus or minus to the NPV as well. It's the same thing. Okay. So if I tell you that I am going to earn PV of CI of 100 and my PV of CO is, let's say, for example, 70. So my NPV comes 30, right? So there is a deviation of this as plus or minus 20. Okay. So you can earn 120 also, or you can earn 80 also. So that is why if I take 120 minus 70, this will give me how much? 50. And 80 minus 20, this will give me what? 80 minus 20, this will give me 60. 80 minus 70, sorry. So this will give me 10. So my NPV is 50 or 10, which can be nothing but 30 plus 20 minus 20. So 50 and 30 minus 20 is 10. So ultimately it's the same thing only, because your PV of CO is constant, but conceptually this this particular deviation what you have got, that is 14.37, is the deviation on PV of CI. Okay, but because the PV of CO is same, so that is why we also say that this is nothing but the deviation from the NPV as well, because of this logic, okay, which I just told you, because of PV of CO remaining the same. Okay, so if I earn 120 also, or if I earn 80 also, so if I apply these deviations to the CI as well, so I can either earn 120 or I can either earn 80, and keeping this 70 same, so ultimately I'll be earning NPV of 50 or 10, which can directly be calculated like this as well, by taking the NPV and plus or minus this 20. So that will be 50 and 10. Okay. So this was just for your reference, that whatever NPV you have actually earned, plus or minus 14.36 is something what you're estimating. Okay. And that's what in the third part they have asked you, how would the standard deviation of the present value help help in the capital budgeting decisions? So how does standard deviation helps us? So can I say standard deviation helps us to create one range, okay, where we can come to know that what is the maximum NPV we can earn and what is the minimum NPV we can earn, and that is something which will also help us in decision making. So it is something like this, that if suppose the NPV of both the projects are 100, okay, but project A has a standard deviation which is coming as 30 and project B has a standard deviation of 50, then can I say that there is 130 or 70, and here there is 150 or 50. So you can see that the risk involved in B is relatively higher as compared to A. So the person who is willing to take high risk, high returns will definitely select B. And the person who is like, it's very conservative, then he will select project A. Okay. So when the projects are offering you almost similar NPVs and we want to invest in such kind of a project, then can I say standard deviation can come to your rescue? And then we will select the projects which offers us lower standard deviation. Okay. So that's why, because at the same NPV, if the standard deviation is lower, can we select such kind of the projects? Yes or no? Yes, sir. Okay. So this was something which we had discussed in the first part, in the first question. So that theory part, if you want, then you can read it, which is there in your study module as well. Okay, we'll discuss about the same thing what I've just now told you. Okay, sure. Now let us start with the next question, question number 2. Now see, cyber company is considering two mutually exclusive projects. An investment outlay of both the project is 5 lakhs. So this is nothing but your CO, and each is expected to have a life of 5 years. Under the three possible situation, 3 annual cash inflows and the probabilities are given to you. Okay, so we have the cash inflows and what are the probabilities attached to it that is available to us. Okay, and the cost of capital of 7%. Okay, that has to be taken, which project should be accepted, explained with working. Now see, can I say that here there are 5 years, but every year the cash inflows are constant and we have the probabilities as well as the estimated cash flows. So if I just calculate my solution to the second part, if I want to calculate expected cash flows, okay, that is average cash flows for project A and B. Okay, so for project A and B, if I want to calculate the expected cash flows, how will I do it? So I have three situations: good, normal, bad. Okay, and good, normal, worse. Okay, and What is the probability? 0 0.3, 0 0.4, 0 0.3. And the probability is 0 0.3, 0 0.4 and 0 0.3. Do I have the estimates available? Yes, 6, 4 and 2. So for project A, I have 6 lakh, 4 lakh and 2 lakhs. Correct? So if I want to calculate average, how will I do this? So I will simply take 0.3 into 6 lakhs. So that will give you 1 lakh 80. 0.4 into 4 lakhs. That will give you 1 lakh 60. 0.3 into 2 lakhs. That will give you 60. And the total of this is now 4 lakhs. Again, if I take it for project B, what is my project B? 5, 4 and 3. 5, 4 and 3. Okay. Now what will be my average? Can I say it will be 5 lakh into 0.3? Then 4 lakh into 0.4 and 3 lakhs into 0.3. The total of this is again 4 lakh. Oh, now can I conclude like this that the average cash flows for both the projects are same? Average cash flows for both the projects are same. So cash inflow per annum is the same on an average basis. So if I want to calculate NPV also, what I know is that here 1, 2, 3, 4, 5, the cash inflows for project A on an average basis, which we also call it as expected cash flows, are 4 lakh, 4 lakh, 4 lakh, 4 lakh, 4 lakh. If I discount it at the cost of capital, which they have told you that is 7%, okay, and I'll be getting the present value, okay. So this is my PV of CI, from which if I subtract my PV of CO, so ultimately what will I get is my NPV. And the same thing beta if I do it for project B as well, okay, but because the cash inflows are constant, from year to year 1 to year 5, which is nothing but on an average of 4 lakhs, I can simply multiply that by PVAF at 7%, okay, for 5 years annuity factor. Then can I get the PV of CI? Come on, yes or no? Yes, sir. Okay. So under both the situations, if I subtract it by PV of CO, I'll be getting the NPV. And the NPV under both the projects are going to be the same. Come on, yes or no? Yes. So now if they have asked you that which particular project should be accepted. So first thing is very clear that just on the basis of NPV, I cannot judge that which project is going to be better. So in this particular case, can I calculate what can be my standard deviation? Come on, yes or no? Yes, sir. So I can calculate the standard deviation of the particular cash flows for year 1. Okay. So basically I have these cash flows. Okay. So just I can calculate the standard deviation for the same. And the moment I calculate the standard deviation, I come to know that this is the risk which is involved to earn the cash inflow for a particular project. And once I get the risk, of course, can I say that the risk every year, for every year, because the cash inflows are constant, the risk is going to be the same only. Okay, so there is no need to calculate for every year. Just for calculating for one particular year, if I calculate the standard deviation, then I can select the project in which the risk element is going to be lower. This is unlike the previous question. In the previous question, we had 3 different years. Here we have 5 years. In the earlier question, 3 different years had 3 different cash inflows, had different cash inflows every year. So that's why we had to calculate the risk every year. Okay. But here, can I say that every year the cash inflows are constant? So the risk involved here is also constant every year. Okay. So that's why what we will do is we'll simply calculate the risk for, project A or project B and just check where the risk element is lower and the project in which the risk will be lower. Are we going to select that? Yes or no? Yes, sir. Okay. So let us calculate the same. Write down. Since the cash inflows on an average basis is constant, or same for project A and B, we conclude that NPV will also be the same. Okay. Because you know that the PV of CO is also 5 lakh rupees. Huh? So that's why PV of CI, PV of CO, NPV is going to be same. Okay. Therefore, to select a project, we need to calculate net present value. Okay. Sorry, we need to calculate standard deviation. We need to calculate standard deviation or risk. Okay. So let us calculate the standard deviation or the risk for project A. Okay. So can I say that we have events? Now you all can check that there are 3 events. So I will say good, normal, worse. What is the probability of occurrence of these events? 0.3, 0.4, 0.3. Okay. And also, what are the estimated cash flows? So your estimated cash flows are 6 lakh, 4 lakh, and 2 lakhs. 6 lakh, 4 lakhs, and 2 lakhs. Okay. And this we can say is your X. And we have the X bar as well. The X bar is 4 lakhs. So X minus X bar, and then I can take X minus X bar square and multiply the same by probability. So this will now be 6 minus 4. X bar is 4 lakhs, right? So this will now be 2 lakh, 0 and negative 2 lakh. Okay. So this will now be 1 lakh 20,000. I'm taking this on, on an average on the rupees in lakhs basis, because 2 lakh square, if I multiply that by probability, the figure is very huge. So I'll just write down this as 1,20,000. Okay. And then this will again be 1,20,000. Okay. Now this will be your 2,40,000. And I will take the standard deviation of 2,40,000, which will be, and if I multiply that by 1 lakh, I'll be getting this as 4,89,898. Okay. One second. Let us take, if I take the full figures, let us see what happens here. One second. Huh? Let us go by the normal process. 2 lakh into 0.3. So this will now be 120. 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. So this will now be 2, 4, 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. And if I take the root of this, this should be coming as 1,54,919. So this is the exact answer. 1,54,919. Okay, 1,54,919. Similarly for project B, let's do the same. So because from starting only I've taken the full figure, so let's do it accordingly. Project B. So project B, same concept. We'll be having good normal verse, and we have the probabilities zero point 0.3, zero point 0.4, zero point 0.3, and we also have its cash inflows as 5 lakh, 4 lakh, and 3 lakhs. Okay, and this will be your x minus x bar, probability into x minus x bar square. So what's your x bar? It's 4 lakhs itself. So this is now going to be 1 lakh, 0, negative 1 lakh. Let's now sum it up and then take the root of this. Okay. So this is coming as 77460. Okay. Perfect. Fine. So now you all can check that the risk of the project B is 77460, while the risk of project A was 1,54,919. Okay. Now definitely we will select which project. We will select project B because it is having lower standard deviation. Okay. So there is no need to calculate the NPV because NPV is anyway going to be constant only, same only. So we'll just write down the conclusion. Okay. Project B should be selected because risk because risk is relatively lower. Okay. Because the standard deviation is lower, can I say the risk is also relatively lower? Yes or no? Yes, sir. Okay. So with this, now we are done with your question number 2 as well. Okay. Fine. Okay. Now, in this particular question, it's a very basic and easy question. A company is considering projects X and Y with the following information. We have project X, project Y, we have the expected NPV, we have the standard deviation. Which project will you recommend based on the above data? So, do we have the expected NPV? Yes. We have the standard deviation? Yes. So, there is no need for any calculation here, but your theory of dominance does not apply. We cannot say that here project X is better or project Y is better because we cannot directly compare and check that which particular project is having lower risk and higher returns. So what we need to do is we have to actually calculate your coefficient of variation, and then we will see that which particular project has the lower coefficient of variation and we will select that. Okay. Explain whether your opinion will change if the coefficient of variation as a measure of risk is used, and which measure is most appropriate in this situation and why. Okay, so basically we are just going to do the calculation based on coefficient of variation. So you can just check the solution. On the base of standard deviation, X can be chosen because it is less risky. Okay, just on the base of standard deviation. But what is the most important part? That we have to use coefficient of variation. So how will we do that? We will take the standard deviation upon expected NPV. So very basic and easy question. You can do the calculation simultaneously. You will take the standard deviation and divide that by whatever is the average. So you will come to know that this is 0.738 and this is 0.533. Now, based on coefficient of variation, we should select the project in which the coefficient of variation is lower. So we say that project Y should be accepted because project X is now appearing to be risky because its coefficient of variation is relatively higher. Okay. And then when we talk about your third part, what is given to you, that they have asked in the question, which measure is more appropriate and why? NPV is NPV method in such conflicting situation is the best, because NPV method is compatibility of the objective of wealth maximization. Now, whenever you see that there is some difference in the opinion, in the first opinion, we just selected the project based on NPV. In the second method, we calculated on the base of coefficient of variation. In the first, on the base of standard deviation, project X was taken into consideration. Then, on the base of coefficient of variation, you can see that project Y looks better. Okay. So there is a conflict in ranking. So in that particular case, we should always select the project in which the NPV is maximum. So which project has the highest NPV? Then it is project Y. So that's why we can conclude like this, that project Y can be selected because its NPV is higher. Okay. Chalo. Now let us start with the next question. KLM is considering taking up one of the two projects, K and project S. Both the projects have same life, require initial investment of 80 lakhs. Both are estimated to have the same yield. As the company is new to this type of business, the cash flows arising from the projects cannot be estimated with certainty. Of course, an attempt was therefore made to use the probability to analyze the pattern of the cash flows from the projects during the first year of its operations. The pattern is likely to continue during the life of these projects, and the results of the analysis are as follows, in which project K and project X, we have the cash inflows and we have the probability. So we have the estimates available. Okay. And we have the probabilities. We are required to calculate what is the variance, standard deviation, and coefficient of variance for both the projects, and which of the two projects is riskier. So we are required to calculate variance, standard deviation. So basically, from the cash inflows, we are required to calculate the standard deviation. How will we do that? Can I say we can simply calculate the standard deviation by taking x minus x bar square, and we can multiply that by the probability. Okay, so very similar to that previous question which we did of cyber company. Okay, and we are also required to calculate the coefficient of variation. Okay, for both the projects. So for that, actually the NPV will be required. Okay, and do we have here the life available or not? Okay, so let us check this out. 80 lakh will be invested today. Okay, and they have told you that the pattern of the cash flows during the first year of operations is given to you, and this is likely to continue during the life of this projects, and we have the cash inflows available. Okay, so actually the life is not available to you, so we can simply calculate whatever is going to be your uh, expected net cash flow. We'll calculate the standard deviation and the mean, so there is no need to calculate the NPV. We can directly do it. See how I'll tell you. Let us start now with this question number 4. We'll solve it in much more easier format. uh, First part, calculation of variance, standard deviation. Okay, so first I'll start with calculation of variance. Okay, for both the projects. Now, in this particular case, you are having events. How many events are there? 1, 2, 3, 4, 5. A, B, C, D, or E. Then we also have the probability of the events. 0.1. Okay, for project K, this is 0.1, 0.2, 0.4, 0.2, and 0.1. Correct? Then do we have the estimated cash flows? Yes, sir. What are the estimated cash flows? 11, 13, 15, 17, 19. 11, 13, 15, 17, and 19. So can we calculate the expected cash flows or the average cash flows? Yes or no? Yes, sir. Which we can call it as X bar. So that will be 11 into 0.1, then 13 into 0.2, then 15 into 0.4, then 0.2 into 17, then 19 into 0.1. So the total of this is coming as 15. Okay. So this is your X bar. Okay. The total year, not here. The total year is coming as 15. Now the next thing is we have to do X minus X bar. Then we'll do X minus X bar square. Then we'll take and we can just simply multiply the probability here itself. So there is no need to do all these things. Okay. Sure. So now let us calculate your X minus X bar. 11 minus 15. So this will give you minus 4. 13 minus 15. This will give you your minus 2. This will be 0. This will be positive 2. This will be 4. And if I take the square, so this will be 16 into 0.1, 1.6, 4 into 0.2, that will be 0.8, 2 square, multiplied that by 0.2, so that is 0.8 again, and this is again 16 into 0.1. So the total is now coming as 4.8. Okay. This is the variance of project K. Okay. So variance of project K is coming as 4.8. Okay. And similarly, we have to prepare one more table for project. Now this will be project S. Okay. So you can try this on your own. Just pause the video and try this. So your answers for your project S should be, okay, so this is for your project S, which should be 4.8 and 20.8. Okay, so that's your variance. Now, they have also asked you in the B part that what should be the standard deviation. So calculation of standard deviation. So as you know that standard deviation is nothing but the square root of the variance, right? So we will take standard deviation as root of, for project K and for your project S, it's gonna be root of, in the first case, root of 4.8, and in the second case, it is root of 20.8. So this is 4.56, and this is now going to be 2.19. Okay, and because all this is in lakhs, right? Rupees in rupees, and we are assuming that all this is in rupees in lakhs, so this will be rupees 2.19 lakhs, and this is rupees 4.56 lakhs. But now we are also required to calculate the coefficient of variation. Okay, so let us now also start with coefficient of variation. So how will you calculate that? Whatever is your standard deviation, you will divide that by mean. So for K and for your S, your standard deviation is 2.19 and 4.56. And what's your mean? Mean means your average. So your average for project K was coming as 15 and 17. So this will now give you 0.146 is to 1, and this will give you 0.268 is to 1. Okay. So which project, they have asked you, which of the two project is riskier? Can I say that the project in which the coefficient of variation will be higher, that project will have higher element of risk? So we will write down here, project S is riskier as it has higher level of coefficient of variation. Okay, higher level of coefficient of variation. Okay, that's it. Now let us start with the next question. Now what is given to you? Project X and Y are under the evaluation of XY company, and the estimated cash flows and the probabilities are given below. So project X and project Y. So there are two types of projects. Okay, and both the projects, you all can see that they are having different cash outflows. Project X is having a cash outflow of 70 lakhs and project Y is having a cash outflow of 80 lakhs. We have the probabilities and we also have in project X 3 years where there are three different types of cash inflows. As you all can just check, project X has for year one cash inflow of 30, 50, and 65, and the probability of occurrence is also given to you as 0.3, zero point 0.4, and zero point 0.3. So just interpret the data very carefully. For project X, for year two, the cash inflows are 30, 40, and 50. Okay. And this is going to be your uh, probability 0.3, zero point 0.4, and zero point 0.3, and same for project for your year three as well. Project Y has annual cash inflows through its life, which is probability 0.2, 0.5, and zero point 0.3, and we have the annual cash inflows 40, 45, and 50. So every year the annual cash inflows are going to be the same. Which project is better based on your NPV, and the discounting factor is given to you as 10%. And then we are also required to calculate the standard deviation of the present value distribution and analyze the inherent risk of the project. Okay. So we are required to calculate the NPV, okay, for both the projects. So for project B also we are required to assume that the life is 3 years because for the standard measures of comparison. So how are we going to start this particular question? So let's start with your A part, and here it will be calculation of NPV, calculation of NPV, project X. Okay. So how will we do this? First, we need the average cash flows at the end of year one, year two, year three. So year one, two, and three, we need the average cash flows that needs to be discounted at what percentage rate? Then the rate is 10%. So we'll be getting the present value of cash inflows, and from the present value of the cash inflows, what will be your NPV? Your NPV will be whatever is your PV of CI. From that, if I subtract my PV of CO, what I ultimately get is my net present value. Okay. Now, what is your average cash flows? So for year one, it is 30, 50, and 65. So 1 second, but we have to now calculate the average because these are given to you estimated cash flows at different levels of probability, right? So that is why average cash flows, okay, for year one will be based on probabilities, which will be multiplied by the estimated cash flows, and this will give you the average cash flows. Okay. So what are the probabilities? 0.3, 0.4, 0.3. Okay. 0.3, 0.4, and zero point 0.3. What are my estimated cash flows? 30, 50, and 65. So it's 30, 50, and 65. Correct? So this will actually help me to calculate what is the average cash flows. 0.3 into 30, zero point 0.4 into 50, and 0.3 into 65. So this is 48.5. So that is for your year one. Similarly, for year two, probabilities multiplied by estimated cash flows will give me average cash flows. And similarly, for year three also, I'll be getting the average cash flows. And what is the use of this? I will use this for the purpose of discounting and bringing it to the present value terms. So you can now directly calculate on your calci as well. It is 30 into zero point 0.3, then it is 40 into zero point 0.4, then it is 55 into zero point 0.3. So this will be 60. Total will be 41.5 for your year 2. And for your year 3, 30 into zero point 0.3, then 40 into zero point 0.4, then 45 into zero point 0.3. This is 38.5. Okay. So are we having the cash inflows of 48.5, 41.5, and 38.5. Okay. Then what we need to do is we have to discount it and we have to bring it to the present value term. So do we have the discounting factors in the question? No. 1 divided by 1.1 into 48.5. I'm doing it directly. 1 divided by 1.1, multiply that by 41.5. 1 divided by 1.1, 3 times multiplied by 38.5, and the total of this should be coming as rupees 107.31. So I'll take here 107.31, and from this now I will subtract what is my PV of CO. So my PV of CO is 70 lakhs. So this will now give me 37.31 lakhs. Okay. So this will now be 37.31. And now what about your project Y? Okay. Project Y. So now I will take project Y. Now we are going to say that project Y also has a life of 3 years. Okay. And they have given you annual cash inflows, which is 0.2, 0.5 and zero point 0.3. Okay. So I will have the probability of 0.2, 0.5, 0.3. See, only if you'll practice, you'll understand it. And try to practice this along with me as fast as possible. You can also mute me and solve this on your own and then confirm your answers. There are so many multiple ways where you can develop your confidence, right? So what's going to be your expected cash flows? 40 into 0.2, 45 into 0.5 and 50 into 0.3. The total is 45.5. And is this going to be constant on per annum basis? Yes, sir. So we will write down like this. Since cash inflows per annum are constant, we use present value annuity factor. So that is cash inflow per annum into PVAF at how much percentage? At 10% for how many number of years? For 3 years. Will that give me my PV of CI? Yes, sir. So what's your cash inflow per annum? 45.5. Multiply that by PVAF. So this will now be 1 divided by 1.1. 1, 2, 3. Okay. The total of this is coming as 2.4869 multiplied by 45.5. So this will now be 113.15. So here what will be your NPV then? You will take 113.15 and subtract. What's the PV of CO? 80 here. So I'll be subtracting that by 80 to get this as rupees 33.15. Okay. So this was coming as 37.31 and this is 33.15 AX. Okay. Now we are also required to calculate the next thing, and what is that? Standard deviation of the present value. Okay. So now we are required to calculate the B part, standard deviation of projects. Now, see what have they asked you? Calculate the standard deviation of the present value distribution. So what is the present value distribution which we have got? We have got the present value distribution of, can you just check, 107.31 lakhs, right? PV of CI, this one, 107.31 lakhs, correct? And the present value distribution here is going to be 45.5, 45.5 and 45.5. Okay. And now we are required to calculate what is going to be your, risk attached to it. Okay. So standard deviation attached to it. Okay. So now you have to be very careful here because the average is something else and we are required to now calculate what is going to be the risk which is involved to get that particular thing. See here, you can just check the in your project. First I will start with project X. Okay. Now, as per Hiller's model, you are aware about the fact that how will you calculate the risk of the particular project? You will take root of whatever is going to be the variance at year 1 divide by 1 plus discounting factor square plus what is the variance of year 2. You will take 1 plus discounting factor raised to the power 4 plus variance of year 3, and you will take 1 plus discounting factor raised to the power 6. Okay. Okay. So basically now let us start with your variance at the end of year 1, right? Variance at the end of year 1. So to calculate the variance at the end of year 1, we have to follow the same process. We will start with year 1, and then we have a probability of 0.3, 0.4, 0.3. And then we have your X as 30, 50 and 65, right? This is 30, 50 and 65, right? And then what is your X bar? Your X bar is for year 1. Can you just check your X bar is 48.5? So there is no need to calculate this again. Your X bar is 48.5. So what we are going to do is X minus X bar. Then we will take X minus X bar square and we will multiply that by probability. Same thing we are going to do it for year 2. For year 2, now your X will be what? 30, 40 and 55. Okay. 30, 40 and 55. See, all this you can only understand it if you are solving it. If you're just seeing the video, so you will not be able to get this particular part. You have to arrange the cash flows. So I always have a habit of writing down the formula first. So variance of year 1, right? So to calculate the variance of year 1, we have to see that what are the streams of cash inflows for year 1, right? And then prepare the table. Now variance for year 2, for that it will be again the same X and then X minus X bar and then probability into X minus X bar square. And then for year 3, this will be X and your X will be 30, 40 and 45. 30, 40 and 45, correct? And we are having X minus X bar, okay? And then probability into X minus X bar square. So what's your X bar for year 2? Let us just check that out. For year 2, your X bar is going to be 41.5 and this is 38.5. So 41.5 and this will be 38.5. Okay. Chalo. So let us now calculate. This will now be 30 minus 48.5. That is minus 18.5. Okay, I'll square it up here and multiply that by probability of 0.3. So this is 102.675. Then 50 minus 48.5. That is nothing but 1.5. Okay. And I will square it up and multiply that by 0.4. So that will be 0.9. And 65 minus 48.5. So that will be 16.5. And then I will square it up and multiply that by 0.3. So that will give me 81.675. And the total of this is 185.25. So variance at end of year 1 is 185.25. Now let us calculate the same at the end of year 2 as well as at the end of year 3. Correct? Okay. So now again X minus X bar. So 30 minus 41.5. So that is minus 11.5. Square it and multiply that by 0.3. So that is 39.675. Then 40 minus 41.5. Okay, 1.5 negative. I need to square it and multiply that by 0.4. So this will now give me 0.9. And then 55 minus 41.5. square it. Okay, 13.5, you need to square it and multiply that by the probability, which is 0.3. So this will give you 44.675, and the total of this will be 95.25. Okay, so 95.25 for year 3. 30 minus 38.5, so that is negative 8.5. You will have to square it up and multiply that by 0.3. So this will now be 21.675. Then 40 minus 38.5. So this is 1.5. Then you have to square it up, multiplied by 0.4. So this will be 0.9. And then it is 45 minus 38.5. So that will give you 6.5. You need to square it up and multiply that by 0.3. So this is 12.675. And the total is 35.25. Oof. So finally we have the variance for all the 3 years. So now we can calculate the standard deviation. Okay, so root of, now I will take 185.25 and divide that by 1 plus. I think the discounting factor given to you is your 10%, right? So it's going to be 0.1. We have to square it, plus 95.25. I will divide that by 1 plus 0.1 raised to the power 4, plus the last one is 35.25, 1 plus 0.1 raised to the power 6. So this is coming as root of 153.099 plus 34 multiplied by 95.25. So this is coming as 65.06 plus 1, 2, 3, 4, 5, 6 multiplied by 35.25. This is coming as 19.90. So this will be root of 238.05. So around 15.43 rupees in lakhs. So this should be 15.43. Okay. And this will be your standard deviation or the risk for the project X. Okay. Similarly, now you have to calculate for project Y. But for project Y, you have to understand that for project Y, okay, the concept is the same. Year 1, year 2, year 3. X minus X bar. But every year the cash inflows are constant. So can I say for year 1, year 2 and year 3, there is just one need of calculation, only one calculation will be sufficient. So for year 1 to year 3, the risk will be calculated like this. Probability, it has a probability of 0.2, 0.5 and 0.3. So the question looks simple, but it is very tedious to calculate it. So many calculations are there. And why I'm solving it here on the screen is it so that you can get the flow of how to solve the questions. You solve it with me, there's nothing to worry about. Okay, this is the best approach, that if you want to learn how do you calculate the standard deviation of the project using the Hiller's model, when the cash inflows are completely independent of each other. So this is how we solve it. Okay, so we have the probabilities, and also at the same time we have the cash inflows also available. So what are the cash flows, which is 40, 45 and 50. 40, 45 and 50, and here we will term it as X. Then what are we going to do? We'll be taking X bar. So what's your X bar? Your X bar, X bar, X bar is nothing but for project Y, your X bar is 45.5, right? 45.5. So x minus x bar, and then we'll take x minus x bar square, and I will need to multiply that by probability. So what's your x bar? As we have discussed, 45.5. 40 minus 45.5. So this is minus 5.5. Square it and multiply that by probability. So this is 6.05. 45.5. So this is negative 0.5. I will square it and multiply that by probability. So this is 4.5. Square it and multiply that by probability. This is 12.25. So can I say that now, as per Miller, 12.25, divide that by 1 plus 0.1 square plus 12.25, divide that by, because every year now this is going to be the same thing because your cash inflows are constant, right? Divide that by 1 plus 0.1 raised to the power 4 plus 12.25, divide that by 1 plus 0.1 raised to the power 6. Okay. So this is coming as 10.123 plus this is coming as 8.3669 plus this is coming as 6.9148. The total of this is root of 25.4056, and this will be coming as 5.04 lakhs. Okay. So now can I say that I have the NPV also, as well as I have the standard deviation as well. Okay. So I will just summarize this for project X and project Y, right? What is your NPV and what is your standard deviation? So your standard deviation for project Y is rupees 5.04 lakhs, and for your project X is 15.43 lakhs. And what's your NPV? Your NPV is for project Y, it is 33.15, and this is 37.31. Okay. So this is 33.15 and that was 37.31. Okay. Great. Now they have just given you project Y should be selected because its standard deviation is lower. And yes, it makes sense. Project Y should be selected because its standard deviation is lower and its NPV is almost near your project X itself, right? So we will just write down the conclusion. Or else if you want, you can also calculate coefficient of variation as well. And with that also, definitely your answer is going to be project Y should be selected. Okay. So your conclusion will be project Y should be selected because its NPV, because its standard deviation is lower. Because its standard deviation is lower. Okay. Perfect. Sure. Now let's start with our next question. Okay. And that is now your question number 6. Now see, in this particular question, what is specified that Shivam is considering two mutually exclusive projects, Project A and Project B. Project A cost 36,000, Project B cost 30,000. And you have been given below the NPV and the probability distribution. So in this question, we are very lucky that they have given us the NPV for every probability, for every situation. Okay. So if situation 1 occurs, then the NPV is 15,000. If situation 2 occurs, then the NPV is 12,000. Okay. So they have asked you, first of all, what is the expected NPV? So very easily we can calculate the expected NPV, right? Which is going to be the average. Then they have asked you that compute the risk attached, that is standard deviation for each probability distribution. Now we have the NPV estimate. So that is nothing but your X. Okay, we can treat this as your X. And then what is the deviation for each probability distribution? So then we can calculate the standard deviation. And then we will see that what is the deviation of X with X bar. And then what is the profitability index? Now you must have studied earlier. Your profitability index is PV of CI, which I have to divide by PV of CO. So this will give you your profitability index and which project do you recommend. Okay. So how are we going to start? Question number 6. Calculation of expected NPV. Okay. How will you do that? So very simple. We have the probabilities. Okay. And probabilities are different for different projects. We have the NPV estimate as well. And if I multiply this, I'll be getting the expected NPV. Okay. And this is for your project A and this is for your project B. Same concept, probability into NPV estimates, that will give you expected NPV. Okay. What are the probabilities? 0.2, 0.3, 0.3 and 0.2. So 0.2, 0.3, 0.3 and 0.2. And do I have the NPV estimates? Yes. 15, 12, 6 and 3. 15, 12, 6 and 3. So this will give me average. And here the probability is 0.1, 0.4, 0.4, 0.1, 0.1, 0.4, 0.4 and 0.1. And we have the NPV estimates of 15, 12, 6 and 3. 15, 12, 6 and 3. So this will help me to calculate the expected NPV. 3,000, 3,600, 1,800, 600, and the total of this will be 6,000. And let's check for your project B as well. 1,500, 4,800, 2,400, 300. So this will be 9,000. Correct? So actually this is also coming as 9,000 only. Second. 9,000, sorry. So this is also 9,000. Okay, so both the projects have the same NPV of 9,000. Now, what is the second part? Compute the risk attached. Now, risk is your standard deviation. So, calculation of standard deviation of NPV. So, in this question, we have the NPVs available, right? So, we have the estimates. We also have the average. So, how will you calculate this? So, for project A, okay, we have the probability of 0.2, 0.3, 0.3 and 0.2. We have the estimated NPV, okay, which is 15, 12, 6 and 3. 15, 12, 6 and 3. So this will be your X. Then I have to take X minus X bar, right? Then I have to take probability into X minus X bar square. Okay. So what's your X bar? So your X bar is 9,000. So 15 minus 9, that will give you 6, 3, then minus 3, and 3 minus 9 is going to be minus 6. Okay. So let's calculate this. So 72 lakhs. So what is going to be the standard deviation of this part? It will give you rupees 449,449.72. Okay. So this is your standard deviation for your project X4450 अपना आ रहा है 4449.72, which is approximately rupees 4450 itself. Okay. Now similarly for project B, you are going to follow the same process and tell me for project D what is going to be your answer. Okay, you can pause the video and do it. So eventually this should be rupees 1 crore 44 lakhs and you will take the root of it. So you will be getting rupees 3795. This is the standard deviation. Okay. And then you are also required to compute what is the profitability index. So profitability index, that's the third part, PI. So PI we are required to calculate by taking PV of CI upon your PV of CO, correct? And there are two projects, and the two projects are A and B. Okay. So we are having project A and project B, and your PV of CO is 36,000 for A, and it is 30,000 for B. Now, what is your PV of CI? So, can I say you have NPV in the question? NPV is PV of CI minus PV of CO. So, if you have PV of CO and NPV, can we calculate PV of CI? Yes, sir. So, what will be your PV of CI? You take your average NPV and you add the PV of CO to it. Okay. So, what was your average NPV? 9,000. So, you will take 9,000 and add 36,000 to it. So, that will be 45,000, which will divide by 36,000. So, that will be 1.25 is to 1, and here you will take 9,000 and add 30,000. So this will now be 39,000, divide that by 30,000, so that will be 1.3 is to 1. Correct. So now which project are you going to select? So definitely we will select your project A. So project A will be selected because its PI is higher. Profitability index is higher. Okay. And then they have also told you that, you know, the decision will be with respect to the variation in selection. Project B is preferable because of the possible. So here they are telling why project B, because there the standard deviation is lower. Okay. But there is risk higher in project A. So we can write down project A is because PI is higher. But project B, if an investor wants to take lesser risk, okay. So in that particular case, we can say that project B should be selected because its deviation is lower. But actually, just on the base of risk, your project B seems to be much better. But this conclusion is not correct. We should actually take on the base of profitability index. So that is as per your project A. Okay. So that's it regarding this particular part. Okay. Worst case and fine. Okay, students. So let's continue further. Now see, we are starting with your question number 7. What is the data which is given to you? Following are the estimates of the net cash flows and the probability of a new project of Messrs X Limited. We have initial investment and which is 4 lakhs, and there are 3 situations which are given to you, and the probability of occurrence is 0.3, 0.5 and 0.2. Then we have the estimated net after tax cash inflows per year, which is for year 1 to 5, 1 lakh, 1 lakh 10 and 1 lakh 20. And the estimated salvage value is also given to you at the end of the 5th year, which is 20,000, 50,000 or 60,000. Required rate of return from the project is 10%, and we are required to find out what is the expected NPV of the project. So that's the first part. What is the best case and the worst case NPV? The probability of the occurrence of the worst case if the cash flows are perfectly dependent over time and independent over time. Standard deviation and the coefficient of variation, assuming that there are only 3 streams of cash flows which are represented by each column of the table with the given probabilities. Coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. And if the coefficient of variation is found to be less than the average, 100 basis points are to be deducted from cost of capital and should the project be accepted by X Limited. So there are many calculations involved in this particular question. But this question introduces you to a concept of scenario analysis along with your probabilities and NPV. See, apparently what happens is when a CFO is going to estimate the cash inflows, then definitely is not 100% sure. So he attaches probabilities to it. But while making estimates also, he is going to estimate the cash inflows by taking into consideration 3 different scenarios. What are the 3 different scenarios? Worst case scenario, most likely, and the best case scenario. Okay, so it is something like this. Like, for example, if you come from the examination hall and if I ask you that how was your paper and what are your estimates? So then you will tell me, sir, if worst to worst, if the paper checking is very tough, so worst case, I will get 50 marks. Okay, so that's your worst case estimate. Your best case will be what? Sir, if the paper checking is extremely lenient, I'll be getting 70 marks. And the most likely part is what? Sir, I might get somewhere between the two. Okay, like 60 marks. So 50 marks is the worst case, best case is 70, and most likely 60. On the result day, you are going to get something else only. But just in case, if we will estimate something, then we will always keep in our mind worst case scenario, best case scenario, and the most likely scenario. Okay. So worst case is the minimum. So a CFO should know that what is the minimum cash inflows that will be generated from the project. Best case is the maximum, the maximum cash inflows that will be generated, and most likely somewhere between the two. So when they ask you that you are required to calculate the worst case NPV, what are they trying to tell you is that you should take the minimum cash inflows of the estimates and then calculate the NPV based on those minimum cash inflows. When they ask you to calculate the best case NPV, you are expected to take what is the maximum cash inflows and then calculate the NPV based on those maximum cash inflow from project and the salvage. So in this particular question, if you can see, there are 3 streams of cash inflows, right? Where the minimum cash inflow is 1 lakh, maximum is 1 lakh 20, and somewhere between the two is 1 lakh 10. So can I say worst case is this particular situation, right? Worst case. Best case is this particular situation. And also you can see that the salvage is minimum year and the salvage is maximum year. Okay. But if they ask you that you are required to calculate the expected NPV. So how will you calculate your expected NPV? Your expected NPV means NPV on an average basis. And how will you calculate the NPV on an average basis? So you will take into consideration all these estimated cash inflows, which will multiply it by the probability. So if you take the estimated cash flows and multiply that by probabilities, can I say you'll be getting the average common, yes or no? Yes, sir. And here, every year the cash inflows are going to be constant. So for year 1 to year 5, okay, the cash inflows are going to be same. That can be either 1 lakh or 1 lakh 10 or 1 lakh 20. So we can take the average of it and we can calculate the average cash flows. Okay, something which you already know. Salvage also, can I say that is 20, 50 and 60. So if I multiply that by probability, I'll be getting the average salvage. So the first thing we have asked you to calculate is the expected NPV. So can we calculate the expected NPV? So I've already solved this for you. We can calculate the expected NPV. Okay, this is the first part. Okay. Then I will give you some time to take the screenshot of the same. So then you can take the screenshot or then copy it down or pause the video. Okay, but it's extremely easy to calculate it. So these are the probabilities, 0.3, 0.5 and 0.2. And these are the estimated cash flows, which is 1 lakh 10, 1 lakh or 1 lakh 10 or 1 lakh 20. So if I multiply this on an average, I'll be getting the cash inflows of 1 lakh 9,000 per annum. Similarly, for my salvage, I'm having the three estimated cash flows, which is 20, 50 and 60, and multiply that by the probability, I'll be getting the average salvage, which is 43,000. Okay. Now, if I want to calculate the present value, how will I do it? If the cash inflows per annum are constant, then can I say I can take 1 lakh 9,000 and multiply that by the annuity factor, right? So I multiplied that by the annuity factor at the rate of 10% for the 5 years. So this comes as 4 lakh 13,197. And for my salvage, I have to take the PV factor at the end of the 5th year. So that comes as 26,700. And if I sum it up, then my PV of CI is 4,39,897. So there is nothing new in this particular part. And I will take this 4,39,897 and subtract 4 lakh. So I'll be getting the positive NPV of 39,897. So I hope you all have realized that how have we solved this particular part. Very simple concept. We have the estimated cash flows. If I multiply that by the probabilities, I'll be getting the average cash inflow. And because it is on per annum basis, so I've taken estimates at the end of first year on the per annum basis, which can be 1 lakh or 1 lakh 10 or 1 lakh 20. Multiplied that by the probability. So every year it's going to be 1 lakh 9,000 on per annum basis, right? Salvage, same case, but that is only to be occurred only once, and that is towards the end of the project. So this is how you'll be getting the PV of CI, from which you subtract the PV of CO, so you'll be getting your 4 lakh rupees. Your NPV, which is 39,897. Then what is they have asked in the second part that what is the best case and the worst case NPV. So as I've told you that in the best case NPV we should only focus on the maximum cash inflows. So if this situation materializes, then what is the NPV? Okay. So can I say 1,20,000 will be my cash inflows? Yes, and 60,000. So I have taken in best case NPV we will consider maximum cash inflows from the project. So we have taken 1,20,000 and salvage we have taken 60,000. Your cash outflow is 4 lakhs. So based on this, I've calculated my NPV is coming maximum, which is 90 to 150. Of course, it's going to be greater than that 39,000 NPV, which we have calculated because that was on average basis. This is the maximum NPV. Okay. And what about your worst case? So for worst case, we'll be taking the minimum cash flows, right? So what is going to be your minimum cash flows? So you're going to take 1 lakh and 20,000. So 1 lakh and your 20,000 rupees of salvage. So this will help me to get 3,91,498. And based on this, my worst case NPV is going to be negative 8,502. Okay. So a CFO should know that if suppose the projects are not going to work as per our expectations, then the maximum loss which will be generated will be negative 8,502. Okay. Now, what is the probability of occurrence? So in the third part, they've asked you the probability of the occurrence of only worst case. So you can see that the worst case probability of occurrence is 0.3. Okay. But it completely depends whether the cash flows are dependent or independent. Now see, when the cash flows are dependent on each other, what does that mean? Can I say that it means that at the end of the first year, if suppose I'm generating worst case, Okay. If the cash inflows are dependent, if at the end of first year, I'm going to generate worst case, then from second year onwards, I will be generating only worst case cash inflows. Why? Because they are dependent on each other. Okay. So what does dependent means? Dependent means that at the end of first year, if you have incurred worst case, then in the second year, there is no possibility that you're going to earn best case or most likely. You are going to for sure earn worst case cash inflows only. Then at the end of the third year, there is no other possibility because in the second year you have earned worst case. So at the end of the third year also, you are going to earn worst case only. So basically, when the cash inflows are dependent on each other, the probability of occurrence is going to be 0.3. How? Because see, at the end of the first year, it can be anything. It can be worst case, it can be best case, or it can be most likely. Suppose it is worst case, then can I say the probability of occurrence is 0.3? But once this worst case is established at the end of the first year, can I say from the second year onwards, it is going to be for sure worst case. So now there is no probability of 0.3. Now you have to be 100% sure that it is going to be worst case scenario. Okay. Then again, it will be going to be worst case, worst case, worst case. So that is how, if the cash flows are dependent, then the probability of occurrence is 0.3. But when the cash inflows are independent of each other, then in this particular case, if in at the end of the first year, the probability of occurrence for worst case is 0.3, then at the end of the second year also, it can be 0.3 because there is a possibility of best case also. There is a possibility of most likely as well. Okay. The same thing is applicable for third, fourth, fifth year. So that is how the probability of occurrence is 0.00243. So let me just explain to you like this. Let's say, for example, you know, 0, 1, 2, 3, 4, 5. Okay. I am doing a business in which the cash inflows are dependent on each other. Okay. So let's say, for example, if I start with my own practice and worst case at the end of first year, suppose I'm estimating that I'll be getting 10 clients. Now, because this practice industry is example based on word of mouth, and I know that every year the cash inflows or the number of clients will be dependent on what is going to be the number of clients in the previous year. Okay. So if they're dependent on each other, and suppose at the end of first year, I'm estimating that I'm going to get 10 clients. This is my worst case. Okay. The most likely can be 20 and the best case can be 30 clients. Okay. Now, if the cash flows are dependent on each other, then don't you think that in the second year, while estimating the cash inflows, I cannot take the base of 20 and 30. I have to take the base of this 10 only and estimate the cash inflows at the end of the second year. So this is my worst case scenario. So then in this particular case, example, I'm estimating 15 clients at the end of the second year. I might estimate 30 clients. Here I might estimate 40 clients. But now in the second year, there can't be 30 clients or 40 clients. No. Why? Because it is based on my first case. And now if the probability of occurrence of this 10 clients is 0.3, and now the probability of occurrence of this 15 has to be 1 only. Why it has to be 1? Because if this materializes and if they're dependent on each other, then in the second year, I will get 15 clients only. I'm not going to get 40 clients. Okay. Then the probability of occurrence here has to be 1. Then it has to be 1 and so on. But if the cash flows are independent of each other, then I hope you all are aware about this. In this particular situation, if the cash inflows are independent guys, so then you don't have to worry at all. If they are independent of each other, it means that at the end of the second year, I can get 15 clients also, 30 clients also, or 40 clients also, because it is not based on my previous year. So then the probability of occurrence can be anything. It can be 0.3, right? So that is why it's not necessary. I'm not 100% sure that I'm going to get 15 clients only. It can be anything. Okay. So that is why the probability of occurrence is 0.3. So we'll multiply that by 0.3, 0.3, 0.3. So I hope this point is very clear. So I wanted some time to explain you this. So that's why I just solved this first so that, I don't waste your time in just solving also an explanation also. But I hope you all have understood this very thoroughly, that when they are dependent on each other, then whatever is the first year probability of occurrence, if that is decided, then from second year onwards, it's going to be prefixed. Okay. So it's going to be certain. So it's going to be 1. Okay. If they're independent, then every year you have a chance. Okay. Chalo. So with this, we are done with your first 3 parts. Now we can start with the fourth part. So this was something new. So we are into now scenario analysis about your worst case, best case, along with the probability of occurrence. Okay. Now, what is the standard deviation and coefficient of variation? Assuming that there are only 3 streams of cash flows which are represented by the each column of the table, which is with the given probability. So now basically we are required to calculate the standard deviation and coefficient of variation. Okay. See, we have to calculate the standard deviation and coefficient of variation of NPV, right? So by the word NPV, I actually mean what? I mean expected NPV. Okay. Now, you know, the best part in this particular question is there are 3 situations. There are 3 situations. Okay. You have to identify this. What are the 3 situations? That it can be worst case, it can be most likely, or it can be best case. Okay. There are 3 situations. Now, do we have the probability of occurrence of every situation? Yes. What is the probability of occurrence? 0.3, 0.5, and 0.2. Okay. Now, if I have my estimated NPV, then can I say I can calculate my average NPV, right? And guys, just like the previous question which we did, I can keep my estimated NPV as X. My average NPV is X bar. So can I say I can write down here X minus X bar and then take probability into X minus X bar square and take the deviation of it. So can I get the standard deviation of the NPV? Come on, yes or no? Yes, sir. Because I have already calculated my worst case NPV. See, what's my worst case NPV? It is negative 8502, right? So this is negative 8502. So that's my worst case NPV. I've already calculated my best case NPV. So what is the best case NPV? My best case NPV is 90 to 150. Okay, that's my best case NPV. And what is my most likely? So my most likely NPV, I will just need to calculate that because that's the only thing which is pending. So what is going to be my most likely? So for most likely NPV, do I have my cash inflows per annum? Yes, that's 110. And this I'll multiply it by the annuity factor, which I've already written here. And that is 3.7908. So 1,10,000 into 3.7908. So this will be rupees 4,16,988. And this is from your projects. And from your salvage, you'll be getting 50,000, which I will multiply it by the PV factor. And that is nothing but 0.6209. 0.6209. So this will now be 50,000 into 0.6209. So that is 31,045. So this will now be 4,48,033. Correct? So this is my total PV of CI, from which I will subtract my PV of CO, which is 4 lakhs. So I'll be getting 48,033. And what is that? Can I say that's my most likely NPV? Yes, sir. So that is 48,033. Now, can we calculate the average NPV? Yes. And you'll be very strange to know that your average NPV will be coming around this only. That is the expected NPV, which we have already calculated here. In the very first part, that was 39,897. Okay. So it's going to be almost the same thing. Okay. So that will be 8502 negative into zero point 0.3. So that will be negative 2550.6. Then 48033 into 0.5. So that gives you 24,017 and 92,150 into zero point 0.2. That will give you 18,430. And the total of this will be 39,896. Okay. And this was 39,897. Correct? Kither gaya wo? 39,897. Obviously, this has to be the same. Okay. Average NPV. Now, how will you calculate the standard deviation of the project? So we have the estimated NPVs available. Now we can calculate the same. So x minus x bar. So your x bar will be 39,896. Okay. So I will take 8502 minus your 39,896. So this will be negative 48398. Correct. Then the next one will be 48033 minus 39,896. So that will be 8137. Then 92,150 minus your 39,896. So that will be 52,254. Okay. Now 48,398 square, which I need to multiply it by the probability of 0.3. Okay. Also 8137 square, which I need to multiply by the probability of 0.5. And then 92,150. Sorry. Then 52 then 52,254 square, which I need to multiply it by the probability of 0.2. And the total of this will be coming as a very huge figure, 12819111409. And the standard deviation will be the root of this 12819111401, which comes as rupees 35,804. Rupees 35,804. Correct? Perfect. 35,804. So this is your standard deviation NPV. Now, what is going to be your coefficient of variation? Okay. So your coefficient of variation will be, can I say, whatever is your standard deviation NPV, you need to divide that by your average NPV. Correct? So your standard deviation NPV is 35,804. And what's your average NPV? 39,896. So 39,896. So this will now be 0.90897. So I can write down this as coefficient of variation of 0.90. Okay. Now, so are both the parts completed for the fourth thing? Yes, for the fourth sub question, we have completed both the parts. In the fifth part, they have told you that coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. So usually coefficient of variation of X should always be between 0.95 to 1. But if it is found to be less risky than the average, so if it is supposed to be less risky than 0.95 to 1, okay, then 100 basis points are to be deducted from the company's cost of capital. So it is less risky, okay. So can I say in the fifth part, coefficient of variation is 0.90, okay, which is lower than the average 0.95 to 1, correct? So now can I say the project is less risky because lower the coefficient of variation, lower is the risk, okay? So we can say that we consider project to be less risky as coefficient of variation is lower than average. And what are the consequences of this? If the coefficient of variation is lower, then what are the consequences? Can I say the consequences are cost of capital is going to be reduced, right? So what was your original cost of capital? 10%. and we will reduce it by 1%. So what's going to be my revised cost of capital? My revised cost of capital will be 9%. Correct? So how will we calculate the NPV now? So therefore, what will be my revised NPV? So do I have my average cash inflows per annum? Yes, sir. Do I have my average salvage? Yes, sir. So what's my average cash inflows per annum? Just check. My average cash inflows per annum. In the very first part, we had calculated that the average cash inflows per annum were coming as 1,09,000 and this is 43,000. Okay. So now we will take 1,09,000 and multiply that by the PVAF at the rate 9% for how many number of years? 5 years. And this one was 43,000. Multiply that by the PV factor at 9% at end of 5th year. Okay, so let us write down their factors. 1 divided by 1.09, 1, 2, 3, 4, 5. So this is 0.6499 and this is 3.8897. So this will come as 4,23,972 and this 43,000 if I multiply by 0.6499, so this will give me 27,946. The total of this is coming as rupees 4,51,918. So what's going to be your NPV? 4,51,918 minus 4 lakhs. So that will be 51,918. Okay. So this is your final answer. Your NPV is 51,918. So I hope my dear students will have understood this entire question. If you want, then I'll just arrange, I'll just, show you the solution. You can take the screenshot of the same. Okay. So now let's continue further uh, with the next question. Okay. Again, you will see that in this particular question, there are various scenarios. So XY Limited has under its consideration a project with the initial investment of rupees 1 lakh and the probable cash inflows with their probability of occurrence have been estimated as below. So there are 3 annual cash inflows, which is 20,000, 30,000 and 40,000. And we also have the probabilities of 0.1, 0.7 and 0.2. The project life is 5 years and the desired rate is 20% and the estimated terminal values, that is your salvage also, which is given to you. You are required to calculate the probable NPV. Can I say the first basic thing is probable NPV. So we have to calculate the expected NPV. So this is something which I wanted to practice this on your own. We have the annual cash inflows. We'll multiply that by the probabilities. So we'll be getting the average cash inflows, right? And once we have the average cash inflows, we will discount it. Along with that, there are some salvages also. So we are going to attach the same probabilities to it. And the moment we get the average cash inflow from the projects and from the salvage, then ultimately the present value can be calculated, PV of CI minus PV of C, and ultimately the NPV will be calculated. Okay. Then find out the worst case NPV. So for the worst case, we have to take the minimum cash inflows and the best case will be the maximum cash inflows. Okay. And state the probability of occurrence of worst case if the cash flows are perfectly correlated over the time. So perfectly correlated indicating what? That if they are dependent on each other. So for the worst case, the minimum cash inflow is 0.1. So here you will see the answer, which will be 10%, 0.1. That is nothing but 10%. So this is very similar to what we have done. So just practice this particular question on your own regarding your question number 8. And this is your scenario analysis, worst case and the best case part. Okay. Fine. Now, let us start with the next part, and which is with regards to your sensitivity analysis. Okay. Now see, uh, can I put it like this? NPV is actually an outcome of PV of CI minus PV of CO, correct? Okay. And if suppose I want to calculate PV of CI, then my PV of CI comes from cash inflow from projects, and which I need to discount it. Okay, so with the help of the PV factor, I'll be getting the PV of CI, right? And the cash inflow is actually coming from the income statement where we take sales less variable cost, contribution less fixed cost, NPVDT, and so on, right? So my very simple question to you is that if the NPV needs to be calculated, then we will need the data of how to calculate your quantity sold, what should be the selling price per unit, what will be the variable cost per unit, all those things, yes or no? Of course, yes. And if suppose after I calculate the NPV, in real life, when I invest in this particular project, and if only one variable changes, then don't you think that the entire NPV which I had calculated will change, yes or no? And the answer is absolutely yes. So if while estimating, I decided that I'm going to sell the product at rupees 10 per unit, okay? But after making investment in the project, I realized that I am now going to sell this particular product at rupees 15 per unit. Then don't you think that my entire NPV calculations which I had made, that will change? Come on, yes or no? Yes, sir. Or if my CFO tells me, or if my sales manager tells me that we have to sell this product at rupees 5 per unit, then don't you think entire NPV will change? Come on, yes or no? Then the answer is yes. Because NPV is a byproduct of too many calculations. And if any one of the variable on which NPV is based, if that is changed, then don't you think the NPV keeps on changing? Come on, yes or no? Then the answer is yes. So NPV is very much sensitive to all these types of variables, to selling price per unit, to variable cost per unit, to quantity, to fixed cost, to discounting factor, to project life, and also at the same time to whatever is your initial investment, PV of CO. Because all these are your estimates. In real life, when you will be making investment in the projects, there is a great possibility that one thing can change at a time. It can either be selling price per unit, or it can be either variable cost per unit. Anything can change. So on this particular basis, will the NPV having any impact? Come on, yes or no? Then the answer is yes, sir. So as a CFO, you should know that your NPV is sensitive to which particular variable to its maximum. And if the NPV is sensitive to that particular variable to its maximum, then we have to understand that this variable is going to cause maximum risk. And that's why it's forming part of your risk analysis. See, if I put it like this, that I've calculated sales less variable cost, contribution, etc. I prepared the income statement where I took the quantity sold of 10,000 units and I took the selling price per unit as rupees 10. Okay. And let's say, for example, uh, you know, I think that the selling price per unit, if it is 10 and I've calculated accordingly, and if suppose the selling price per unit is now rupees 11, okay, and because of which the NPV has increased by let's say from 1 lakh, it has increased to 1,20,000. Okay. Then can I say NPV is actually 20% sensitive to a change in the selling price per unit? Come on, yes or no? Then the answer is yes. So if I increase the selling price per unit by 10%, then my NPV is sensitive by 20%. If I reduce the selling price per unit by 10%, then it is possible that my NPV will reduce by 20%. Just examples, okay? So, if I change various factors, then can I say my NPV will also change? Okay. Yes or no? Yes, sir. If I change factors, then will my NPV also change? Yes or no? Yes, sir. So if the selling price per unit reduces, then the NPV will also reduce. If the selling price per unit increases, then my NPV will also increase, right? If my selling price per unit, let's say for example, reduces by 10%, then my NPV might reduce by 20%. If my selling price per unit increases by 10%, then my NPV might increase by 20%. Suppose variable cost per unit. My variable cost per unit, if I increase by 10%, now listen to this very carefully. If my variable cost per unit increases by 10%, then can I say it will cause an adverse impact on NPV, right? So now my NPV will fall and it might fall by 15%. If my variable cost per unit reduces by 10%, so this is a very favorable situation, it is very much possible that my NPV will increase by 15%. Okay. So can I say just between selling price per unit and between variable cost per unit, it looks like selling price per unit is more risky because little bit change is having too much of impact on the NPV. So selling price per unit is going to have a maximum impact on the NPV, yes or no? Yes, sir. Similar to that, there can be quantity also. If my quantity is, for example, reduced by 10%, then my NPV might reduce just by 5%. If my quantity increases by 10%, then my NPV might increase by 5% as well. So each and every factor has an impact on NPV. In sensitivity analysis, what we do is we only change one variable at a time and we keep other variables constant. We just change one factor, one variable at a time, and we see that how does the NPV react to that particular variable. And there can be two impacts. It can be adverse also and can be favorable also, right? If selling price per unit is reducing, then the impact on NPV will be adverse. If the selling price per unit is increasing, then the impact on NPV will be favorable, right? It will increase. Similarly, if output is reducing, then the impact of NPV is adverse. It will fall down, correct? If the NPV, if the output is going to increase, then the impact on NPV is going to be favorable. It will rise. So apparently, we need to check that what is going to be the impact on NPV based on these particular changes. What is going to be the favorable impact and what is going to be the adverse impact? Your favorable NPV, your favorable impacts will enhance the NPV, your adverse impact will reduce it. Okay. Now see, what is given to you in this particular question? See, before we start with this, now let us take one question in which it becomes more easier for you to solve. Let's say question number 10. See, from the following details relating to project, analyze the sensitivity of the project to the changes in initial project cost, annual cash inflow, and cost of capital. So we have initial project cost, okay, which is nothing but 1,20,000. Annual cash inflow is 45,000. Project life is 4 years, and cost of capital is 10%. Okay. Now see, the first basic thing you all need to do is we have to calculate what is going to be our initial, your basic NPV. Okay. So question number 10. Calculation of NPV. Now, how will you calculate your normal NPV? Okay. So can I say that there is cash inflow per annum? If I multiply that by PVAF at some particular percentage for how many number of years? For 4 years, then I will be getting my PV of CI. From this, if I subtract my PV of CO, what do I get? Is my NPV, correct? Now, I have my initial project cost, which is 1,20,000, correct? Got it? This is 1,20,000. What is my cash inflow per annum? That is 45,000. Okay. And what is my PVAF at the rate of 10%? Okay. So annuity factors for 10% is coming as 3.169. So this is at the rate of 10% initially. So that is 3.169. Okay. So I have to multiply this by 3.169. So that will give me 1,42,605. So this will now give me 22,605. So this is my base NPV. Okay. My existing NPV. Okay. This is my existing NPV. Now, let's say, for example, in this question, I want to calculate that what is the sensitivity of the project with regards to the changes in initial project cost. Now, let's say, for example, if I want to enhance my initial project cost by 10%. Okay. So I've just assumed like this, that if suppose the initial project cost increases by 10%. Okay. So if initial project cost, okay, first variable is initial project cost. The second variable is annual cash inflow. And the third variable is my cost of capital. Okay. Now, if I increase the initial project cost by 10%, if I reduce the annual cash inflow by 10%, if I increase the cost of capital by 10%, the moment I do this, can I say my NPV will be having an adverse impact, right? You can also take an assumption of favorable. Okay, but for favorable, your project cost should reduce. Then the NPV will become favorable to you. Your annual cash inflow should increase. Then the NPV will become favorable to you. And when the cost of capital reduces, then the NPV will become favorable to you. So let us take this into consideration that if suppose I want to enhance my initial project cost by 10%. So can I say that I will take this 45,000 as it is, but this annuity factor, I'll take it for 11%. Sorry, for 10% because I'm not changing that. Okay. I'm keeping this as 10% only. So this will be 3.169. So this will also be 3.169. So because of which my PV of CI will be 1,42,605. But my PV of CO will now not be 1,20,000. Can I say if this increases by 10%? So what happens is I invest in this project, and the moment I realize that, I've decided to invest in this project, and when I actually go to make investments, the initial project cost has increased by 10%. So 1,20,000 plus 10%. Okay. So this will give you 1,32,000. So can I say apparently my NPV will now become 10,605. So can you see what has just happened? From 22,605, the NPV has reduced to 10,605. So what is your change in NPV? Okay, in rupees. So your change in NPV in rupees will be 12,000. And what is the percentage change in NPV? So can I say that will be 12,000 upon what was my original NPV? 22,605. So this will be 53.09%. So can you just check that your little bit change in your project cost? So if you're just increasing the project cost by 10%, your NPV is falling by 53.09%. Okay. So there is a reduction of 53.09%. No worries. Now let us take the second scenario. If the annual cash inflow is reducing by 10%. So instead of 45,000, now can I say I have to take 45,000 less 10%? Okay. So that is 40,500. Now there is all the other things will remain the same only. Okay. So that will give you 1,28,345. And this will now continue back to normal 1,20,000. Okay. So this is coming as 8,345. Oh my God. So what is the change in the NPV? Can I say from 22,605, now I'm going to 8,345. So there is a reduction of NPV. There is a change in NPV. This is not increase, huh? This is the change. Okay, so change in NPV is 14,260. So what will be the percentage change? 14,260, divide that by 22,605. Okay, so this will now be how much? 63.08%. Oh my God. Can I say now between these two, at least I have understood that NPV is most sensitive to the cash inflow. If I'm just reducing the cash inflow by 10%, my NPV is getting changed by 63.08%. Okay. What about this cost of capital? For cost of capital now, can I say that this particular 45,000 is going to remain the same? Correct. This now I will take it at the rate of 11%. For 11%, they have given you the annuity factor, which is 3.103. Okay. So I will now take 3.103 because 10% plus 10% of 10%, right? So that will be 1%. So that's why 11% is now your cost of capital. Hmm? So by 1%, if it increases, then what is the PV of CI? So from 45,000, if I multiply that by 3.103, so this will ideally give me 1,39,635, and this will continue to remain 1,20,000. So this will be 19,635, and this will now be 9. What's the change in NPV? 2,970. Okay, so NPV is least affected with the cost of capital. Okay, so my NPV just gets reduced by how much? So it gets reduced by 13.14%. So can I conclude like this? NPV is most sensitive to cash inflow per annum because if cash inflows per annum are reduced by 10%, NPV is reduced by 63.08%. Okay. Now see, they have solved it like this. Alternative solution. Can you see that if initial outlay is increased by say 10%, then the NPV will decrease by 32.22%. One second. This was your customer 10 only, right? 10, 10, 10. Okay, this is your 9th. Okay, this is your 10th question. See, student may please note that they may assume any other percentage other than 10%, say 15, 20. So we have understood on the basis of 10%. So can you just see it is 53.08%. Okay. Then for the next case, it is 63.08 and 13.17. So it is more sensitive to annual cash inflow. So that is how we can calculate it by assuming any 1% change, and based on that we can judge that NPV is more sensitive to which particular factor. Okay, great. Now, for this question number 9, okay, okay. Now see, in this particular question, again, what they have told you that XYZ is considering for a project for which the estimates are available. There is initial project cost, which is 10 lakhs. We have the selling price per unit, we have the variable cost per unit, and we have the volumes available for 3 years, and every year the volume is different. Discount rate is 10%. You are required to measure the sensitivity in respect of selling price per unit, unit cost, volume, outlay, and project lifetime. So again, we can follow the same method. We can calculate first our normal NPV, okay, based on 10% discounting factor. And we have to measure the sensitivity, right? So we can just change any one of the variable at a time by considering 10%. Okay, so that's what even institute has done in the alternative solution. You can take 10% or you can take any other percentage as well. But let us say, for example, okay, there is an adverse variance of 10%. So what we will do is that the selling price per unit we will reduce by 10% and we will see that what is the impact on the NPV. Unit cost, we will increase it by 10% and we will see what is the impact. So this will lead to your faster calculations. Your sales volume, if suppose we reduce it by 10%, then what is going to be the impact? Initial outlay, if I will increase it by 10%, and what is going to be the impact? And for project lifetime, I'll tell you what we have to do. Okay. See, now when it comes to, first of all, your selling price per unit. Okay. So let us start here. Solution to now question number 9. Okay. So write down calculation of NPV and its sensitivity. I'll show you both the ways. Okay. But this one is much more easier and simpler. So first we will start with this particulars. Okay. And now see, uh, here the outputs are different. So I will not be able to do it on per annum basis. So we will first calculate existing NPV. Okay. Existing NPV. So for existing NPV, what is our basic formula? PV of CI minus your PV of CO. Will that give you NPV? Yes, sir. Okay. Now, what is your PV of CO? 10 lakhs. So I will take just simply 10 lakhs. So there is no worry about this. And PV of CI ke liye, I have to now prepare one table because there is your 1, 2, and 3. Okay. So your 1, 2, and 3. We'll have to take sales. Okay. Minus cost. And we have given you this will be your contribution. But apparently there is no fixed cost, right? In this particular question, there is no fixed cost and no other data is given to you. So this itself will be your cash inflows because there is no depreciation, tax rate, nothing. Okay. Taxation may be ignored. Okay. So this itself will be your cash inflows. So how will you calculate your sales? So for the first year, it will be 20,000 into 60, right? So that is going to be 12 lakhs. Okay. And your variable cost will be 20,000 into 40. That is 8 lakhs. So this will now be 4 lakhs cash inflow at the end of first year. What about the second year? 30,000 into 60. That is 18 lakhs. And what's your variable cost? 30,000 into 40. 12 lakhs. So this will now give you 6 lakhs. Third part is 30,000 into 60. That will be 18 lakhs. And this will now be again 30,000 into 40. So that will be 12 lakhs. So this will again be 6 lakhs. Okay. So I need to just discount this at what percentage rate? So the rate is 10%. So we'll be getting the PV of CI. Okay. So do you have the PV factors in the question? No. 1 divided by 1.1, 1, 2, So this will be 0.9091, 0.8264 and 0.7513. Correct? So this will now be 4 lakh into 0.9091. So that will give you 3,63,640. Then 6 lakh into 0.8264. So this will give you 4,95,840 and 6 lakh into 0.7513. So this will give you 4,50,780. The total of this should be coming as 13,10,260. What will you do? You will substitute here 13,10,260. So your NPV positive will be 3,10,260. So this is my expected NPV. It is 3,10,260 without any changes. But if suppose I am changing selling price per unit, okay, so A part. So what am I doing in A part? We are reducing selling price per unit reduced by 10%. So that is, it will now become how much? It was earlier 60. So this will now become 60 minus 10%. So that will become rupees 54. Correct? So what will be my NPV in this case? So what will change is my sales. Okay. So my sales less cost will give me contribution or my cash inflows, which I will multiply by the discounting factor. So I'll be then getting my PV of CI. Okay. So in this particular case, what is going to be my sales? Okay. So your sales is going to be 20,000 units. Okay. Multiplied by 54. So that will be 10 lakh 80,000. Okay. Then once again, 30,000 units multiplied by 54. So this will be 16 lakh 20,000. And then this will also be 16 lakh 20,000. Okay. So quantity sold, I'm multiplying it by the selling price per unit. What about the cost? Is the cost going to change? No. So this will continue to be 8 lakhs, 12 lakhs and 12 lakhs. Correct? So this will now give me what is going to be my cash inflows, 10 lakh 80,000 minus 8 lakhs. So this will be 2 lakh 80. Then 16 lakh 20, I will need to subtract it by 12 lakhs. So this will now be 4 lakh 20. And this will also be 4 lakh 20. And what is my annuity factor? It's 0.9091, 0.8264 and 0.7513. So 2 lakh 80 into 0.9091, then 4 lakh 20 into 0.8264, then 4 lakh 20 into 0.7513. So this comes as total 9 lakh 17,182. And what was my PV of CO? My PV of CO was nothing but 10 lakhs. So now my NPV is how much? Negative 82,818, right? So this is my NPV. So what is going to be my percentage change? So my existing NPV was 3,10,260. Correct? Then what is my NPV here? It is negative 82,812. So can we see that the change in NPV, okay, will be So for change in NPV, what will I do is I'll take negative 82,812 and minus 3,10,260. So it is negative 3,93,072. Correct? Because this is positive and this one is my existing and this is my new NPV, adjusted NPV. So I will have to take 82,182 negative minus 3,10,000, right? So my change in NPV is 3,93,072. So this 3,93,072, if I divide it by 3,10,260 into 100, now how much is the percentage change? So it's coming as 126.69%. So can I put it like this? My NPV, if I'm just changing this by 10%, okay? If my NPV, I'm just changing this by 10%, you all can see that there is a decrease of 126.68%. The NPV reduces by 126.68%. Okay, perfect. So this is my first part. So NPV is sensitive by this much. Okay, so if selling price per unit reduces by 10%, then NPV falls by 126.69%. What is going to be my second case? My second scenario. My second scenario will be variable cost per unit. Okay. Now what do I have to do? I have to increase the variable cost per unit by how much percentage? By 10%. Okay. Now what are the consequences? Okay. So can I say my sales less cost will give me my contribution, which is my cash inflow, which I'll multiply that by discounting factor to ultimately get my PV of CL. Correct? My sales will now be again the original part, which is 12 lakh, 18 lakh, and 18 lakh. Okay, so that's not going to change. 12 lakh, 18 lakh, and 18 lakh. Okay. But what will change will be now my variable cost. Okay. So my cost is increasing by 10%. So how much was my old? 40. So now this will become 44. So 20,000 into 44. So that will be 8 lakh 80. Okay. Also 44 into 30,000. So that is 1 lakh 30. So that's going to be 13 lakh 20. And this will also be 13 lakh 20. So this will now be 12 lakh minus 8 lakh 80. So this will now be 3 lakh 20. 18 lakh minus 13 lakh 20. So this will now be 4 lakh 18. And this will also be 4 lakh 18. And what is going to be my PV factor? My discounting factor is at the rate of 10%. So these are going to be the same 0.9091, 0.8264 and 0.7513. So 3 lakh 20 into 0.9091. So 4 lakh 80 into 0.8264, 4 lakh 80 into 0.7513. So this will now be 10 lakh 48,208. So from this I will subtract 10 lakh PV of CO. So this will now be 48,208. 48,208. Correct? Now what has happened to my NPV? So what was my existing NPV? My existing NPV was 3,10,260. And what is my new NPV? That is 48,208. So you all want to check how much it has reduced. 48,208 minus 3,10,260. 48,208 minus 3,10,260. So that is coming as 2,62,052. Correct? So what is going to be now the percentage change? So it will be negative 2,62,052 with the original, which was 3,10,260. So there is a reduction of somewhere around 84.46%. Okay, so 84.46%. Now, what is going to be my third case? My third case will be reduction in sales volume. Okay. So in this particular case, for year 1, year 2, year 3, now my quantity will be, okay, I have to reduce it by 10%. So this was 20,000, so it will become 18. This one is 30,000. So this will now become 27 and 27,000. What is going to be your selling price per unit? So can I say that I can directly take my contribution per unit, right? Which is selling price per unit, that was 60 and this was 40. So that's not going to change. So that will be 20. So will I get now contribution or cash inflow? Yes, sir. 18,000 into 20, 3,60,000. 27,000 into 20. So that will give me 5,40,000. This will also give me 5,40,000. So this will be multiplied by 0.9091, 0.8264 and 0.7513. So this will now give me my PV of CI. So the total year will be 11,79,234. So from this, if I subtract 10 lakhs, so this will now give me 1,79,234. And guys, ultimately, what is going to be my change? So my old NPV was, how much is it? 3,10,260. So 3,10,260 means I have to now subtract 179,234. So the reduction is 1,31,026. So 1,31,026, I need to divide it by 3,10,260. So you will come to know that there is 42.23 percentage reduction. So till now, who is winning? NPV on the basis of what? On the basis of your, uh, you know, till now, selling price per unit. So NPV is more sensitive till now for the selling price per unit. And then what's the fourth part? So in your fourth part, we have to make some changes in the volume. Okay. So what is going to be my initial outlay? Okay. Initial outlay. So initial outlay. Now let me increase that by 10%. So my PV of CI will be as it is, that is 13 lakh. What was your old one? 13 lakh 10,260. So this will be 13 lakh 10,260 only. But my PV of CO will now be 10 lakhs. Oh, sorry, 11 lakhs. Because I'm increasing that by 10%. Correct? So this will now become 11 lakhs. So what is now going to be my NPV? That will be 2,10,260. So this is 2,10,260 and my NPV is 3,10,260. So basically you can see that 1 lakh rupees say your NPV has reduced. So 1 lakh upon 3,10,260 into 100. So that is 32.23%. Okay. So your NPV is reduced by 32.23%. Now what is going to be the next case? The next case is my project lifetime. Okay. Now for project lifetime, now, what I want you to do is, I want you to calculate what is the discounted payback period. Okay, what is the discounted payback period? Can I say discounted payback period is the time period in which your PV of CI will be equal to your PV of CO, right? So PV of CI should be equal to your PV of CO. Okay, so a discounted payback period. So we have year 1, 2, and 3. And do we have the PV of CIs available at your discounting factor? Yes. 363, 640. Okay. Then 495, 840. 363, 640. Then 495, 840. And the last one was your, how much was it? 450, 780. 450, 780. Okay. This is the PV of CI. So in how much time period your PV of CI will be equal to PV of CO? So first we have to calculate cumulative cash inflow. So this will be 363, 640 itself. Then this will be 363, 640 plus 495, 840. So that will be 8,59,480. 480. And to this, if I add 450, 780, of course, I will get 13,10,260. Correct? So can I say my 10 lakh is recovered somewhere between second and third year? So 2 years plus something. So what I need to do is now I have to find out what is going to be my, that interpolation part. So in the third year, in that 1 year, you are recovering 4,50,780. Okay, now this is something which I expect you all know. So we have recovered up to 859,480. Now I have to recover 10 lakhs. So in that 1 year, my PV of CI is 450,780, but I don't have to recover this much. Can I save? From 10 lakh, I have already recovered 859,480. So how much I have to further recover it? 10 lakh minus 859,480. So I want to further recover 1,45,20. So for this, what is the time period required? So for this, the time period required will be 0.31. So the total comes as 2.31 years. Okay, 2.31 years. So basically what happens is you should at least run the project for 2.31 years. Okay. So if I reduce the project lifetime by 10%, okay. So if we reduce project lifetime by 10%, then project will run for, how much? Can I say 3 years minus 10%? So 3 years minus 10%, that is 2.7 years. Okay. But break even point is 2.3 years, 31 years, right? So can I say if you are running for 2.31 years, your PV of C and PV of CO both are going to be the same. Okay. So at 2.31 years, PV of CI will be equal to PV of CO. Okay. At 2.31 years. You got it? Okay. Now, can I say that NPV is not going to be negative until unless you run the project below 2.31 years? So NPV is going to be positive. So this is not going to have much impact, okay, on the sensitivity of the project. So our conclusion will be what? Our conclusion will be NPV is most sensitive. NPV is most sensitive to selling price per unit. Obviously, because there the NPV is becoming negative, correct? So NPV is most sensitive to what? Selling price per unit. Okay. So you can calculate it like this, your discounted payback period. Fine. Okay, students. So welcome back. Now let us start with the next question. See what is given to you. Red Limited is considering a project with the following cash flows. So we have year 0, 1, 2. We have cost of the plant. Then we have our running cost and the savings is given to you. And then they have told you that the cost of capital is nothing but 9%. And we are required to measure the sensitivity of the project to changes in the levels of the present value, running cost and savings, considering each factor at a time, such that the NPV becomes zero. And the present value factor at 9% RS under for year 0, 1 and for year 1 and year 2 they have given to you, and which factor is the most sensitive to affect the acceptability of the project. Now see, what is given to you is that the cost of the plant is nothing but 10,000 rupees. So when we are making our investments today, then can I say 10,000 rupees is something which we are going to spend, so its present value is also going to be 10,000. Now we have running cost and we have savings. There is no data which is given to you regarding your taxation. There is no data given to you regarding your depreciation. So basically from the savings, if I subtract my running cost, what will I get is the net savings. And that will be my cash inflows at the end of first year and the cash inflows at the end of the second year. But that is in future value terms. So we will discount it, we will get it into present value. See, the first step to this particular question is that first let us calculate the NPV. Okay, so let's do that first. So go to your notebooks and write down. This is now your solution to question number 11. Write down. Calculation of NPV. So to calculate the NPV, what do we need? PV of CI minus PV of CO. Okay. Now we are having year 1 and year 2. Okay. Can I say we are having savings? Yes, sir. Okay. Now let us do one thing. Instead of directly taking savings minus running cost, first let us calculate what is the present value of savings. And from that, let us calculate what is the present value of running cost and let us subtract both the things. Okay. Why? I'll explain you just in some time. But for the timing, you remember that we have our savings available. See, one of the approaches what? Our orthodox method is we take the savings, we subtract the running cost, we'll be getting the net savings, right? And then once we get the net savings, what do we do? That is in future value terms, we will discount it, we will get it into present value. Okay, so that is one of the approaches. So from savings, if I multiply that by the discounting factor at the rate of 9%, what do we get is the present value. So this is my present value of savings. Okay. Similarly, if I have the running cost, okay, if I multiply that by the discounting factor at the rate of 9%, what will I get is the present value of the running cost. So how much is my savings? 12,000 and 14,000. 12,000 and 14,000. What is my discounting factor? 0.917 and 0.842. Okay. So then I'll be getting the present value. That will be 11,004. This is 14,000 into 0.842. 11,788. This is 22,792. What is the running cost? Your recurring cost is 4,000 and 5,000. Okay. And my discounting factors will be the same 0.917, 0.842. So this will be 4,000 into 0.917, 3668. And this is 5,000 into 0.842. So that is 4210. That is 7878. Now, what will be my present value of cash inflows? So that is 22,792 minus 7878. That will be 14,914. So is this your present value of cash inflows? Come on, yes or no? Yes, sir. Okay. So similarly, again I'm repeating, if you take 12,000 minus 4,000, 8,000, multiply that by the discounting factor, will be getting the present value. Same 14,000 minus 5,000, 9,000, will be multiplying that by the discounting factor, will be getting the present value. And then that will be your PV of CI, which is going to be the same part, 14,914. But here, because we have to calculate the sensitivity in such a way that the NPV should be 0, so that's why I've done it like this. Okay. So I've taken the future value of savings, multiplied that by the discounting factor. I got the PV of savings. I got the PV of running cost. And then from the PV of savings, if I subtract the PV of running cost, what do I get is my PV of CI. Okay. Now, what is your NPV? So your NPV will be PV of CI minus PV of CO. So that is 14,914. From this, if I subtract 10,000, what do I get is 4,914. So is my NPV available as 4,914? Come on, yes or no? Yes, sir. Okay. Now you all can just check that they have told you measure the sensitivity of the projects to the changes in the levels of plant value, running costs, and savings, considering each factor at a time, such that the NPV becomes 0. Okay. Now I want to make the present value 0. How can I make the present value 0? See here right now my NPV is 4,914. If I want to make this 4,914 0, then can I say the first step is I have to increase my running cost. Okay. If I increase the running cost, then my NPV can be 0. If I reduce my savings, NPV can be 0. If I increase my plant cost, my NPV can be 0. The most easiest is, let's say for example, if I increase the plant value. Okay. Now, see, the first part is, if plant value is increased, then NPV will be 0. Do you guys get this? If the plant value increases, then the NPV is going to be 0. Okay. Now see, you all can just check that the plant value here is 10,000. If I increase the plant value by 4,914, then don't you think that the NPV can be 0? Come on, yes or no? Yes, sir. So my plant cost is right now 10,000. Okay. And then if I increase the plant value by 4,914, then can I put it like this, that the NPV will be 0, right? So in this particular case, by how much percentage I have to increase the plant value? So 4,914, if I divide that by 10,000 and multiply it by 100, can I say this will be 49.14%? So guys, if I increase the plant value by 49.14%, will my NPV be 0? Come on, yes or no? Yes, sir. Similarly, if my present value of running cost is increased, then can I say the NPV will be 0, right? So if I increase the present value of running cost, you guys can just check that do I have the running cost? Yes, sir. Now see, what is the advantage? I've already calculated its present value, 7878. Now, if this present value of 7878 is increased by present value of 4914, then what do you think will happen to the NPV? Will the NPV be 0? Come on, yes or no? Yes. Okay. So that's why I calculated the present value of running cost. See, what is my PV of running cost right now? My PV of running cost is nothing but 7878. Okay. Now, to make the NPV 0, can I say my present value of running cost should rise? Because if my present value of running cost will rise, then my NPV will be 0. So can I put it like this, that PV of running cost should be increased by rupees 4914, then NPV will be 0. Correct? So by how much percentage it is going to increase? So can I say 4914 divide by 7878 into 100? So 4914 divide by 7878. So this will now give me around 62.38%. So when the present value of running cost increases by 62.38%, then what are the consequences? Can I say the NPV can become 0? Come on, yes or no? Yes, sir. Okay. And then what is the third part? What is going to be the sensitivity in terms of your savings? Then can I say if my PV of savings will fall, then my NPV can also become 0? Yes or no? Yes, sir. So if PV of savings is reduced, then NPV will be 0. Okay. So can I say I have my existing PV of savings? What's my PV of savings? So my PV of savings is 22,792. Okay. Now to make the NPV 0, right now the NPV is 4914. I want to make that NPV 0. Then can I say I have to reduce my PV of savings by 4914? So to make NPV 0, we need to reduce PV of savings by rupees 4914. So can I say I will take 4914 and I will divide that by 22,792 into 100. The moment I do this, can I say by 21.56%. So if my PV of savings is reduced by 21.56%, what are the implications? Can I say the implications will be NPV will be 0, right? See, you all can just check it like this. Your PV of CO is 10,000. So if I increase that by 49.14%, so 10,000 plus 49.14% will become 14,914. From 14,914, if I subtract 14,914, NPV will be 0. If I want to have the PV of running cost, right? So PV of running cost, if suppose if I increase that by how much percentage? 62.38%. So if I take 7878 and if I add my 62.38%, and then if I subtract the PV of CI, which is PV of savings, ultimately my NPV is going to be 0. Okay, if I take PV of CI and then if I subtract that by PV of CI, ultimately my NPV is going to be 0. Same thing happens with my savings as well. So I have my PV of savings, which is 22,792, right? If I reduce that by 21.56%, then if I subtract the PV of running cost and then my PV of cash outflow, ultimately my NPV is going to be 0. So, cut to this particular concept that whenever you want to make NPV 0, what you should do? Whatever is the PV of running cost, whatever is the PV of savings, whatever is the PV of cash outflow, first determine that. And then whatever is the NPV, right? You have to just make the adverse changes to it. So by how much percentage we have to increase or decrease so that you can come to know that the NPV is sensitive to how much impact. Now the best part of this particular question is, if you want to know that which of the three variables has maximum sensitivity, then you can just check like this, that if your plant value, right, if it is increased by 49.14%, then the NPV will become 0. Your running cost, if it is increased by 62.38%, then the NPV will become 0. If your PV of savings, if it is reduced by 21.56%, the NPV becomes 0. Can I say the NPV is most sensitive? Hold your breath. The NPV is most sensitive to savings, because just by reducing 21.56%, the NPV becomes 0. So this is very different from what we have done earlier. Earlier, we used to say that what is the percentage change in NPV. Here, we are not saying that. Here, we are saying by how much percentage we are changing the variables, the NPV is getting affected. So the NPV is getting maximum affected by the savings part, because just little bit change in PV of savings, then the NPV will become zero. So NPV is more sensitive to what? NPV is most sensitive to savings and not running cost. Okay. So when we are following this method, that how much percentage changes we have to make to different variables in such a way that the NPV becomes zero. So here the conclusion lies that the NPV is most sensitive to the savings part. Okay. So I will write down here conclusion. NPV is most sensitive to savings because if we reduce the savings by 21.56%, NPV will be zero. Got it, everyone? Okay. Chalo, nice. Okay. So now, what is given to you in the next question? The easygoing company limited is considering a new project with the initial investment uh, for a product survival, and it is estimated that the IRR of the project is 16%, having an estimated life of 5 years. And the financial manager has studied the project with the sensitivity and informed that the annual fixed cost sensitivity is 7.8416%, whereas the cost of capital, the discount rate sensitivity is 60%. Other information available are, we have the profit volume ratio, which is 70%. Then we have the variable cost, which is rupees 60 per unit. Then we have the annual cash flow, which is 57,500. And then they have told us to ignore the depreciation on the initial investment and the impact of taxation. You are required to calculate what is the initial investment of the project, what is the NPV, what is the annual fixed cost, estimated annual unit of sales, break-even units, and then we have the cumulative discounting factor for the period of 5 years also, which is available. Okay. Now, this is the data. First, let us see that what information do we have in your question number 12. They have told you that the IRR is 16%. The life of the project is 5 years. And then they have told you that the annual fixed cost sensitivity, okay, annual fixed cost sensitivity is nothing but 7.8416%. And what is the cost of capital discount rate sensitivity? Okay, so cost of capital sensitivity, mind you, guys, this is not the discounting factor, but this is the sensitivity, which is 60%. Okay, so what do I mean by this? Fixed cost sensitivity and cost of capital sensitivity means if we increase the fixed cost by 7.8416%, then the NPV will become zero. If we increase the discounting factor by 60%, then the NPV will become zero. Okay. So what does this mean? That if we increase it by 7.8416%, then the NPV will turn out to be zero. And if the cost of capital is increased by 60%, then the NPV will become zero. See, very similar to what we have done here. Can you just check? Here, if the plant value is increased by 49.14%, then the NPV becomes zero. If the running cost is increased by 62.38%, then the NPV becomes zero. Here also, when we talk about annual fixed cost sensitivity, it means that if we will increase it by 7.8416%, then the NPV will become zero. Okay. Now, we have the PV ratio, which is 70%. So PV ratio is your 70%. Then we have the variable cost, that is rupees 16 per unit. And then we have the cash inflows per annum, which is rupees 57,500. Okay. There is no depreciation and no impact of tax. So first part is we are required to calculate the initial investment of the project. Okay. So the first part is calculation of initial investment. So initial investment, can I say it's also nothing but PV of CO? All right. So how will we calculate the present value of cash outflows? Now for this, you all can just check. Do you have the IRR in the question? Yes, sir. We have the IRR, that is 16%. Can I say that at IRR, your PV of CI is equal to your PV of CO? Okay. So at IRR, PV of CI is equal to PV of CO. Okay. So do you have your cash inflow per annum? Yes, sir, which is 57,500. Multiply that by the discounting factor at 16%. Okay. For 5 years, we will be getting PV of CI. So what's your cash inflow per annum? 57,500. Multiplied that by the discounting factor at the rate of 16%. Okay, so we already have this as 3.274 and this will be 57,500 into 3.274. So that is 1,88,255. And at IRR, your PV of C and PV of CO both are same. So therefore, your PV of CO is equal to 1,88,255. With this, our solution to the first part is now over. Then what is the NPV of the project? Of course, now they are not talking about the NPV at IRR because NPV at IRR is obviously zero. So what is the NPV of the project? And for that, you know that here they have told you that the sensitivity is 60%. Okay. Now see, listen to this very carefully. Okay. See, we are required to calculate NPV. So for NPV, we need PV of CI minus PV of CO. Do I have the PV of CO? Yes, sir. I need PV of CI, which is cash inflow per annum, which I need to multiply it by the discounting factor at whatever is my cost of capital and for the period of 5 years. Now, in this particular case, you have to understand that your cash inflow per annum into PVAF at some particular percentage for 5 years. Will this give you PV of CI? Yes, sir. And what's your cash inflow per annum? It is 57,500. If I multiply that by the annuity factor, then I will be getting PV of CI. But I don't know what is this cost of capital. But I know the sensitivity, that the sensitivity is 60%. Now see, if I give you roughly an example like this, that if my cost of capital is 10%, and then if I tell you that it is 10% sensitive, okay, at which the NPV becomes zero, then can I say that you will add 10% to it and then ultimately you'll be getting 11%, right? So basically what happens is we take 10% of 10. So if we just add the cost of capital by 10%, so it's not 20, huh? So if my cost of capital is 10%, and if suppose my sensitivity factor is 10%, what does that mean? That cost of capital is 10%, and if I add it by 10%, then it will become 11%. At 11%, the NPV becomes zero. All right. So here also, if my cost of capital is 10%, okay, and 10% of 10, if I add it, then this becomes 11. Now, 11% is the rate at which the NPV becomes zero. So what is this 11% rate called? It is actually called as your IRR, because IRR is actually the rate at which PV of CI is equal to PV of CO. All right. So what is IRR? IRR is the rate at which my PV of CI is equal to my PV of CO. So 11% is the rate at which my PV of C and PV of CO both are same. Okay. Now coming back to this question, can I say that we already have the IRR? What is the IRR? 16%. Okay. So my IRR is 16% and the sensitivity factor is 60%. Okay. So what do you think should be my cost of capital? Okay. So can I say 16 minus x upon x. Okay. If my NPV has to be 0, then can I say that suppose my base is, like example, 20%. Okay, example 20%. So 20% plus 60% gives me the IRR percentage, right? So I have the IRR percentage. From that, if I subtract whatever is the sensitivity, then I'll be getting my cost of capital. So similarly, if I want to know that how much percentage this cost of capital sensitive is, then what will I do? I will take 16 minus x upon x, because I know that this much is giving me a sensitivity of 60%. So what will be the answer for the same? Okay. So this will now become uh, let me do it like this. Uh, see, 16 minus x upon x is equal to 60%. Okay. So that will be 16 minus x upon x is equal to zero point 0.6, right? So 16 minus x is equal to 0.6x. So 16 will be, this will now go here. So 1.6x. So your x will be 16 divided by 1.6, and that's nothing but 10%. Okay. So eventually, what is your cost of capital? Now you have got your cost of capital as your 10%. Okay. So obviously, if I take 10%, if I add 60% of 10 to it, then ultimately, can I say I'll be getting nothing but 10% plus 6%. So that will be 16%. So that was your IRR. Okay. So this is how the IRR is calculated. So basically, what we have to do is 16 minus x. So let the cost of capital be x. Okay. So by how much percentage, if it is increased, then the NPV becomes 0. So I've taken the cost of capital as x, and instead of 60 now, we have to take 60% and do it accordingly. So this is how you'll be getting your cost of capital as your 10%. Okay, and the moment I got this as 10%, do I have the annuity factor available? Yes, sir, 3.791. Okay, so this will now be 57,500 into 3.791. So that is 2,17,983. This is my PV of CI. So can I calculate the NPV? Yes, sir. Therefore, what is your NPV? PV of CI minus your PV of CO. So that is 2,17,983, from which I will subtract what is my PV of CO. My PV of CO is we just now calculated 188,255. So this will now give you 2 lakh 217,983 minus 188,255. So that is 29,728. So that's your NPV. Then we are required to calculate what is the annual fixed cost. Okay. Third part. Calculation of annual fixed cost. How will you calculate your annual fixed cost? Now see, you all can just check here that the annual fixed cost sensitivity is 7.8416%. Okay. What do we mean by this? That if suppose I increase the fixed cost by 7.8146%, then can I say my NPV will become zero? It means that my NPV will be reduced by 29,728. Okay. Because whatever is my fixed cost, suppose my fixed cost is example 1 lakh. Okay. Example. If I add 10% to it, example, so this becomes 1,10,000. Correct? So if my NPV is 1,10,000, then can I put it like this? See, just by adding 10%, we are getting the NPV as zero. Okay. So in this particular question, we have this sensitivity factor available and we want to reduce this particular NPV. So let us put it like this. If fixed cost is increased by how much percent? 7.8416%, then NPV becomes zero. Correct? Then the NPV becomes zero. So we have to reduce the NPV by how much amount? 29,728. So if I increase the fixed cost by 7.8416%, then can I say my NPV gets reduced by 29,728? Come on, yes or no? Yes, sir. Okay. So what is my 10% PV factor? 3.791. Okay. So let us put it like this. Mm, reduction of NPV by 29,728. Okay. So what is the increase in present value of fixed cost? Okay. That will lead to reduction of NPV. So we don't have the original fixed cost, but at least we know that 29,728, you know, this is the NPV which I have to reduce it. So by what is the percentage change in that fixed cost? So let us put it like this, that change in fixed cost is X. Okay, so this will be X into at 10%, what is the factor? 3.791. 3.791. So this becomes zero. Okay, so if I have the present value of increase in the fixed cost available, then I will come to know that 29,728 minus this particular present value will give me the NPV 0. So basically this will now be 29,728 minus 3.791x is equal to 0. So 29,728 is equal to 3.791x. So your x is 29,728. Divide that by 3.791. So that is coming as rupees 7841.73. So what is the meaning of this is that if suppose I increase the fixed cost by 7841.73 in PV terms, okay, then what will happen is my NPV will be 0. Then my NPV is going to be 0. So this 7841.73, if I increase the fixed cost in PV terms by 7841.73, then can I say that my NPV can become 0? Yes or no? Yes, sir. Okay. So do I have the percentage change available? Yes, the percentage change is already given to you, 7.8416. So if I have change in fixed cost, okay, that is 7841.73. And if I have change in fixed cost percentage, that is 7.8416, then can I say, if I can just simply take 78417 1.73 and divide that by 7.8416%, So divide that by 7.8416%. So this will give me 1 lakh rupees approx. So this is my annual fixed cost. So whatever is my annual fixed cost, I've got this on per annum basis. Okay. So ultimately you have to understand this. To reduce the NPV by 29,778, you have to understand like this, that my fixed cost in present value terms should increase by 29,728. Okay, so that's why I've written here increase in PV of fixed cost should be by 29,728. Only then my NPV will reduce by 29,728. So I have taken here 29,728. This is the amount of the NPV which I have to reduce minus change in fixed cost. So what is that change in fixed cost amount? Because I have the sensitivity factor available with me. So I have to see that what is the PV of sensitivity. So that's why I've assumed that as X into 3.791, this is equal to 0. So the moment I do this, I come to know that my PV change is 7841.73. So I have the PV factor change also in percentage term. I have this PV change also. Then accordingly, I'll be getting this as rupees 1 lakh. Okay. Now, what is the estimated annual unit of sales? Now I have to calculate calculation of annual unit of sales. So sales less variable cost, what do you get? Contribution less fixed cost, what do you get? Your profits before depreciation tax, but here there is no depreciation, no impact on tax. So this itself will become your cash inflow. I have the fixed cost, which is 1 lakh. And then what is the cash inflow per annum? The cash inflow per annum is, what is the cash inflow per annum? 57,500. So this will become 1,57,500. 100. And do you have the PV ratio? Yes, which is 70. So variable cost is 30. 157,500 into 100. Divide that by 70. So that's coming as 2,25,000. And your variable cost will become 67,500. And now you all can just check that variable cost is rupees 60 per unit. So we have the variable cost per unit available. So can I put it like this? Variable cost is rupees 60 per unit. Therefore, number of quantity sold will become 67,500. Divide that by 60. And that is 1125 units. So what is actually the selling price per unit also, you can find out that as well. You can take 2,25,000, which is your sales, and 2,25,000, which is your sales, and divide that by selling price per unit. If you want that, then you divide that by 1125. That is rupees 200. So 200 will be the selling price per unit. So they have told you that estimated annual unit of sales. So we have calculated that 1125 units, and this is the extra part, that the selling price per unit is rupees 200. And the last part is break even. So guys, to calculate the break even point or break even units, see, you have one option, that is you can go reverse by taking this as 0. Okay, go reverse, get the sales and divide that by selling price per unit. Or else, if you know that your break even point can also be fixed cost upon contribution per unit. Okay, so your fixed cost is 1 lakh, and what's your contribution per unit? So if you have the selling price, which is 200, and variable cost is 60, then the contribution is 140. So we can take 1 lakh and divide that by 140. So that is 714 units. So this is your break even point, 714 units. Okay. Okay, now see what is given to you in the next question. Unnat Limited is considering investing rupees 50 lakh in a new machine, and the expected life of the machine is 5 years and has no scrap. And it is expected that 2 lakh units will be produced and sold each year at a selling price of rupees 30 per unit. And it is expected that the variable cost is 16.5 per unit and the fixed cost is 10 lakhs. The cost of capital of Unnat is 12% and the acceptable level of risk is 20%. You are required to measure the sensitivity of the project's NPV to a change in the following project variables, जिसमें आपके पास दिया है selling price, then there is sales volume, then there is variable cost, and on further investigation it is found that there is a significant chance that the expected sales volume of 2 lakh units will not be achieved. The sales manager of Unnat suggests that the sales volume could depend on the economic states, which could be assigned the following probability. So there is poor, normal, good. There is annual sales, which is given to units, and there is probability. Calculate the expected NPV of the project and give your decision whether the company should accept the project or not. Okay. Now see what is given to you. First of all, here we are required to measure the sensitivity of the project's NPV to change in selling price, sales volume, and variable cost. But again, see, they have not given to you that what is the percentage change in NPV. So if you want, then you can take adverse variable of 10% and do it accordingly and judge that to which particular variable it is more sensitive. Or else you can also calculate like this, that if we want to make the NPV to be zero, then in this particular case, by how much percentage your selling price should change, by how much percentage your volume should change, by how much percentage your variable cost should change. So any one of the two things is okay. Now in this particular case, they have not given you any particular percentage. So let us see that to make the NPV zero, what is going to be the impact of your selling price per unit? By how much percentage should that change? Okay. So what we will do is now first we'll calculate your normal NPV. Okay. So we will write down here calculation of NPV. Okay. Now how do you calculate your NPV? So that's nothing but PV of CI minus PV of CO. Does that gives you NPV? Yes, sir. What is my PV of CO? My PV of CO is 50 lakhs. So that itself will become 50 lakhs. Now what's your PV of CI? So to calculate the PV of CI, do we have the quantity? Yes, sir. Do we have the selling price? Yes. Do we have the variable cost? 16.5? Yes. So can I say that sales less variable cost gives you contribution minus fixed cost? There is no data which is given to you regarding tax and all. So we will simply take this as your cash inflows. Okay. And every year it is same. So we just need to multiply it by the PVAF at what is the cost of capital? The cost of capital is 12% and the life is 5 years, right? So this will now give me my PV of CI. So what's the selling price per unit? 30. Okay. And your quantity is 2 lakh units. So 30 into 2 lakhs. So this will now be 60 lakhs. Then what is the variable cost? 16.5 into 2 lakhs. So that will be 33 lakhs. So then 27 lakhs, that's your contribution. What's your fixed cost? Your fixed cost is 10 lakhs. Then your cash inflow is 17 lakhs. And what is the annuity factor? Just check. The annuity factor at the rate of 12%. Okay. So 1 divided by 1.12. 1, 2, 3, 4, 5. So this will be 3.6048. And this will help me to calculate my present value of cash inflows, which is nothing but 61 lakh 28,119. So let me put this as 120. Okay, 119.54. So I have my PV of CI, from which if I subtract my PV of CO, what do I get is my NPV, and my PV of CO was how much? 50 lakhs. Okay. So this is 50 lakhs. So what's my NPV? My NPV is 11 lakh 28,120. Okay. So if we talk about the first part, okay, selling price per unit, sales price. So you can also understand it like this, that we have to reduce the NPV by 11, 28, 120. Okay. To make NPV zero, to make NPV zero. So which is nothing but, can I say that I have to make my PV of CI as rupees 50 lakhs? So if I make the PV of CI as rupees 50 lakhs, then can I say that automatically my NPV is going to be zero? So let selling price per unit be X. Okay. So because we are talking about selling price per unit, right? And the quantity is 2 lakh units. So your sales less variable cost contribution less fixed cost, that gives you your profits, which is nothing but cash inflow per annum. You multiplied that by PVAF, okay, at some particular percentage for 5 years. Then what do we get is PV of CI, okay, which we want it to be as 50 lakhs, okay. And do I have my PVAF also available? Yes, sir. That is 3.6048. So if this is 3.6048, will this give me my cash inflow per annum? Yes, sir. Okay. So can I say 50 lakhs divided by 3.6048? So that will be, if I take 50 lakhs and divide that by 3.6048, so that will be 13 lakh 87,040. Okay. What is the amount of the fixed cost? The amount of the fixed cost is 10 lakhs. So your contribution will be 23 lakh 87,040. And we have to keep our variable cost figure same, which is 33 lakhs. 33 lakhs. Okay. And then your sales volume is going to be, how much units is it? It is 2 lakh units, right? Okay. So this figure will be, can I say 23,87,040 plus 33 lakhs? So this figure is coming as 56 lakh 87,040. So what will be your selling price per unit? 56,87,040. If I divide that by, what was my quantity? My quantity was 2 lakh units. So if I divide this by 2 lakhs, I will be getting this as rupees 28.44. So if my selling price per unit is rupees 28.44, then can I say that my NPV will become zero? Come on, yes or no? Yes, sir. Okay. So y'all can just check that my earlier selling price per unit was what? 30 rupees. So my selling price per unit is rupees 30. Okay. And if my selling price per unit revised is 28.44, so 30 minus 28.44. So can I say that the reduction is 1.56? Okay. So 1.56 is my change. Okay. Change. Divide that by 30 into 100. So this is nothing but 5.2%. So what does it mean? That if selling price per unit is reduced by 5.2%, then can I say that the NPV becomes zero? Okay, so selling price per unit is sensitive by 5.2%. Okay. Now, what is the second part? The second part is we can calculate this for sales volume. Okay, sales volume. Now, for sales volume, what you can do is Uh, do you have the selling price per unit? Yes, sir. Which is 30. Okay. So let volume be X. So we have to see that by how much percentage the volume is getting reduced. Okay. In such a way that your NPV becomes zero. So let the volume be X. So do you have the selling price per unit? Yes, sir. How much is that? 30. Okay. Less what's the variable cost per unit? So that is nothing but 16.5. So will I have my contribution per unit? So that is 30 minus 16.5. So that is 13.5. So can I say let volume be X? So this will now become 13.5x minus what's my fixed cost? My fixed cost is 1 lakh. Okay. So this minus 1 lakh. Okay. And that will give me my cash inflow per annum, which is 13. Sorry, fixed cost is 10 lakhs, not 1 lakh. So this will become 13.5x minus 10 lakhs. Okay. Okay. And from this, what I get is my cash inflow per annum. Okay. Which I need to multiply it by what? I need to multiply it by 3.6048. Okay. So this will give me this will be 13.5x minus 10 lakhs. And if suppose this I multiplied by 3.6048. Okay. So let's just simply multiply this by 3.6048. So this will actually give me how much? 50 lakh rupees. And I want this as 50 lakh rupees only because I want to make my NPV zero. And for that, I need my PV of CI to be 50 lakhs. So this minus 10 lakhs multiplied by 3.6048 will ultimately give me my 50 lakh rupees PV of CI. Same concept, right? So this into this will give me 50 lakhs. So now, and why do I need 50 lakhs? Because my PV of CI is also 50 lakhs. So I want to make my NPV to be zero. Okay. So ultimately, 13.5 into 3.6048. So this will give you 48.6648x minus 3,60,480. This is equal to 50 lakhs. So 48.6648x. This will become 53,60,480. So what is your x? 53,60,480. Divide that by 48.6648. So this will give you 1,10,051. 1,10,151. Okay. Units. Okay. So if these are my units, then my NP will become zero. So what was my old units? My original units was, in the question you all can check, my original units was 2 lakh units. Okay. So old was 2 lakhs. Revised is 1 lakh 10, 151. So can I say that what is the reduction? The reduction is 2 lakh minus 1 lakh 10, 151. So it is 89,849. Correct? So if suppose 89,849, if I reduce it by 2 lakhs into 100, so that will be 44.92%. Okay. So if my volume is reduced by 44.92%, then NPV will be zero. Got it? So if it is, so volume is how much percent sensitive? 44.92% sensitive. Okay. Then my NPV will become zero. And then what about the C part? In the C part, they have told you what is the variable cost. So what is going to be the sensitivity of the variable cost? So lots of calculations are involved here, but ideally you just have to practice this. Only if you practice and solve, you'll be able to understand. Watching the video is not going to help you. Okay. So there are different ways on the basis of which you can calculate this. So I'm using here one of the most easiest way to do this. Okay, so this will give me my cash inflow per annum into PVAF. This gives me PV of CI, which I want to keep it as 50 lakhs. So my PVAF, I'll take the figures from here only, 3.6048. So what is the cash inflow per annum which I'm getting? That is 13,87,040, 13,87,040, right? And my fixed cost was 10 lakhs. So this will be 23,87,040. Okay. And what is the amount of the sales? Now this amount of the sales I have to keep the same. And that is nothing but 60 lakhs. So this is 60 lakhs. Okay. So what will be my variable cost? So this will be 60 lakhs minus 23 lakh 87,040. So that is 36 lakh 12,960. Okay. And what will be my variable cost per unit? So that will be 36 lakh 12,960, and I need to divide that by 2 lakh units. So if I divide that by 2 lakh units, what do I get is rupees 18.06. And right now my variable cost is 16.5. So old is 16.5, new is 18.06. So what is the change? Can I say the change is 1.56? So if my variable cost per unit is increased by 1.56, okay, but that is per unit, right? So let us calculate this in percentage. So 1.56 divided by 16.5 into 100. So if I divide this by 16.5 and multiply that by 100, I'll get 9.48%. Okay. So can I put it like this? That if this is increased by 9.48%, then my NPV will be 0. Okay. So if I'm talking about the three elements, that is selling price, quantity, that is volume, and variable cost. So my selling price per unit should be reduced by 5.2%. So if I reduce this by 5.2%, my NPV will be 0. Okay. Then if my volume is reduced by 44.92%, if my volume is reduced by 44.92%, my NPV will be 0. And if my variable cost is increased by 9.48%, my NPV will be 0. So can I say NPV is most sensitive to what? Selling price per unit. Okay. But in the fourth part, it is mentioned that on further investigation, it is found that there is a significant chance that the 2 lakh units will not be achieved. So what are the three possibilities? Okay. The three possibilities are 1,75,000 units, 2 lakhs and 2 lakh 25, and the probabilities are also given to you. Calculate the expected net present value and give your decision whether we should accept the project or not. So how will we calculate your expected, net present value? Okay. Now to calculate the expected net present value, what you will do, you have the quantity available. You can multiply that by the probability, you will be getting the average volume. Okay, so we can do it like this. Calculation of expected NPV. So this is the question of the mixture of two things, that is sensitivity analysis along with the probability analysis. Okay, now do we have the three states? See, instead of calculating three different NPVs, the best part is we can calculate what is going to be your average sales. Okay, so we are having the three situations. Okay, and we have situation poor, normal, and good. And we also have the probability of occurrence. So what is the probability of occurrence? 0.3, 0.6 and 0.1. Okay. And then we have its quantity. What is the quantity? 1 lakh 75, 2 lakh, and this is 2 lakh 25,000. So can I say we can get the expected volume? Yes, sir. Okay. So that will be So this is 1,95,000. So this is my expected volume, 1,95,000. Now, can I calculate sales less variable cost, contribution less fixed cost, cash inflow per annum? If I multiply that by the PVAF, I'll be getting my PV of CI. From this, if I subtract my PV of CO, I'll be getting my NPV. Okay. Now see, I have my volume of 1,95,000 and my selling price per unit is 30, and this is 30 and this is 16.5. Okay. So I can first directly calculate the contribution per unit, which is 13.5. So 13.5, if I multiply that by 1,95,000, so this gives me 26,32,500. Fixed cost is 10 lakhs. Correct. So this will now give me 16,32,500. And I will take my annuity factor, which is coming as how much? My annuity factor is 3.6048. Okay. So I need to multiply this by 3.6048. So this will give me 58,84,836. And my PV of CO is 50 lakhs. So my NPV is coming as 8,84,836. Okay. Now see, the NPV is positive. Okay. But the decision making will depend on what is the probability. See, the acceptable level of risk is 20%. Now this sentence is very important because our NPV decision will be based on this. Just check that in your poor state of economy, the probability is 0.3. Now if suppose it is poor state of economy, can I say that my NPV will be what? It is 1,75,000 units, right? So I'll take 13.5, which is my contribution per unit, multiply that by 1,75,000. Okay. From this, if I subtract my 10 lakhs and whatever I get, I multiply that by 3.6048 and subtract PV of CO, which is 50 lakhs. Of course, I'll be getting my NPV, right? So see, this is 13.5 into 1,75,000 minus 10 lakhs, okay, into, so this was coming as 13,62,500 into 3.6048, which is 49,11,540. From this, if I subtract 50 lakhs, what do I get? Negative 88,460. So there is 30% chance. There is 30% chance that the economy can be poor and the NPV will be negative. But your level of acceptability is just what? 20%. Okay. So now what is going to be my conclusion? My conclusion will be, since level of risk acceptability is 20%, it means there is we'll write down like this. One second. Huh? Since level of acceptability level is 20% and the probability of poor economy is 30%, in which NPV is negative, we should not accept the project. We should not accept the project. So I hope you guys are trying to understand that if suppose the acceptability level is just 20%, but at 30% chance of poor economy, the NPV is coming negative, should we accept the project? Then the answer is absolutely no, we should not do that. Okay. So I hope you all have understood this much part. Okay. So students, now let us start with the next question. And that is your question number 20. Now see what is given to you here. That a firm has an investment proposal requiring an outlay of rupees 80,000. The investment proposal is expected to have 2 years economic life and there is no salvage value at all. In year 1, there is 0.4 probability that the cash inflow after tax will be rupees 50,000 and 0.6 probability that the cash inflow after tax will be rupees 60,000. The probability assigned to cash inflow after tax for the year 2 is as follows. So at the end of year 1, the cash inflows can be 50,000 also, it can be 60,000 also. And at the end of year 2, the cash inflows can be 24,000, 32,000 and 44,000. Or it can be 40,000, 50,000 and 60,000. And the firm uses a 10% discount rate for this type of investment. We are required to construct a decision tree for the proposed investment project and calculate the expected NPV. So that is something which is asked in the first part. What net present value will the project yield if the worst outcome is realized? And what is the probability of occurrence of the NPV? What will be the best outcome and the probability of that occurrence? And will the project be accepted? And they have given you the PV factors. See, first of all, as you can see that in this particular question, the cash inflows are dependent on each other. Now, how do I know this? You guys can just check that the cash inflow at the end of year 1, they have told you it is 50,000. And if the cash inflow at the end of year 1 is 50,000, then you all can check that the cash inflow at the end of year 2 can either be 24, 32 or 44. So these cash inflows are dependent on year 1 cash inflows. Similarly, the cash inflows for 40, 50 and 60 are dependent on your 60,000 cash inflows. So clearly, the cash inflows are dependent on each other. And whenever they are going to ask you about decision tree, then obviously a tree, what will it have? The main stem and its different branches, right? So basically that's what they are trying to tell you, that here we are going to calculate, we have to prepare a decision tree where what will be the different streams of cash inflows, which will be based on the previous year's cash inflows. Okay, so we are going to prepare the decision tree first based on this particular concept. Okay, now see, let us start very quickly the first part of the question, and that is construct the decision tree. Okay, so here we'll be having the first part, decision tree. Now in decision tree, what is going to happen? Can I say I'm having first the cash outflow of rupees 80,000? So that is okay. This is my cash outflow. Okay. Now based on this cash outflow, which will definitely happen at your year 0, there is going to be two possibilities, that the cash inflows at the end of year 1, the cash inflow can be 50,000 also, or the cash inflow can be rupees 60,000 also. Okay. And then see, what is going to happen is at the end of year 2, the cash inflow can be 24, 32 and 44. So this can be either 24,000, or this can be either 32,000, or this can be either 44,000. And do I have the probability? Yes, sir. 0.2, 0.3, 0.5. So this is 0.2, 0.3, 0.5. And of course, what is the probability that you are going to earn 50,000? So for that, the probability they have given to you is 0.4. Okay. So this is going to be 0.4. Now, if this is 60,000, then again, there are three streams of cash inflows, which are 40, 50 and 60. So this is 40,000, this is 50,000 and this is 60,000. And the probability is 0.4, 0.5 and 0.1. 0.4, 0.5 and 0.1. Okay. Now these are my year 2 cash inflows. Okay. Now what is going to be my joint probability? So my joint probability means what? That what is the possibility that I will be earning 50,000 at the end of year 1 and I'll be earning 24,000 at the end of year 2. What is the joint probability of that? So for that, I'll take 0.4 into 0.2. So that is 0.08. So there is 8% chance that I will earn this first stream of cash inflows, which is 50,000 at the end of year 1 and 24,000 at the end of year 2. So this is the first possibility. The second possibility is what? You all can check that there is 50,000 at the end of year 1 and there is 32,000 at the end of year 2. So in this particular case, it will be 0.4 into 0.3. So that is going to be 0.12. And this is 0.4 into 0.5. So this will be nothing but 0.2. Okay. Also, 60,000. Now, what is the probability that you are going to earn 60,000? So that's going to be 0.6. So 0.6 into 0.4, that will give you 0.24. So that is the fourth possibility. 0.6 into 0.5. So that will be 0.3. And that will be your fifth part. And then 0.6 into 0.1. So that will be 0.06. And that will be your sixth path. So these are the six paths you have to understand. Okay. Now, what do we have to do with the same? So we already have this sixth paths readily available. The first part is, what? The construct the decision tree of the proposed investment. So we have already constructed the decision tree. Okay. And they have also told you that you are required to calculate the expected NPV. So now see, there are six possibilities. There are six NPVs which are possible. There are six estimated NPVs which we can calculate it. And also at the same time, we also have the joint probability, that what is the probability that these estimated NPVs will occur. So we have that as well. So if I can calculate what is going to be my estimated NPV, and if I have the joint probabilities available, then don't you think I can multiply both of that and I can calculate the average of the same, yes or no? Of course, yes. Okay. So we have to calculate the NPV for each and every possibility. Okay. Now see, when I talk about my first possibility. Okay. So this is case 1. You can also call this as the path 1. Okay. First instance. Okay. What is the cash inflow at the end of year 1? So that's 50,000. What is the cash inflow at the end of year 2? So that is 24,000. Okay. Now, do I have the discounting factor available for year 1 and year 2? Yes, sir. So what's the PV factor at year 1? What is the PV factor at year 2? So my PV factor at year 1 is 0.909 and this is 0.826. Okay. So of course, this will give me my present value of cash inflows. I'll sum it up. So I'll be getting the present value. If I subtract that with the present value of cash outflows, what do I get? I'll be getting the NPV. Okay. And my present value of cash outflows are the same everywhere, 80,000. Okay. So that is going to be the same everywhere. Now, there are six paths: 1, 2, 3, 4, 5, and 6. There are six paths. Okay. Now, what is going to be the NPV? So, let us start with the same 50,000 into 0.909 and 24,000 into 0.826. So, the total is coming as 65,274. From this, if I will subtract 80,000, I'll be getting negative 14,726. Then again, can I say for my year 2, again, for my case 2, sorry, year 1 cash inflows are going to be 50,000 only. See, you all can check now. For case 1, 2, and 3, are the year 1 cash inflows 50,000? Yes, sir. Okay, so it's going to be 50, 50, 50. Then it is 60, 60, 60. Correct? Now, what about your year 2? So, year 2 is going to be 32,000. In your path 2, 44,000 in your path 3, then 40,000, 50,000, and 60,000. 40,000, 50,000, and 60,000. And do I have the PV factor available? Yes, sir. So that's going to be the same only, no? For year 1 and year 2. Okay. Now, can I put it like this? The PV of CI will now be for case 1, case 2, case 3, it's going to be 65,274, 65,274. Oh, sorry. This is the combination, right? Okay. So let's do this again. 50,000 into 0.909 and 32,000 into 0.826. So this comes as 71,882. From which if I will subtract 80,000, then I'll be getting negative 8,118. Okay. Now you all can do this on your own. 50,000 into 0.909 and 44,000 into 0.826. So this will be 81,794. From which if I'll subtract 80,000, I'll be getting 1794. Then 60,000 into 0.909 and 40,000 into 0.826. The total of this will give you 87,580 minus 80,000. So that will eventually give you 7580. Then 60,000 into 0.909 and 50,000 into 0.826. So that will eventually give you 95,840. And this will give you 15,840. 60,000 into 0.909 and again 60,000 into 0.826. So the total gives you 1,04,100 and this will give you 24,100. So these are the possibilities. Okay, these are the possibilities. These are the NPVs which can be possible at different paths. Okay. Now, do we have the estimated NPVs? Yes, sir. They have told you what is the expected NPV. Now, you all know the rule that if there is estimated NPV and if I multiply that by the probability, what do I get is the expected NPV. Okay. So, there is going to be path or case 1, 2, 3, 4, 5 and 6. And we have the estimated NPVs. If I multiply that by probability, then I'll be getting the expected NPV. Okay, this is something which we are doing it normally as well. So your estimated NPVs are 14,726, 8118, 1794, 7580, 15840, and 24,100. And I have the probabilities which is 0.08, right? The first joint probability that this path will occur is 0.08, 0.12, 0.2, 0.24, 0.3 and 0.06. Okay. So what is going to be the average? 14,726 into 0.08. Then this is going to be negative 1178.08. Then 8118 into 0.12. So that will give you negative 974.16. 1794 into 0.2. So that will give you 358.8. 7580 into 0.24. So that will give you 1819.2. 15840 into 0.3. So that will give you 4752. 24,100 into 0.06. So that will give you 1446. And the NPV is coming as 6,223.76. So that's the solution for the first answer. This is your average NPV. Okay. Second part. What NPV will the project yield if the worst outcome is realized? What is the probability of the occurrence of this NPV? Wow. Now, for this, we have to check what is the estimated NPV. So there are 6 paths and these are the 6 NPVs. And you all can see that in this 6 NPVs, the worst NPV or the worst outcome will be at path 1, right? That is negative 14,726. Okay. So what is going to be your solution for the second part? Okay. So here we will write down solution for the second part. worst case NPV will be negative 14,726, and the probability of occurrence is 0.08, that is 8%. Okay. So this is the worst case NPV and this is the probability of occurrence. Now, institute in their solution, they have given this answer and then they have told that the expected NPV will be negative 1178.08, but that's not correct. Because when we are saying that the worst outcome will realize, it means that we are saying that this 14,726, that is the negative NPV which will be realized. And the probability of occurrence for that negative NPV is 8%. So we don't have to multiply it by 8%. So we have to understand it like this. So if someone will ask you that if you're going to invest in this project, what is the maximum loss? So you will say that the maximum loss which I'm going to incur, that is the worst case scenario, is 14,726. And what is the probability that you can enter into such kind of the worst outcome? So that is just 8% probability. Okay. So this is your answer. Then in your third part, what have they told you? What will be the best outcome? So then in the third case, they have told you what is the best case NPV. So what will be the answer for the best case NPV? So for the best case NPV, you all need to check in the again the list of estimated NPVs. The best case NPV is 24,100. All right. So we will write down best case NPV is 24,100. And what is the probability of occurrence for this best case NPV? Then that's nothing but you all can just check 6%. Okay, so that's 6%. Then what is the fourth case? Will the project be accepted? Yes. Yes, because expected NPV, because on an average, now your expected NPV is positive. So definitely we will accept this particular project. Okay. Chalo. Now let us start with the next question. And that is your question number 21. Now, very unlikely to be asked in the examination, because in real life we don't use or we don't place the emphasis on the utilities of the cash flows to determine whether we should accept the project or not. So it is something like this. Let's say, for example, you have let's say three employees. Okay, A, B, and C. Example, you have three employees, A, B, and C. Now, A is the least efficient. Okay. So let's say, for example, he rather when he comes to the office and he works for you, because of him, there is too much of delay in the work and stuff like that. And because of that, he actually gives you a negative utility. Okay. So suppose he has a negative utility of 10. Okay. And let's say, for example, B, B has a positive utility of 2. And let's say C has a positive utility of 40. Okay, he's the most efficient. Okay. Now, uh, let's say, for example, if I just tell you that all the three of them, they work for 8 hours in a day. Okay, so if they are going to give you 8 hours in a day. Okay, so utility is actually a unit of measurement. So in this particular case, can I say that total utility which A, rather than contribution, he will withdraw 80 utilities, right? Then if you talk about B, then he will withdraw what? 60, he will contribute 16 utility. And if suppose we talk about C, then he's going to contributing what? 320 utilities. Okay. Now, uh, if suppose we have the utilities available, for different employees, for different hours they work, and how much are they going to contribute it. And if suppose I want to now calculate, the average, on an average, what is the utility which all the employees put together will contribute it to me, then I will attach probabilities to it. Okay. And based on probabilities, then I'll take the average and calculate it. What is going to be the expected or the average utility from this particular team of employees. Now, of course, here we are not doing any human resource, but when it comes to your capital budgeting decisions, we can actually provide utilities to the cash flows. Okay, so let's say for example there are certain cash flows like negative 10,000, negative 5,000, then negative 1,000, then 10,000, okay, 50,000 and so on. And then I can provide some utilities for the same. Okay, so let's say for example negative 10,000, the utility is 500. Example, this is 30, then this is 40, and then this is like, let's say for example 20, 80 and stuff like that. Okay, whatever. And now these are the utilities which are being provided to you. Now they tell you that, let's say for example there are two projects, project A and project B. Okay, now project A, the estimated cash inflows at the end of year one is, let's say for example, uh 10,000 and 50,000. Okay, and when we talk about project B, suppose the estimated cash inflows are negative 10,000 and 50,000. Okay, and if you want to calculate what is the utility which is generated by project A and project B, so first we should know that what is the probability that this 10,000 will be generated. Suppose the probability this 10,000 will be generated is example 0.8. The probability here, this will be 0.2. Suppose this is 0.4 and here it is 0.6. Okay. So first what will I do is I will attach the utility. So what is the utility of positive 10,000? For positive 10,000, the utility is 20. So I'll attach 20 to it. For 50,000, the utility is 80. So I'll attach 80 to it. And this will actually give me my average utility which will be generated from the project. So 0.8 into 20, that will be 16. 0.80 into this will also be 16. So this will be total 32. And here this will be negative 10,000, it is 500, and this 50,000, it is 80. Okay, so this will give you zero point 0.4 into 500, and this will be negative 200. Okay, so it provides you with a negative utility of 500. Of course these all were negatives. Okay, and 0.6 into 80, so that is what, 48. So 48 minus 200, so this projects provide you with a negative utility of 152. So of course we will select the project in which the utility is going to be what, it's going to be higher. Come on, yes or no? Then the answer is yes. Okay, so here if you just check this particular question, Jumble Consultancy Group have determined the relative utilities of the cash flows for the two forthcoming project of its client companies, which is as follows. So we have the cash inflows of negative 15, negative 10, negative 4, then 15, 10, 5, and this is 1,000. Okay, and we have the project A cash flows as well as the probability, and the project B cash flows as well as the probabilities, and which project should be selected and why. Okay, so now how will we solve this particular question? This is your question number 21. How will we do this? So here we will first start with giving the heading calculation of expected utility. Okay, and when we talk about your project A, okay, we have the cash flows as negative 15, negative 10, 15, 10, and 5. And then we also have the utilities. What are the utilities? Then for negative 15, you all can just check the utility is 100. Okay, so this is negative 100. Then for negative 10,000, it is negative 60. And then we have the next series, which is 15,000, for which the utility is 40. For 10,000, the utility is 30. And for 5,000, the utility is 20. Okay, so what is the probability first of the occurrences of these cash inflows? So that is 0.1, 0.2, and then we have 0.4, 0.2, 0.1, 0.4, 0.2, 0.1, and this will give me my expected utility, okay, or on an average utility. That will be negative 100 into zero point 0.1, then negative 60 into zero point 0.2, then 40 into zero point 0.4, then 30 into zero point 0.2, then 20 into zero point 0.1. So this total is coming as 2. Okay. And when we talk about your project B, okay, so it will be the same system which we have to follow: cash flows, utilities, probability, and this will give me my expected utility. All right. So what are the streams of your cash flows? Negative 10, negative 4, 15, 5 and 10, 15,000, 5,000 and 10,000. And what are the utilities? 15,000. First, if it is 10,000, then this is negative 60. If it is 4,000, then it is negative 3. If it is 15,000, then it is 40. If it is 5,000, then it is 20. And if it is 10,000, then it is 30. And what is the probability? So we have the probability of 0.1, 0.1, 0.15, and then we have 0.4, 0.25, and then we have 0.1. Okay. So what is going to be the expected utility? So this is minus 6, then minus 3 into 0.15, then 40 into 0.4, then 20 into 0.25, then 30 into 0.1, and the total of this is coming as 17.55. So what will be our conclusion? We will select project B because its expected utility is higher. Correct? Its expected utility is higher. Okay. Now let us start with your question number 22. Now see what is given to you. A&, company is contemplating whether to replace an existing machine or to spend on overhauling it. Okay. It means, you know what, that whether we should further do any maintenance on it or not. A&, company currently pays no taxes and the replacement machine costs rupees 90,000 now. So if I want to replace the machine right now, then from my pocket 90,000 rupees will go, and it requires maintenance of rupees 10,000 at the end of every year for 8 years. At the end of 8 years, it would have a salvage of rupees 20,000 and it would be sold. And the existing machine requires increasing amounts of maintenance each year, and its salvage value falls each year as follows, in which we have present maintenance 0, salvage 40,000, then year 1, 2, 3, 4, we have the maintenance cost, and then we have the salvage, and the opportunity cost of capital is 15%. Then what is required? When should the company replace the machine? So that's the first part, whether we should replace the machine or not. And they have given you that the present value annuity factor for the period of 8 years at the interest rate of 15% is 4.4873. And at the end of the 8 years, it is nothing but 0.3269. Okay. So this is the concept. Now let us first learn how do we calculate this, the replacement kind of a question. Now see, in there are certain projects, or there are certain machines for which cash inflows from the project will not be available to you. So in those situations, we are going to use the concept of NCO, that is nothing but net cash outflow. Okay. So imagine something like this, like if suppose you want to buy car for your personal use. Okay. Now when you want to buy the car for your personal use, of course there is no cash inflows that will be generated from the car, because you are not going to charge from anyone who's going to sit in your car, right? Okay. So if such kind of the decisions has to be made that which car should be bought for your own personal use. So in this particular case, what will you do? You will take into consideration, okay, fine. Now there are two cars, okay? Suppose one car has a cash outflow of 8 lakhs, another car has a cash outflow of 10 lakhs. Then we will see that what is the repairs maintenance for both the cars. Suppose the car with 8 lakhs might have a higher repair cost at the end of every year. It will require more maintenance. Suppose car with 10 lakhs will have lower maintenance. Also, let's say for example, the fuel efficiency for car A is very low. For car B, it is relatively high. So what are we doing is we are just checking that what is going to be the cash outflows. At the end of, let's say 5 years, you want to sell the car, then what will be the salvage value? So we are just going to calculate the cash outflows which will be generated from both the cars. And then what we will do is we will see that which particular car provides you with the least cash outflow and we are going to select that. Okay. So what is your net cash outflows? So net cash outflows means, I just present it like this, A plus B minus C. Okay. Where can I say your A is nothing but PV of initial investment. Okay. What is B? B is nothing but PV of running cost. Okay. And what is your C? C is nothing but the PV of salvage. Okay. So we will calculate NCO by taking A plus B minus C. Okay. And if suppose the project in which there are different lives, okay, suppose project A has a life, car A has a life of 5 years, car B has a life of 3 years, then we can calculate NCO per annum by taking NCO upon PVAF. Okay. And then we will see that where the cash outflow is going to be lower. Okay. So then what we will do is we will select the project in which NCO is lower, okay, or NCO per annum is lower. And what will be the tax implication on this? That is also something we should discuss, but this is the basic thing. So now understanding this particular concept, now let us start with this question where they have told you that A and B is contemplating whether to replace an existing machine or to spend. The replacement machine cost rupees 90,000 now. So can I say that if I buy a new machine, okay, so if I buy a new machine, then the new machine will have an original cost or the initial investment of rupees 90,000. Okay, so can I say this is nothing but my PV of initial investment, right? PV of initial investment. Then you all can just check that there is, these are the cash, these are the maintenance cost, right? And it requires a maintenance cost of rupees 10,000 at the end of every year for 8 years. Okay. Now, second part is, what is the maintenance cost? So the maintenance cost is rupees 10,000. Okay. And that is going to be every year. Okay. So can I say the PV of maintenance cost will be 10,000 into 10,000 into, can I say present value annuity factor at, what is the rate? 15%. And this is for how many number of years? This is actually for your 8 years. Okay. That is, this will be 4.4873. Okay. So if I take 10,000 and if I multiply that by 4.4873, so that will give you 44,873. Now this will be your PV of your maintenance cost. Okay. Third part is what is going to be your present value of salvage. Okay. So my present value of salvage, can I say that is going to be, salvage is nothing but, how much is it? 20,000 rupees. So salvage is 20,000. And this I need to multiply it by the PV factor at 15% at the end of 8th year. Okay, and do I have the discounting factor for the same? Yes, sir. How much is that? So that is nothing but 0.3269. Correct? 0.3269. Okay. So this will now give me 20,000 into 0.3269. So that is 6538. So this is your PV of initial investment. This is your PV of maintenance cost. This is your PV of salvage. So therefore, A plus B minus C is 90,000 plus 44,873 minus 6538. So what is this going to be? 90,000 plus 44,873 minus 6538. So that will be 1,28,335. Can I say this is my net cash outflow? Okay. I hope you have understood that we are making the initial investment today. So that's why it's your cash outflow. And then whatever is your maintenance cost at the end of every year, that is constant. So we have calculated the PVF. So initial investment and the present value of the maintenance cost. And whatever is the salvage, which we are going to receive at the end of the 8th year, we are going to subtract it. So ultimately, we'll be getting the final net cash outflow, which is 1,28,335. And now, how do you calculate your NCO on per annum basis? Okay. So how will you calculate your NCO on per annum basis? So can I say NCO per annum can be 1,28,335, divide that by, can I say that this is 4.4873? So that's the present value annuity factor. Okay. So that actually gives you 28,600 per annum. Okay. So this is the cash outflow per annum. Now, why have I calculated this on per annum basis? Okay. See, I hope you have first understood that how do we calculate the net cash outflow for a new machine. Now see, the question which we are actually doing is regarding your optimum replacement time. See, they have asked you that when should the company replace the machine? So they have asked you about when. But when the machine should be replaced. So it's an optimum replacement time when we should replace it. See, actually your CFO is always at a fix that at the end of which year should he replace the machine. Because if he keeps on using it towards his entire life, then the salvage will be reduced and the maintenance cost will increase. And if we replace it too early, then we will rather incur more cost in buying the new machine. So he is always at a fix that when the machine should be replaced. See, even if suppose you have a car, okay, generally as per RTO, your cars can be used for 15 years, example. But of course, you are not going to use one car for 15 years, right? You will replace it at the end of 5th year or 7th year or 10th year or 12th year, whatever is your wish. Now, when it comes to replacement of the car, if you replace it at the end of the 2nd year, then of course salvage value will be very high. Maintenance, you have hardly paid it. If you replace it at the end of the 12th year, maintenance cost will be too much high, salvage will be very low. So when should you replace it? So right now I know that the moment I replace the car and get a new one, then my per annum cash outflow is 28,600, right? Now I will see that if suppose I want to replace the car right now, then what is going to be my net cash outflow? If I replace the car at the end of the 1st year, then what is going to be the net cash outflow? If I replace the car at the end of the 2nd year, then what is going to be the net cash outflow? And then we will replace the car at the end of the year in which the net cash outflow is going to be the least. Okay. So that's why I calculated it on per annum basis. Okay. So just to make you understand this. Now see. What we will do is we will calculate what is going to be the uh, net cash outflow if the replacement is done today. Okay. So what is your case 1? Okay. replacement done at year 0. So when you are going to replace at the end of today itself, okay, then can I put it like this? You will get the salvage of 40,000, right? So salvage is my cash inflow, and that is 40,000, and the present value of 40,000 is 40,000, and I know what is my NCO per annum. So my NCO per annum is 28,600, because now old machine is replaced and we have taken new machine. So if you are doing it today itself, we don't have to bear maintenance cost on the old machine as well, right? So there will only be maintenance cost on the new machine. So that's going to be 28,600. Okay. So this will now be 40,000 minus 28,600. So that is 11,400, and that is your positive. Okay. So this is your positive cash inflow, because see, you can understand this like this, that the salvage value is 40,000. That's the money coming in, and the net cash outflow is 28,600. Okay, per annum. So that is why, can I put it like this, that 11,400 is actually what? That is nothing but your one type of cash inflows, because this is coming positive. 40,000 is coming in and 28,600, that's the NCO per annum. So ultimately you will be left with 11,400. So this is actually your inflow. Okay. But when we talk about your case 2, and case 2 is, let's say replacement is done at the end of year 1. Okay. Now see, what will happen if the replacement is done at the end of year 1? Are you going to bear the maintenance cost? First of all, yes, sir. I'm going to bear the maintenance cost, which is 10,000. At the end of year 1, are you going to get the salvage of 25,000? Yes, sir. 25,000. Now, both of them are in future value terms. So it is my duty that first I have to convert that into present value. So what will I do is 10,000, the discounting factor they have given to you is 15%, right? So 15%. Now, can I say that 1 divided by 1.15 will be 0.8696, and this will be also 0.8696. Okay. And out of these two, I hope you realize that your maintenance cost is actually your outflow, salvage is your inflow, and at the end of year 1, then the NCO which you have is 28,600. So that is 28,600, and that also needs to be converted into your present value. So this is what at the end of year 1. Okay. So 10,000 is negative, 25,000 is positive, 28,600 is negative. So this will now be how much? This will be negative 11,826. And this is your outflow. Okay. So we have an outflow of negative 11,826. Similarly, now let's say, for example, we are doing the replacement at the end. So this was what? Replacement done at the end of year 1. Case 3. What will be case 3? If you are doing replacement done at end of year 2. So now what will happen? Of course, I will have to pay the maintenance for both the years, right? So year 1 maintenance cost is negative 10,000. Year 2 maintenance cost is 20,000. Correct? And at the end of year 2, will there be any salvage? Yes, sir. What's the salvage? Just check. The salvage is 15,000. So this is going to be your inflow. But now we are replacing the machine at the end of the second year. So your per annum cost is 28,600. Okay, NCO per annum. Now, if I discount all of these, so this will be 0.8696. But now for the end of the second year, this will be 0.7561, 0.7561, and 0.7561. All right. So these are my streams of the cash flows. Okay. See, you have to understand like this, that if I'm talking about the new machine, you must be wondering, okay, sir, but for new machine we are paying 90. I agree. You are paying 90,000 rupees for the new machine. Okay. Now you understand it like this, that 90,000 you are paying today. Also, 10,000 rupees is nothing but your what? And is nothing but your maintenance cost every year for the period of 8 years, and your salvage at the end of the eighth year. So we have to take all these things put together, and we are getting finally the answer here for the new machine, which was nothing but 1,28,335. Now see, 1,28,335 is for the life 8 years. What we are talking about is if the machine is replaced today. So can you see that the life is now not same? We are replacing the old machine with the new one at year zero itself. So that's why we have to calculate that on per annum basis. Similarly, if you are doing it at the end of year one, so that is why your maintenance cost is your outflow. Your 25,000, that's your inflow. Also at the same time, when you will be replacing the machine, the replacement cost, I cannot take it as 1,28,335 because that is put together for 8 years. So that's why my per annum cost is what? 28,600. So that needs to be subtracted. Okay. So here also 28,600 will have a negative cash outflow. So what is the answer? Okay. So this is negative 8696. This will be negative 15,122. And this is coming as 11,342. And the last one is negative 21,624. The total is coming as negative 34,100. So if you're replacing at the end of year two, then your net cash outflow negative is 34,100. What about your case 4? The machine will be replaced at the end of year 3. So replacement at the end of year 3. Okay, process remains the same. Now you will pay the maintenance for 3 years. At the end of third year, you will get the salvage. At the end of third year, I have the NCO available. So my NCO per annum, that is 28,600, no doubt about it. And this was negative 10, this was negative 20, and now I'll be having maintenance of negative 30. And then there is a salvage value of 10,000. Okay. And then I also have my probability, my discounting factor is 0.8696, 0.7561. Okay. And we already know this is 8696 negative, and this is negative 15,122. And then I have, this is negative 30,000. So 1 divided by 1.15, 0.6575. So this will be 30,000 into 0.6575 negative. So this is negative 19725. Then 10,000 into 0.6575. Then 28,600 into 0.6575. Okay. And then we are having 15,122 negative and 8696 negative is coming somewhere around 55,773 negative. Yes, correct. 55,773. Then your last and final case, case 5, if the replacement is done at the end of year 4. Okay. So year 1, 2, 3, 4, 4, 4. Why? Because now I'll be having 8696 as my maintenance cost, present value 15,122, 19,725, and then we just have to take 40,000 into point. Salvage is 0, and this will be negative 28,600 into point. 1 divided by 1.15, 1, 2, 3, 4. So that is 0.5718, 0.5718. Okay, so this is already in PV terms, I've written it. So this is point, so this is 8696, 15122, 19725, 40,000 into 0.5718, 28,600 into 0.5718. So this is coming as negative 37,024. Oh, I think I have made a mistake. This is also 40,000 negative only. Okay, so 1000 into 0.5718. This will now be 40,000 into 0.5718 plus 59,000. This is okay. Somewhere around negative 82,768. This should be your answer. Okay. Now, where do you think that it is the least? Then we should replace the machine immediately. Why? Because it results in cash inflow. Rest everyone results in cash outflow. So we should replace it what? Immediately. So you can write down here, company should replace the machine immediately because its NCO is least. So in bracket you can write down positive 11,400. So it makes sense doing this right now. Okay. Fine. I hope you have understood this particular question. Okay. Okay. So students, now let us start with the next question. Now see what is given to you, that a company has an old machine which is having a book value 0, which can be sold for rupees 50,000. So its book value is 0 and it can be sold for rupees 50,000. The company is thinking to choose one from the following two alternatives. First point is to incur the additional cost of rupees 10 lakhs to upgrade the old existing machine. And second, it is to replace the old machine with a new machine costing rupees 20 lakhs plus installation cost of rupees 50,000. Both above proposals envisage useful life to be 5 years with the salvage value to be nil. The expected after-tax profits for the above three alternatives are as under. Year 1 to 5, if we continue with the old existing machine, what is the net profits after tax? upgraded machine, and if it's a new machine, the tax rate is 40%. The companies follow straight line method of depreciation and assuming the cost of capital to be 15%, you are required to advise that the company as to which alternative is to be adopted. See, it's a very simple question having two options. Okay, so what are the two options in this particular question? Okay, listen to this very carefully. This is your solution to question number 23. See, you have an old existing machine. Okay. Now, when you have an old existing machine, you can continue as it is. Okay, continue as it is. And that is, don't do any upgradation or don't replace it with a new machine. Don't do anything. Okay, you are going to continue as it is. Second, you can upgrade the machine. Upgrade the machine. Okay. And the third part is you can replace the machine. Okay, replace the machine. So if you continue as it is, okay, don't even spend a single rupee on that old machine, then the cash inflows generated will be as follows. Okay. But if you upgrade the machine, then these will be the cash inflows. Or if you replace it with a new machine, then this is going to be the cash inflows. Are you understanding this? So these are the two options. That is whether you should upgrade the old machine with the new one. Do we have to do upgradation of that particular old machine, or do we have to replace the entire old machine with the new machine? Okay. Now see, whenever such kind of concepts come, it means that we are going to now use incremental method. What is incremental method? That if suppose old machine is upgraded, then what is the incremental NPV? Or if the old machine is replaced with the new one, then what is the incremental NPV? And we will select the option in which the incremental NPV is going to be higher. Now you can just check in your first part, they have mentioned that there is going to be an additional cost of rupees 10 lakh, which is going to envisage the useful life to be 5 years. Now what happens is that whenever we are making some expenses or whenever there is upgradation cost which has the impact on the life of the particular asset, we usually say what? That this particular expenditure should be capitalized. And upgradation per se, it should always be capitalized. And if it is capitalized, then why I'm using this word capitalized? Because it is eligible for depreciation. But of course, when you're upgrading the old machine, you're not going to sell the old machine. So there is no salvage. But yes, when you're going to replace the old with a new one, then will there be any salvage? Come on, yes or no? Then the answer is yes. Okay. So how are we going to approach this? Okay. So we'll write down here option 1. If old machine is upgraded. If old machine is upgraded. Okay. So what is going to be your PV of CO? Can I say that is going to be 10 lakh rupees? Okay. And you are going to spend 10 lakh rupees right now. So that's why it's going to be 10 lakhs. But when I talk about your PV of CI, we have to understand that we have to calculate what is the incremental present value of cash inflows. So in this particular question, you have upgraded machines NPAT available. Mind you, upgraded machines NPAT is available. Okay. So we are having here 1, 2, 3, 4, 5. What we have is actually your NPAT. Okay. So see, what's your NPAT? Your NPAT is 5 lakh 50. Then it is 5 lakh 90. Then it is 6 lakh 10. 6 lakh 50. and it is 7 lakhs. Correct? Now to this NPAT, I will add the amount of depreciation. I'll be getting the cash inflows. Right? So this will be the cash inflows from the new machine, from the upgraded machine. From this, I need to subtract what is the cash inflow from existing machine, because this will give me incremental cash inflows, which I need to discount it at what percentage rate? 15% rate. Then I'll be getting the PV of CI. Okay. So what am I going to do from this NPAT? I'm going to add back the amount of depreciation, because here they have just given you net profits after tax of the upgraded machine, and we want cash inflow. So definitely I'm going to add back the amount of depreciation. Okay. But then you must be wondering, okay, sir, why are we not adding depreciation to the old machine? Because it is specifically given to you that it has a book value which is 0. Okay. So it is not further subject to any kind of further depreciation. Okay. So that is why its NPAT itself is nothing but your cash inflows. So that will be 5 lakh, 540, 5 lakh, 540, then 580, then 620, and the last one is 660. Now, what is the amount of depreciation? Depreciation is going to be, can I say depreciation will be, upgradation cost is 10 lakhs, your salvage is 0, and the life is 5 years. So that's going to be 2 lakhs. So 2 lakh will be your depreciation. So what is going to be now your cash inflows? 7 lakh 50, then 7 lakh 90, 8 lakh 10, 8 lakh 50, 9 lakh. So can I say my incremental cash inflow will be 2 lakh 50, again 2 lakh 50, this will be 2 lakh 30, this will be 2 lakh 30 again, and the last one will be 2 lakh 40. Correct? Now I need to discount all these things at the rate PV factor 15%, so that is 0.87. Right? These are the PV factors which is given to you: the 0.87, 0.756, 0.658, 0.572, and 0.497. So this is now going to give me PV of CI. Okay, and this is your incremental PV of CI. I hope you all are solving. Okay. So the total is coming somewhere around 8,08,680, right? Okay. From which now I have to subtract my PV of CO to get the NPV. So I will write down here incremental NPV will be 8,08,680. There is no salvage here, so that will be subtracted by 10 lakhs. So that is coming negative, and that is negative 191,320. And if it is negative, then definitely we are not going to replace the old, we are not going to upgrade the old machine. At least till now we can understand that much. But what about option 2? Your option 2 is if old machine is replaced. Now in this particular case, we have to see what is the original cost of the new machine. The original cost of the new machine is 20 lakhs plus installation cost is 50,000. Okay. So initial investment is 20 lakhs and plus we have the installation cost which is 50,000. So basically we have 20 lakh 50,000. Okay. But can we sell the old machine? Come on, yes or no? Yes, sir. Because we are not upgrading it now. So we are now selling the old machine for how much amount? 50,000 rupees. Whose book value was 0. So now see, what is going to happen is my gross salvage will be how much amount? So it's 50,000. From which now I have to pay the tax. Now tax is at the rate of 40% and it will be on your profit. So we are selling it for 50,000 and the book value was 0. So basically the entire profits is 50,000. So 20,000 will be your tax. Okay. So ultimately 20 lakh, 50,000 minus 20,000 is 30,000. So this will now give you 20 lakh 20,000. So this is the PV of initial investment, which is nothing but 20 lakh 20,000. I hope you have understood this much. 20 lakh 20,000. Okay, complete this much. And now, after you have completed this, again we are going to repeat the same process. So we have got this as your PV of CO. Now what about PV of CI? So for PV of CI, again the same concept here, 1, 2, 3, 4 and 5. We have the NPAT available for the new machine, which is 6 lakh, 6 lakh 40, then 6 lakh 90, 7 lakh 40, and then we have 8 lakhs. To this NPAT, if I add the amount of depreciation, I'll be getting the cash inflows. Correct? And once I get the cash inflows, then what do I have to do? This is the new machine cash inflows. From this, I will subtract cash inflows from old machine. What will I get is the incremental, which I will discount it at what? 15%. So I'll be getting the present value. What's the depreciation now? Of course, you will charge the depreciation on the total investments which you have made. That is 20 lakh 50,000. Even installation cost gets added to the cost of the machine. So you will take 20 lakh 50 and there is no salvage and the life is 5 years. So this will now be 4 lakh 10,000. So now do I have the amount of depreciation? Yes, sir. And that's 4 lakh 10. So this will now help me to calculate what is going to be my cash inflows. Correct? So this will now be 10 lakh 10. Then this will be 10 lakh 50. 11 lakhs. Then this will be 11 lakh 50. And this will be 12 lakh 10. Now what is the cash inflow from the old machine? So as you all know, it is 5 lakh 540, 5 lakh 540, then 580 620, 580 620 and 660. So are we in the position to calculate the incremental cash inflows? Yes, sir. 10 lakh 10 minus your 5 lakhs. So that will be 5 lakh 10. 10 lakh 50 minus 540. So that is again 5 lakh 10. 11 lakh minus 580. That is 520. Then 11 lakh 50 minus 620. So that will be 5 lakh 30. 12 lakh 10 minus 6 lakh 60. So that will be 5 lakh 50. I need to discount it at these rates 0.870, 0.756, 0.658, 0.572 and 0.497. So let us calculate. Somewhere around 17,47,930. Yes. So what is now going to be your incremental NPV? So your incremental NPV is 17,47,930 you have spending. You are going to get in PV terms, and you are spending how much? So that is 20,20,000. So that is negative 2,72,070. So is the incremental NPV negative? Yes or no? Yes, sir. And now you can see that both the NPVs are negative. So we are definitely going to conclude that we should continue with our old machine only. So conclusion, we should continue with old existing machine. Okay. Chalo. Now let's come to the next question. Company X is forced to choose between two machines A and B, and the two machines are designed differently but have identical the same capacity and do exactly the same job. Now machine A cost 1,50,000 and will last for 3 years, and it will cost 40,000 per year to run. Machine B is an economy model costing 1 lakh, but it will only last for 2 years and cost 60,000 per year to run. These are real cash flows, and the costs are forecasted in rupees at a constant purchasing power. Ignore tax. Opportunity cost of capital is 10%. And which machine should the company choose? And should the company buy? Okay. So now how will you solve this particular question? So here, as you can just check, there is no cash inflows from the project available. So can I put it like this? If there is no cash inflow from the project available, so we are going to use NCO method. So for NCO method, what will you do? For NCO method, we will be taking A plus B minus C. Okay. And we have two machines. So let us write down like this only: machine A, machine B. Okay. Machine A and machine B. And what is your A? PV of initial investment. Okay. So we can solve this very quickly now because there is nothing in this particular question. Your initial investment is 1,50,000. And when are we going to make this? Today. So I'll multiply this by 1. So that will be 1,50,000. And my B will be PV of running cost. So what is your PV of running cost? So we are having the running cost of, you all can just check, it costs 40,000 per year to run. So 40,000 per year to run, multiplied that by, can I say what is the life of the asset? It's 3 years. Okay. So machine A has 3 years. So PVAF at. Now see, they have given to you real cash flows, but there is no data regarding inflation and all. So we are going to discount everything at this 12% rate only. So 10% rate only. So at 10% for how many number of years? 3 years. So this will now be 1 divided by 1.1, 1, 2, 3. And the annuity factor for this will be 2.4869. So if I multiply this by 40,000, I'll be getting 99,474. And what is going to be my C part? PV of salvage. So let us see if there is any salvage. No, there is no salvage available. So that is why I will just have to take now 1,50,000 plus 99,474. So what is my net cash outflow? It is 2,49,474. When we talk about your machine B, what is your initial investment? So that is going to be 1 lakh. So this itself will become 1 lakh. What's your running cost? Your running cost is 60,000. Now this 60,000, I need to multiply it by the PVAF at 10%. But for how many number of years? Just check. They have told you it will last only for 2 years. So this is going to be for 2 years. So 1 divided by 1.1. So that is 0. Uh, this is going to be 1.7355. So this will now give me 1,04,132. Okay. Just reconfirm the calculations. And with this, I'll add 1 lakh rupees. So there is no salvage here as well. So this will now become what? 2,04,132. But can I directly compare it? Then the answer is no, because the life is different. So we will calculate NCO per annum. So I'll divide this by 2.4869 and I'll divide this by 1.7355. So this will now give me 117,622 and 2,49,474 divided by 2.4869, and this will now give me 1,03,115. So can you just check that your NCO per annum is lower in your machine A? So your conclusion will be what? That machine A should be selected. Okay, because NCO per annum is lower. Okay. Now, I hope you have understood this question as well. See, company Y is operating an elderly machine that is expected to produce a net cash inflow of rupees 40,000 in the coming year and rupees 40,000 in the next year. The current salvage value is rupees 80,000. The next year salvage value is rupees 70,000. The machine can be replaced now with a new machine which costs rupees 1,50,000, but it is more efficient and will provide the cash inflow of 80,000 for 3 years. Company Y wants to know whether it should replace the machine now or wait for a year with a clear understanding that the new machine is the best available of the alternatives and that it can be replaced at the optimal point. Ignore tax, take opportunity cost of capital. Advice with reason. So basically, here also in this particular question, we are required to calculate that what should be the optimum replacement time. So in this particular question, how is it different from the earlier optimum replacement time? Because there were only cash outflows. There was no cash inflows from the project. That's why we used NCO method. But this is optimum replacement time and here there is cash inflow from the projects. So we can calculate the NPV. Okay. So see, it's very simple. If you want to replace today itself, okay. So I'll just solve this very quickly. Replacement is done today. Okay. And that is at year 0. So then what is going to happen? Then we will see that what is the PV of CI minus what is the PV of CO, and that will eventually give you NPV, right? So what is your PV of CI? So I can very easily calculate it like this. The cash inflow is 80,000 for the period of 3 years and the cost of capital is 10%. So I will take 80,000 and multiply that by the annuity factor of 10% for 3 years. So this will be 2.4869 and there is no scrap etc which they have told. So this will be 1,98,948. And when we talk about PV of CO, now understand like this. For example, we just calculate PV of CO provided that we are not going to replace it today. Okay, if you are not going to replace it today, then what's the PV of CO? So you all can just check that the machine can be replaced now with a new one which cost rupees 1,50,000. So can I say that 1,50,000 is my PV of CO today? Okay. So this will now be 48,948. So this is my NPV, which I'm planning to earn. But if I'm replacing it today, then can I put it like this? I am going to get some salvage of the old machine also today itself. Yes or no? Yes, sir. So I'll write down here if machine is replaced today. Okay, then salvage of old machine. How much is the salvage of old machine? Just check. The salvage of old machine, they have told you is 80,000. So obviously, this 80,000 is my cash inflow. So therefore, and this will be received today itself. So that's why it's 80,000. So therefore, can I say my NPV will now become 48,948 plus 80,000. So 48,948 plus 80,000, and that gives you 1,28,948. So you must be wondering, sir, why have you done this? You could have directly subtracted 80,000 here also. Yes, we could have done that. My answer would have been the same, 128,948. But why I've done this, you'll understand it right now. If the replacement is done after year one. Now, if replacement is done after year one, can I say I know what is the NPV of the project? The NPV of the project is 48,948. Okay, which I am going to get at the end of year one because the replacement happens at the end of year one. But at the same time, at the end of year one, is there any running cost? Is there any what do we say? Is there any uh, other values which are given to you? See, they have told you that, huh, company wise operating, and here the net cash inflow is 40,000 in the coming year and 40,000 the next year. Okay. So can I say that you are definitely going to earn the cash inflow of 40,000 at the end of year one? Okay. Which we need to discount it. Okay. And we will discount it at what? 10%, right? So everything actually needs to be discounted at 10% at the end of year one. So because this is 48,948 which we're talking about at the end of year one. So we have to bring everything to the present value term. So that's why this will be 1 divided by 1.1. So that is 0.9091, and this will also be 0.9091, because 40,000 is also nothing but what? It is nothing but the cash inflows that will be generated at the end of year one. And then after that, they have told you that the current salvage value is 80 and the next year salvage value is 70. So at the end of year one, now when you'll be replacing the machine, there will be some salvage as well. But this all needs to be brought down to today's value, present value. 48,948 into 0.9091, 40,000 into 0.9091, because that's the revenue for year one. And then 70,000 into 0.9091. So this is coming somewhere around 1,44,500. 1,44,436. So now what are we going to do? We will select the project in which the NPV is going to be higher. So we'll write down the conclusion. Replacement should be done at end of year one, because NPV is maximum. There we were searching, okay, sir, your what should be minimum, then your cost should be minimum. NCO should be minimum. Okay. Chalo. Now after this, what's the next question? Question number 26. This is also a question on replacement only, optimum replacement cycle. Now see, let us read this. A machine used on the production line must be replaced at least every 4 years, and the cost incurred to run the machine according to its age, which is given to you, that is purchase price today itself is 60,000 and year zero. And then they have told you that the maintenance cost is at the end of year one, that is 16,000, then it is 18, then it is 20, and then it is 20. So this is your cash outflow. Repairs, that's also your cash outflow. Scrap value, that's your cash inflow. And further replacement will be identical with the same cost. And so if you're going to replace the old machine with the new one, then you're going to get it for 60K only. Revenue is unaffected by the age of the machine, ignoring inflation and tax. Determine the optimum replacement cycle. So basically, can I say we are required to calculate the optimum replacement time? Yes, sir. And the cost of capital is 15%, and the 4 years discounting factors are given to you. Now, see this particular question, we can directly see the solution for the same because it's extremely easy. We have done the same type of a question earlier as well. See here, what are we doing is, we are first identifying what are the cash flows. Now, first you have to identify NPV method for optimum replacement time or NCO method. Then the answer is NCO method. Why? Because there is no cash inflow from the project which is available. Okay. Now, if you are going to replace, this is case one. Okay. What is case one? If the replacement happens at the end of year one, then of course, today at year zero, what is the replacement cost? 60,000 you have borne. At the end of year one, the maintenance cost will be 16,000. Residual value is 32,000. You all can just check that here. Maintenance is 16, repair is 0, and salvage is 32. Okay, so first we are just identifying what are the cash flows. So can I say that 16,000 is my cash outflow and 32,000 is my residual value? So that's why, can I say that 16,000 is my net cash inflow? So this is my cash outflow, this is my cash inflow. So what can I do is, this is my cash outflow, this is my cash inflow. Can I discount it and bring it to the present value terms? Yes, sir. So that is coming as 46,086. What about year two? For year two, again, 60,000 I'm spending it today, and then maintenance and repairs and the residual value. So we have maintenance if we're replacing at the end of the year two. So we have to bear the maintenance for both the years, that is 16, 18, and also repairs. Okay, so 18 plus 4, 22, that is for year 2, and 16 is for year 1. So you all can just check, it is 16 and 22. Residual value at the end of the second year is 24, and based on this, then you'll be getting the net cash flow. Same, you have to do it for 3 years replacement cycle and your 4 years replacement cycle. But the important part is that these cash flows needs to be discounted and converted to the present value terms. Now, the moment we have the PVs, can I say that the present value cannot directly be compared because their life is different? So we have calculated equated annual installments, and then we have realized that we should replace the machine where the overall cost is lower, and that is lower in your 43,116. There the NPV was higher, here the NCO is lower. So can we replace the machine at the end of the third year? Yes or no? Yes, sir. So they have told you alternatively answer can also be computed excluding the initial outlay. Matlab, you can just exclude the 60,000 everywhere. Why? Because anyway we are going to pay that today. So 60,000 into 1, 60,000, 60,000, 60,000, 60,000. That's anyway going to be there for all the 4 years. So you can just ignore it and then move it forward. Okay, so it's going to give you the same answer. Understood this? Okay, so just practice this particular question. Okay. Okay, so now let us read this question. What is given to you that Trouble Free Solutions is an authorized service center of a reputed domestic air conditioner manufacturing company, and all complaints, service related matters of air conditions are attended by the service center. The service center employs a large number of mechanics, each of whom is provided with a motorbike to attend the complaints, and each mechanic travels approximately 40,000 kilometers per annum, and TFS decides to continue its present policy of always buying a new bike for its mechanics, but wonders whether the present policy of replacing the bike every 3 years is optimal or not. And it is of belief that as the new models are entering into the market on yearly basis, it wishes to consider whether the replacement of either 1 year or 2 year would be better than the present 3 year. The fleet of bike is due for replacement shortly, and the purchase price of the latest model bike is 55,000 and resale value at the end of year 1, year 2 and year 3 is given to you. Running and maintenance expenses excluding depreciation is available, and opportunity cost is given to you as 10%. You are required to determine the optimum. So again, what are we discussing in this particular question? What should be your optimum replacement time? So for optimum replacement time, we have three options. We can replace the bike at the end of first year, second year or third year. Okay. Now see, if we are replacing the bike at the end of first year, again very easy. We can write down case one, replacement of bike at end of year one. So year one, only for year one, what is going to be your road taxes and insurance? 3,000. So we have to bear this 3,000 now, because if we are replacing at the end of year one, so we have to bear this road taxes insurance at least for 1 year. Petrol repair maintenance is 30,000. Okay, so this was your taxes. This is your petrol. Okay, and how much is your petrol? 30,000. So the total outflow is what? 33,000. But this we are going to do at the end of year one. Okay. So this is 33,000. But also at the same time, at the end of year one, is there any salvage? Yes, sir. 35,000. So can I say this is your outflow, this is your inflow, and at the end of year one, then you have to buy the new bike, and that is 55,000. So we are going to consider 55,000. So that's your outflow. So let us see now what is going to be. We have to discount all these things at what percentage rate? 10%. So we'll be getting the PV, present value. So this is now going to be 1 divided by 1.1. So that will be 0.9091, 0.9091, 0.9091. So this will be, don't forget that this 35,000 is actually your inflow. Okay. So we have to subtract it. Okay. So this is coming as 48,182. But because we are replacing at the end of first year, second year and third year, so what will be the equated annual cost? 48,182. We have to divide that by 0.9091. So this is coming as around 53,000. Okay. What about year two? So if I'm talking about year two, case two, that is if replacement is at end of year two, then we are going to continue with the old bike for year two. So year one, definitely you are going to pay road taxes as well as repairs. So taxes plus repairs. So that is 3,000 plus 30. So that is 33,000. Okay. But can I say now we have to talk about year two? So year two, mein what is your taxes? 3,000 and 35,000. Exactly what you have done earlier. Okay. So this will be 38. And also at the end of the year two, what are we doing is we are going to sell this bike for 21,000. So 21,000 is going to be your inflow. And then we have to buy the bike for 55. So that's your outflow. So let's discount it at 10% to get the present value. So this is 0.9091 and this will become 0.8264, 0.8264 and 0.8264. ये कुछ आ रहा है मेरा तो 89,000। एक मिनट, हाँ, इसमें क्या हो गया? Have we taken 33,000? Yes, sir. So the present value comes as 30,000. And PV of resale value. What is the PV of resale value? Acha, so they have not considered that 55,000. They have ignored it. Why? Because everywhere it's the same. Okay. Oh, they have considered it here. Purchase price of the bike is 55. Okay. So this is coming as uh okay, 1818. And this will be 1818. That will be your net outflow. Okay. And the purchase price of the bike is, oh, this is, you cannot take 1818 and further discount it by 10% because this is already discounted at the rate of 10%. Okay. Because this is something which is already in present value. So basically, what you have done, that is correct. When I talk about year two, this is coming as 89,501. But then again, what we have to do, 89,501, we have to divide it by 0.9091 plus 0.8264. You cannot discount again the cash flows which are already discounted. Okay. So I have certain reservations there. So we will do this accordingly. 89,501 divide by this. So this will be now 51,571. Okay. So this one is coming as 53,000. This one is coming as 51,000. And what is your case three? Your case three is if replacement is done at end of year three. So what's going to happen? Year one, year two, year three, your 3,000 and 30,000. So 3,000 plus 30,000, 33,000 will be as it is. We have to pay that. Then 3,000 plus 35,000. So that's 38,000. And then 3,000 plus 43,000. So that is 46,000. And then at the end of the third year, will there be any salvage? Yes, sir. And how much is that? 9,000. And also, is there at the end of third year any kind of your purchase price? Yes, that's 55,000 for you. So this 9,000 is your salvage. Rest all are your outflows. This will be discounted at 0.9091, 0.8264, 0.7513, 0.7513, and 0.7513. Okay. So let's do this. One lakh 30,523. And what will be the equated annual cost? 1,35,23. I need to divide it by the PVAF 0.9091 plus 0.8264 plus 0.7513. So that is 2.4868. So 1,35,523, divide that by, so it will be 52,486. Our conclusion will be the same only. So if you are replacing at the end of year one, year two, and year three, at the end of year one, it is 53,000. Then at the end of year two, it is 51,571. And this one is 52,486. So replacement should be done at the end of the second year. That's what they have mentioned, that it should be replaced after 2 years. Okay. But this is how it is to be done. So I think with this, we are done with all the practice problems as well. All the 27 questions, we have solved it. Okay. Okay, so this is the last illustration which I wanted to discuss, and that is regarding your LNR Limited. See what is given to you. LNR Limited wishes to develop a new virus cleaner software, and the cost of the pilot project would be rupees 2,40,000. Presently, the chances of the product being successfully launched on a commercial scale are rated at 50%. And in case it does succeed, then LNR can invest a sum of rupees 20 lakhs to market the product, and such an effort can generate perpetually an annual net after tax cash inflow of rupees 4 lakhs. And even if the commercially launch fails, they can make an investment of a smaller amount of rupees 12 lakhs with the hope of gaining perpetually a sum of rupees 1 lakh. Evaluate the proposal of adopting decision tree approach. The discount rate is 10%. Now, this is your decision tree question only, but usually students face some problem regarding this particular question. So, I'll just discuss this. See, there is a company LNR, and it wishes to develop a new virus cleaner software. Now, generally, what happens in this when you are making a particular software is that first you don't know whether this particular software will be a success or a failure. So, generally, the software engineers will make a pilot project. Okay. And once it becomes successful, then they will decide that whether we want to now sell it in the market or not. Okay, so there are lots and lots of probabilities attached to this particular type of a product. So they want to manufacture a virus cleaner software. They want to develop that. And the cost of the pilot project would be, how much is it? The cost of the pilot project would be rupees 2,40,000. Okay. So basically, if suppose they want to manufacture, they want to develop this software, then they have to spend 2,40,000. Okay. Or else don't, or else don't develop this software at all. Okay. So either develop it, okay, or you don't develop this particular software. Okay. So it wishes to develop, and then the cost of the project is 2,40,000. Presently, the chances of the product being successfully launched on a commercial scale are at the rate of 50%. Okay. So presently, if suppose 2,40,000, if we invest and if we develop a particular software, then the chances that it can be a success is 50%. So can I say that this product can be a success or it can be a failure? Correct? And if it's a success, okay, then what is the chance of the same? Then there is 50% chance, okay, that it can be a success. There is 50% chance that it can be a failure. Okay. In case it does succeed, okay, now if suppose it is successful, okay, so I've developed the software and it becomes successful, 50% chance, okay, 50% chance there's a failure. What is happening is LNR can invest a sum of rupees 20 lakhs to market the product. Oh, now if the product becomes successful now, then we cannot easily sell this particular product. We have to then market it. Okay. So when the product becomes successful, then there are two options available with you, that whether you want to market it or you don't want to market it. Okay. And if you want to market it, then can I say that you have to spend another rupees 20 lakhs? Okay. If you want to market it, then you have to again spend rupees 20 lakhs. Okay. And then that will give you a, what is given to you, such an effort can generate perpetually an annual net after tax cash inflow of 4 lakhs. So that will give you a cash inflow of rupees 4 lakhs. Okay. But there is also a possibility that the product is successful, but you are like, I don't want to market it. Let it be now. If it's successful, it's like a feather on my cap. I don't want to further market that particular product. Okay. So I don't want to market it. I don't have 20 lakh rupees to market it and sell it. Okay. And even if the commercial launch fails, they can make an investment of a smaller amount of 12 lakhs with the hope of gaining perpetually a sum of rupees 1 lakh. So it is something like this that the engineers have developed, that even if the product fails, we can still invest some amount and generate some revenue out of it. Okay. So like they will be like, okay, we can sell it to this particular, we can sell this particular developed software to, let's say, MSMEs and generate some cash inflows by the same or whatever. Okay. We don't know. but just by spending 12 lakh rupees. Okay. So if it's a failure, again, there are two possibilities that you can market it by spending rupees 12 lakhs. Okay. And generate how much? 1 lakh rupees. Okay. Or else don't market it. Don't market it. Okay. So evaluate the proposal using decision tree approach and the discounting factor is 10%. Now see, first of all, let us decide that what are the decision nodes. Okay. So I've just created a rough background, that these are the possibilities which can happen. Okay. Now, if you guys can just check that uh, if you are at point A, deciding that whether you want to develop or you don't want to develop, and if you are developing, okay, uh, then you can, but ICI, as you know, they have considered this as node C and they have done it accordingly. Okay, but ideally that's not the correct way, because if you don't develop, then this becomes your node C. But still, chalo, we will go as per what nodes ICI has decided. So this is 2,40,000. So if we decide this to do it further, okay, so this is your decision node C. Okay, let us put it like this. This is node B, and we will write down this as your node C. Okay, and this as your node D. Perfect. So if we are right now at A, if we develop it, B. If we don't develop it, let us put it as E. Okay. But if we develop it, then there are two decisions which are possible. Okay, that it can be success or it can be a failure. And if it's a success, then whether we want to market it or we don't want to market it. And if it's a failure, then we want to market it or we don't want to market it. Okay. Now see, marketing or not completely depends upon what is your economic benefits which will be derived by it, right? So very simple concept that by spending 20 lakhs, is it worth spending it or not? Okay. So if you are at node C, okay. So if uh, we are at node C, okay, because first we have to check that if we are at node C, then whether it is economically viable or not, if it's beneficial or not. Okay. Then what is your PV of CO? My PV of CO is rupees 20 lakhs. And what's my PV of CI? So my economic benefit which I'm going to generate, that is 4 lakh rupees per annum. And I want to calculate its present value, but it is going to be constant till perpetuity. So we will capitalize it by our discounting factor, that is 10%, right? So benefits getting constant till perpetuity, there is no growth. So in that particular case, rupees 40 lakhs. That will be my PV of CI. So what's going to be my NPV? So my NPV will be rupees 20 lakhs, right? 40 lakhs minus 20 lakhs PV of CO. So 20 lakhs is going to be my NPV. So my NPV is going to be 20 lakhs. Okay. Now, if I don't market it, then of course my NPV will be zero in that particular case, right? So can I put it like this? That 20 lakh rupees is going to be my NPV if I'm going to develop the software. Okay. But what is the probability of success? So it's 50%, right? So can I put it like this? At node B, probability is 50%. Okay. So first of all, when you are standing at node C, you will always decide like this, कि sir, 20 lakh rupees is the positive NPV. Then why should we not market it? Okay. We will definitely market it, right? Because you are standing at node C and you are generating a net present value of 20 lakhs. Your decision will be what? Okay, sir, definitely we will market it, right? So our conclusion will be that since NPV is positive at node C, we will market, okay, the product. Okay. And at node B, okay, can I put it like this? The probability of success is 50%. So therefore, your estimated NPV is 20 lakhs with a probability of its occurrence, that is 50%. So can I say that your expected NPV is going to be 10 lakh rupees. Correct? What is your expected NPV beta? It's going to be 10 lakhs. So at node B, you know that the expected NPV which will be generated, that will be 10 lakh rupees. But of course, you should also see what is the NPV which will be at node D. Okay. So now I will write down if we are at node B, node D. Okay. If we are at node D. Now let us see if the product is the failure, what is the NPV? Okay. So if product is a failure, then let us see what is our PV of CO. Your PV of CO is you have to make 12 lakh rupees investment. Okay. And what is your PV of CI? So for PV of CI, we have to see what's the benefit which you are going to get. The benefit which you are going to get is 1 lakh. And that 1 lakh, I will capitalize it by 10%. So that's going to be 10 lakhs. Okay. Because the benefits are going to be constant till perpetuity. So your NPV will be negative 2 lakhs. So are you guys understanding that if we are at node D, the conclusion is NPV is negative, we will not market the product. So what's your conclusion? So since NPV is negative, we will not market. We will not market. Okay. So what's your, so what is your decision making at node C? So see, for example, you are at B where the product can be success or a failure. There is node C, there is node D, and in node C you have decided, okay, yes, we will market the product, and the estimated NPV is 20 lakhs. And of course, if it is a failure, then we have a chance to market the product, but we are seeing that the NPV is negative. Then who will market it, right? So that's why the estimated NPV here will be 0. Correct? Now, what is the probability of success and failure? 50-50%. So what is my expected NPV? Can I say that will be 10 lakhs and this is 0? So then the expected NPV is 10 lakhs. So can I say that in the decision making, we have understood at node B that the expected NPV is coming as rupees 10 lakhs. Okay, now if you see the solution, they have given you that only, that the expected at node B is nothing but 10 lakhs. Now at A, now whether we should test this particular product or not. So if I talk about decision node A, of course, then the answer is that we should. Why? Because we are just investing 2,40,000 to reap the benefit of 10 lakhs. So at node A, we will decide to manufacture or develop the software because by investing 2,40,000, we can generate NPV of rupees 10 lakhs. So very nice question, but the only thing is you have to first understand that how you are making the decision. So it's like whether we should spend 2,40,000 or whether we should not spend it. If you are spending 2,40,000, then we have to check that if we are spending 2,40,000, then there are two possibilities, that it can be a success or it can be a failure. If it is success, then we can market it further and generate revenue, and that is giving you NPV of 20 lakhs. But if you are failing, then it is giving you a negative NPV. Then of course we will not manufacture it. So that's why we have two estimated NPVs, 10 lakhs and 0. And that will bring it down to your node B, which gives you 10 lakhs. And then at node A, we realize that, of course, we should take that into consideration, because just by spending 2,40,000, if you're getting the benefit of your 10 lakhs, then definitely it should be taken into consideration. Okay. So I think, guys, with this, we are done with all the concepts which are there in the study module for this particular chapter. I hope you all have understood this very thoroughly.